Hello, good evening, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to another session in the Conquer Prelims 2026 initiative. And today we are going to have a marathon on some of the very important topics from the subject of Indian economy. This is your educator, Shyam Kagod, taking up the discussion. Before I start the session, please do let me know, am I audible and visible for all of you? Those present in the session, please give the confirmation. Am I audible and visible for all of you? Great. Thanks a lot. This is the first marathon in the subject of Indian economy. Before I start, those who are preparing for the civil services exams 2027, this is the right time to start your preparation. Right now, all our courses are available at a discounted price of 17,999. And once you use the code IAS English, you will not only get a discount, you will also become eligible for CSE Assure. Those interested in enrolling, do check out the details by clicking on the link provided in the description below. And before I start with the first important topic, listen to me very carefully here. In today's marathon, I'm going to cover topics such as national income aggregates, inflation, taxation, budgeting, and banking. For UPSC Prelims examination, are these the only important topics? Absolutely no way. There are multiple other topics. So please make a note of this. On 6th March 2026, same timing, that is 4 p.m., I'm going to cover these topics. And on the 24th March 2026, at the same time, that is 4 p.m., I'm going to cover the remaining topics. So if I cover all these particular topics, including today's topics, you would have covered all the important topics that are needed for getting good number of marks in the prelims examination. And second point, very important one, in order to consolidate what you are learning today, in order to basically reinforce the learning that you're doing today in the session, you can join my special classes tomorrow. Tomorrow at 7 p.m. Please make a note of this. Tomorrow at 7 p.m., 18 February, I'm conducting a special class wherein I'm going to discuss topic-wise MCQs as well as PYQs. The MCQs as well as PYQs. So tomorrow, one session, 18th February 2026, and day after tomorrow, 19th February, there will be one more session. So we are going to cover topics. You need to listen to the discussion carefully. Tomorrow, attempt the MCQs. That itself will be a reconsolidation or reconfirmation of the knowledge that you're going to basically learn today. So all you need to do to join these two sessions is scan the QR code. There are two QR codes. You need to scan these QR codes, join the session tomorrow 7 p.m., day after tomorrow 7 p.m. Right now, you can hit the button enroll now. Okay, let's go forward. First important topic. As I mentioned earlier, just a reminder, today I'm going to discuss the national income aggregates. One topic. Second one will be banking. Third one will be inflation. Third topic will be inflation. Fourth one will be taxation. Fifth one will be budgeting as well as finance commission. So these are the 6 topics for which we are going to have a discussion today. And before I start, listen to me very carefully. A lot of you have the habit of writing down when I'm discussing. I don't want you to write down. I want you to simply sit and listen. Sit and listen. I've got a surprise for you later on. Just sit and listen. I'll be taking a mind maps for all these chapters, all these topics. We will have a discussion through mind maps. Let's start. First one, national income, right? So national income. So under the national income, there are multiple indicators that you're supposed to know. You have gross domestic product. You have GDP. You have GNP, gross national product. You have NDP, net domestic product. You also have NNP, net national product. And after studying all of this, you also have the per capita income. So let's understand all these particular indicators one after the other. Let me start with the first one, gross domestic product. Please observe the mind map. It is for your benefit. Please observe the mind map. And do not worry about the PPT. You will get access to the PPT after the class is over. So listen to the discussion carefully. What is GDP? Gross domestic product. The gross domestic product essentially measures a territorial concept. Territorial concept simply means within the territory of India. I repeat, within the territory of India, the market price of all the final goods and services that are produced for a particular financial year, for a particular quarter, etc. When you measure that, that is called as a gross domestic product. This should be very clear to you. But when I say the market prices, we are not going to count the market prices of all the goods and services produced. No, we are going to count only the market prices of final goods and services. Final goods and services. Why final goods and services? If you count any kind of other goods, such as let's say intermediary good, if you count an intermediary good, then there is a possibility, not a possibility, a guaranteed double counting. There is a double counting. That is essentially if you count, let's say, for sake of simplicity, let's say there's a particular product and there is raw material or the intermediary good that is used to manufacture this particular good. Now, if you count the intermediary good, let's say wheat, which is used in the production of biscuit, and also the value of the biscuit, then you're counting wheat 2 times. That's the reason you do not count the market prices of intermediary, you only count the market price of final goods and services. Is this point clear to all of you? That particular definition is provided here. Do not worry. Second, it is a territorial concept. Like I said, what do you mean by territorial? Within the territory of India. Within the territory of India, whether the production is done by a domestic company or production is done by a foreign company operating in India, doesn't matter. As long as the production is done within the territory of India, it will be counted as a part of India's GDP. Important point, remember. Point number 3. How do we measure GDP now? How do we measure GDP? There are 3 methods to calculate GDP. There are 3 methods. One is the production method. Second one is the income method. And the third one is the expenditure method. Production method, income method, and expenditure method. What is the meaning of each one of them? Let's start. Production method, in this, we essentially count the value of the final goods and services by this formula. You count the market price of all goods and services. You count the market price of all goods and services. From this particular number, you subtract the market price of intermediary goods. You subtract the price of intermediary goods. Is everybody okay with the formula here? Please do let me know. Production based formula. Get the sum total of all the goods and services produced in India. From that particular market price of all the goods and services, simply subtract the market price of the intermediary goods. What is left out after doing this? What is left out is the market price of final goods and services. Is it okay? This is called as value addition method. Production value method or value addition method. This is the first method. Second method is called as income method. Second one is called as income method. Under the income method, we essentially take the sum total of all factor incomes. We take a sum total of all factor incomes. Sir, what do you mean by factor incomes? Please understand. When you read the basics of economics, that is essentially go back to the microeconomics, you will come across a concept called as 4 factors of production. Correct? 4 factors of production. The acronym that I generally recommend the students to remember is CELL. The acronym. Labor, capital, entrepreneurship and land. Land, labor, capital and entrepreneurship. So when a company uses any one of these, in fact it uses all of them, whenever a company uses any one of these factors of production, company will pay a cost. That is called as a factor cost. The company will pay factor cost, but the one which is providing the services will receive the money, and that is called as a factor income. That is called as a factor income. So can you simplify it much further? Once you become IAS officer, because I know all of you want only IAS. Nobody wants IPS, nobody wants IFS, nobody wants postal service. Every one of you wants to become IAS. So once you become IAS officer, you will provide the services to the government. Government will pay salary to you. So you have provided services. In return, you receive the income. And that, my dear, is called as a factor income. Everybody is okay? Factor income. So come back to the discussion here. You take the sum total of all the factor incomes generated in India. And that is called as the GDP through income method. Is everybody okay with the second one? Third one. The third one is called as expenditure method. Third one is expenditure method. What is this expenditure method? The formula is very simple. C plus I plus G within the bracket X minus M. C plus I plus G within the bracket X minus M. What does the C represent? C represents the total expenditure, that is the consumption expenditure. Consumption expenditure. I represents investment expenditure. Third one is the government expenditure. Government also spends a lot of money to purchase goods and services. X minus M, X stands for exports, M stands for imports. X stands for exports and M stands for imports. Now before I go forward, can I simply say this particular formula for calculation of GDP is applicable for an open economy? Yes or no? This particular formula of calculation of GDP is applicable for open economy. What if it is a closed economy? Do let me know. What if it is a closed economy? In that particular case, you will not be worried about X and M. You will not be worried about X and M because if it is a closed economy, essentially no imports, no exports. So you will not be worried about X minus M. You will be only worried about C plus I plus G. Please be very careful. Suddenly UPSC can make you fall into a doubt with these kind of statements. So in an open economy, it is C plus I plus G, X minus M. What is the meaning of it? Total expenditure done by you and me to purchase goods and services. Total investment done by the companies to purchase, let's say, machineries. The total expenditure done by the government to purchase goods and services. This will give you, please have a look at the calculation now. This particular number will give you, that is C plus I plus G will give you total expenditure on final goods and services. It will give you total expenditure on final goods and services. But there are certain goods and services which are imported. So can I simply write it as minus X so that imports will be withdrawn? There are certain final goods and services which are manufactured in India. These are exported. They were not counted when you calculated C plus I plus G. They were not counted when you calculated C plus I plus G. So what I do is plus M. This is nothing but the GDP calculation through expenditure method. GDP calculation through expenditure method. Is everybody okay? These are the three methods to calculate GDP. Please look at the mind map now. Please look at the mind map. These are the three methods to calculate GDP. Now, who will calculate and publish GDP in India? Which authority calculates and publishes GDP in India? It is basically the National Statistical Office, which functions under Ministry of Statistics and Program Implementation. Now here, I'm expecting a question in the upcoming prelims. What kind of question? Please make a note of this. We have Ministry of Statistics and Program Implementation. Under that, we have NSO and we have Program Implementation. NSO further has CSO as well as NSSO. It has further CSO as well as NSSO, right? Central Statistical Office, National Sample Survey Organization. Now, please memorize these particular surveys or indices which are published by respectively both of them. Is my statement clear to all of you? My suggestion, please memorize the indices. Of course, the list is very big. I've given you the most important ones. And if anybody has a doubt, some of your typing questions, please hold on to your doubts. The practice of this marathon session will be first, let's say for 1 hour, 1.5 hours, I'll cover topics. Then I'll take basically 10 minutes or 5 minutes. I'll ask questions. If you have any kinds of doubts, you can raise the doubts. I'll address them. Done? Let's continue with the flow. Then in between, right, when you people will start falling asleep, when you people will start snoring, and your parents will come running inside to check out what has happened to you, that is when I'll start asking questions to all of you. Done. So CSO publishes IIP. It publishes Annual Survey of Industries. It publishes National Income Aggregates. The NSSO publishes HCES. This was there in the newspaper a couple of days ago. All of you heard of this? Household Consumption Expenditure Survey. What was the importance of it? The Household Consumption Expenditure Survey data for 23 and 24 now has been used to basically revamp, basically create a new index for CPI calculation. So please be very careful. It is NSSO which publishes it. The Periodic Labor Force Survey and the Time Use Survey. TUS stands for Time Use Survey. Done. So I am expecting a question from this. So please go through some of the surveys or indices which are published by respectively both of the organization. Come back to the discussion. Calculated by whom? National Statistical Office. It is published for every quarter in India. Please remember, GDP is published for every quarter. GDP is published for full financial year as well. Full financial year as well. Okay, let me see how many of you have revised correctly. If GDP is calculated every quarter, how often is NDP calculated in India? I'll repeat my question. How often do you think NDP is calculated in India? I'm pretty sure all of you have read about NDP. We will revise it now. What is the frequency with which NDP is calculated? Do let me know in the chat section. Shivani Patidar says annually. Aman Singh says annually. Others will be like, sir, wait. I'm asking Gemini. I'm asking ChatGPT. Wait, I'm checking my notes. I don't know where I've written it, etc. It is published annually. NDP is published annually right now. Please be very careful. Why I'm asking you this kind of question? Tricky questions. I do understand. Tricky. Reason is, very recently MOSPI is Ministry of Statistics and Program Implementation, has announced that by 29 and 30, they are planning to shift away from GDP to NDP. Correct? They are planning to shift away from GDP to NDP. So right now, do we calculate NDP, right? Let's say quarterly like we do GDP? No, we calculate NDP annually. Right? Whereas GDP, because it is the most important indicator calculated in India, we calculate it once every quarter, once a full financial year as well. Let's go forward. Right now, the base year is 2011 and 12. Everybody is okay with this? Right now, the base year is 2011 and 12. And listen to me carefully. In another 2 weeks, this is going to change. I'll do a hashtag. In another 2 weeks, this is going to change. I'm clarifying this because let's say somebody is watching this particular video in the month of March. They will simply say, sir, you are wrong. Please update yourself. You're the faculty. How can you make silly mistake like this? Right? Argument is the government of India is going to make a change. Right? It is going to make a change on 28th February. New database will be announced. A new base year will be announced. Let's wait and see. Right? Although already it is known what is going to be the new base year. Let's wait and see what will be the announcement of the government. So right now, the base year for the calculation is 11 and 12. Calculated quarterly as well as annually. The base year earlier was 2004 and 5. 04, 05, and now the base year is 2011 and 12. And the GDP is calculated at market prices. Why I'm writing all of this? Please understand, in the year 2015, the new GDP methodology, right? In the year 2015, the government of India announced a new GDP methodology. And that is going to change in 2026 now, after more than a decade. When it was changed earlier, before that, the base year was 04, 05. The government changed it to 11 and 12. Earlier, we used to calculate GDP at cost prices. Now we are calculating GDP at market prices. Right? We calculate gross value addition now. We calculate even the gross value addition. We calculate the production data. That is the industrial data. How do we collect the industrial data? Right now, we are using a system called as MCA 21 database. MCA 21 database, that is Ministry of Corporate Affairs 21 database, right? That is a database that is used. And regarding, let's say, sir, what about unincorporated enterprises? Some of you will ask me this question. Are we collecting the data annually from the unincorporated enterprises in India? Right now, I repeat, right now, no. But going forward, yes. From the next cycle or the next type of GDP that we are going to introduce from the next month, we are going to calculate even the data from unincorporated enterprises. That is basically the idea. You must have heard of, listen to me carefully, you must have heard of a criticism regarding the GDP. What was the criticism? The current GDP does not reflect the amount of productivity from the unincorporated enterprises. Why? What we used to do, or we are used to do until now, is essentially calculate the ratio between the corporated as well as unincorporated enterprises. That is, within the GDP number, within the production number, how much is contributed from the corporated, that is organized, as well as unincorporated, unorganized. That would be the ratio taken from base year. This would be taken from base year. And next year, anyways, you're going to count how much is the contribution done from organized sector. Correct? Next year, you're going to count how much is the production from organized sector. Now you will essentially keep on adjusting the production contributed from unorganized in the same ratio. Is everybody okay with this? We will ensure that the same ratio will be continued to be used over a period of time. That used to happen because we did not have a survey representing the production activity from unincorporated enterprises. We are going to change that with a new type of a survey, ASUSE, Annual Survey of Unincorporated Sector Enterprises, ASUSE. Is everybody okay? Please do let me know. Right? And finally, what is the formula for the calculation of GDP? What is the formula for the calculation of GDP? This is the formula. First, we start with the factor cost. Everybody is okay? First, we start with the factor cost. That is a gross value addition at factor cost. And we basically adjust, right, with basically the idea of the taxation as well as the subsidies. Once we adjust that with the taxation of subsidies and, taxation and subsidies, what we get is, right, the basic prices, GVA at basic prices. And once you get GVA at basic prices, you adjust it further to get GDP at market prices. GDP at market prices. Everybody knows the formula. I'm presuming all of you know the formula. I have not written the detailed formula. Detailed formula essentially will be like this. Before somebody says, sir, write it. What is the problem? It will hardly take 1 minute. Write it. Somebody will say. So I'll write it. Right. So formula is very simple. You start with the factor cost, but you do not directly write factor cost. You write it GVA at factor cost. Plus you will write production taxes minus production subsidies. Once you adjust this, what you get is GVA at basic prices. GVA at basic prices. Now you take GVA at basic prices, you add product taxes. You add product taxes and subtract product subsidies. Subtract product subsidies. What you get after this is nothing but GDP. I don't have to write at the market price, but what you get is essentially GDP at market price. This is the formula. Again, I'm saying you might experience a change in the formula. I also don't know what is going to happen after 28th, but be ready. If not in the prelims, at least in the mains, they can ask you compare the old method with the new method. So be ready for these kind of questions. Is everybody okay with the GDP now? Please do let me know. Is everybody okay with the GDP now? Can I move forward to other indicators? This is the most important indicator, by the way. Most important indicator. Be very careful with this indicator. Okay. Now, apart from the GDP, what are the other types of indicators that you're supposed to know? These are the other types of indicators. Let's start. These are the other types of indicators. You're supposed to know gross national product. You're supposed to know gross national product, but don't worry, there's a mismatch here. I'll correct it, don't worry. You're supposed to know gross national product. You're supposed to know net domestic product. You're supposed to know net national product. And finally, you're supposed to know NNP at factor cost. Again, I'm saying, don't worry. All of these, I'll correct it in the PPT. Don't worry, there is a mismatch here. NDP is part of national income aggregates. NNP is part of national income aggregates. And the last one is net national product. Now, what is the meaning of each one of them? Let's understand. What is GNP? Gross national product. The gross national product simply represents the market prices of all the final goods and services which are produced by residents of a country. Simple. Which are produced by residents of a country. Is everybody okay? Right? What is the basic idea? In the gross domestic product, it was a territorial concept. It was a territorial concept. Territorial simply means we are focused on production done in India. Production done in India, only in India. Right? Whether it is produced by a foreigner, whether it is produced by a domestic company, doesn't matter. As long as it is produced in the Indian territory, it will be counted as a part of India's GDP. Whereas GNP is a nationality concept. GNP is a nationality concept. What do you mean by nationality concept here? Whether it is produced within the territory of India or outside the territory of India, as long as it is produced by the resident of India, it is counted as part of India's GNP. Is the statement clear to all of you? I'll repeat it again. Whether it is produced within the territory or outside the territory, doesn't matter. The production should have been done by the residents of India. And if it is done by the residents of India, it will be counted as a part of India's GNP. And how do I write the formula? I'll write the formula here. The gross national product is equal to GDP plus net factor income from abroad. Net factor income from abroad. Is everybody okay? GNP is equal to GDP plus NFIFA. Sir, what do you mean by NFIFA? All of you remember the concept of factor income? I mentioned it hardly half an hour ago. Not even 2 months ago, hardly half an hour ago. Factor income means what? Anybody who provides factor services. As an input to the company, they will receive income, and that is called as factor income. Now, listen to me carefully. What is this idea for NFIFA? Here, we are going to count the total factor incomes that are generated by residents of India but outside India. Simple. The total factor incomes which are generated by the residents of India, but it is generated outside India. What do you mean by generated outside India? Let's assume you're a software engineer. Now your company will send you to USA. Very common, it will send you to USA. Assuming Mr. Donald Trump will allow you to enter USA now, let's say you will go to USA for a period of 3 months. Right? You will go to USA for a period of 3 months. Now, after 3 months, you will come back to India. Right? You will come back to India. So, can I simply say, you are a resident of India, but you have generated factor incomes outside India. Is everybody able to understand? You are a resident of India, but you have generated factor incomes outside India. So, you are going to count this, right? You are going to write it as factor incomes generated by residents, but outside India. But you will also subtract. That is net component. Net means what? Adjustment. Net means how much is coming into India minus how much is going out of India. Just like you go to USA, can we also assume somebody from USA would visit India for a period of, let's say, 2 months on work basis, for 3 months, for 4 months, etc. So they will be working in India, generating factor incomes in India, but that is not counted as a part of India's GNP because these are not residents of India. So I will subtract factor incomes generated by non-residents but within India. So this is essentially the net factor income from abroad. I have written NFIFA. Instead of that, they will also write NFIA, net factor income from abroad. So GDP will consist of total factor incomes generated by residents plus non-residents within India. I'll repeat it. GDP consists of what? Total factor incomes generated by residents plus non-residents in India. So once you subtract the factor incomes generated by non-residents, you will be left out with the factor incomes generated by residents who are within India plus factor incomes generated by residents but outside India. This will give me the total market prices of the final goods and services produced by the residents either within India or outside India. Is everybody okay with the concept of GNP? Do let me know now. Is everybody okay with the concept of GNP? Everybody is okay with the idea of a GNP? Okay, now this is GNP. The points are given here. Please have a look at it. Market value, that is a market price of all the final goods and services produced after accounting for net factor income from abroad. You have taken care of it. The incomes generated by factors of production owned by Indians will be considered, that is Indian residents. Indian residents, whether within India or outside India. The incomes generated by factors of production owned by the foreigners will be deducted. Right? So simple. So this is gross national product. Let me move on to the next indicator, NDP, net domestic product. NDP, net domestic product. What is the basic idea of a net domestic product? There is a term called as depreciation. Now, some of the students will be very happy. Which students? Those particular students who are from commerce background. Right? Commerce background. Right? They'll be very happy. That is, they'll be like, yes, finally something that I've learned in my college days. You wake me up midnight, ask me about depreciation, I will tell you the answer about depreciation, they'll say. What is depreciation? You purchase an asset. You purchase the asset. During the manufacturing process, the value of the asset will keep on decreasing. The value of the asset will keep on decreasing. Why? Because of wear and tear, because of the repairs, etc. That is essentially called as depreciation. Is everybody okay? That is essentially called as depreciation. So when you calculate gross domestic product, I repeat, when you calculate gross domestic product, can I simply say you have not accounted for the wear and tear or the reduction in the value of your capital assets? Simple. When you calculated GDP, what did you do? You simply took the market price of all the final goods and services. Right? You simply took the market price of all the final goods and services. Right? And you calculated GDP. But in the process of producing the goods and services, you are consuming certain capital. That is machinery. The value of the machinery is decreasing. You have not accounted for that when you calculated GDP. That is the precise reason. When you calculate NDP, essentially the formula is simple. NDP is equal to GDP minus depreciation. Is everybody okay with the formula? Please do let me know. NDP is equal to GDP minus depreciation. This is essentially the formula. This is essentially the formula. Is everybody okay? And before I move on to the next one, everybody is able to understand GDP is an indicator, no doubt. Most followed indicator, no doubt. But GDP has certain flaws in it. GDP does not account for many of the things. For example, what if UPSC will ask you, which is the indicator which represents factor incomes generated by residents? I hope you understand, which is the indicator which is representing the factor incomes generated by residents. A lot of you will be thinking about GDP, but GDP is not representing the residents, by the way. It is a territorial concept. It is not representing the residents, right? Let's say factor incomes. And I know a lot of you are writing GNP. Wait, hold on, hold on. There are two more indicators, then you can give the answer to this question. Please wait, okay? So this is NDP. Everybody is okay with NDP? Now let's move on to the next indicator, NNP, Net National Product. Right, so GNP is done, NDP is done. Next one is NNP. What is NNP? Net National Product. But what is Net National Product? It is the market price of all the final goods and services produced by residents of a country after accounting for depreciation. I'll repeat the statement. It is the market price of all the final goods and services which is produced by residents of a country after accounting for depreciation. That is, earlier we calculated GNP. But there's a problem with the GNP as well. That is, you simply calculated the market price of all the goods and services produced by the residents. But in the process of producing these goods and services, even the residents will be consuming capital. Even the machineries purchased by the residents of India, the companies of India, they will also be experiencing depreciation. That was not mentioned. That was not mentioned in the GNP. So now, can I adjust even the GNP number? That is, NNP is equal to Net National Product is equal to the GNP minus depreciation. Is everybody okay with the formula? Please do let me know. GNP minus depreciation. This will give you the Net National Product. So from GDP we started, we have arrived at NNP. Now listen to me carefully. Now if I ask you, please tell me which is the indicator representing the incomes generated by residents of India. You tell me which is the right option. You have calculated GDP, you have calculated GNP, you have calculated NDP, and you have calculated NNP. These are the four indicators. You tell me which is the right indicator which represents the factor incomes generated by residents of India. As expected, all of you have written NNP. But my dear, please clarify it. It should be NNP at factor cost. Somebody says all. Chirag, my dear, all. Why? Why all? How can all be the answer? Do you think GDP represents the factor incomes generated by residents of India? No. GDP represents the total factor incomes generated in India. Please read the statements in the UPSC Prelims exam carefully. Please read the statement carefully. Why? If the UPSC says, which of the following indicators will represent the total factor incomes generated in India? That is GDP. Is everybody okay? That is GDP, because in India means territory. Within India, it is GDP. But if the question is, what is the right representation of factor incomes generated by the residents of India? It has to be NNP at factor cost. It has to be NNP at factor cost, not even NNP at market prices. Why? Listen to me very carefully now. You have calculated GDP. Can I simply say GDP by default is calculated at market prices? Correct? And some of you might be thinking, sir, what is that you're looking on the right side? What do you keep looking, my dear? I'm looking at the chat section, by the way. Nothing else. I'm looking at the chat section. Okay. So can I simply say GDP by default, whatever number you get, until unless it is clarified to you, it has to be at market prices. But when you use a GDP and keep on purifying and reach NNP, you reach NNP. Don't you think the NNP that you have calculated is also at market prices? Correct? Is also at market prices. So the problem here is, when you calculate NNP at market prices, you have arrived at market prices using the formula. What is the formula? You start with factor cost, you add indirect taxes, you subtract the subsidies, and that is when you get market prices. Now, very simple question to all of you. Tell me now, if question is only the factor incomes generated, do you think the factor cost is a better indicator or at market price is a better indicator? Think of it now. At least think of it now. If the question is calculate the factor incomes, tell me which indicator will give you pure factor incomes only. Market price is the market price, agreed, but that doesn't represent the factor incomes only. There is adjustment with subsidies, there is adjustment with indirect taxation. So what we need to do, we essentially need to take both of them, transfer on the other side. Simple. Transfer on the other side. Can I write the formula now? NNP at factor cost is equal to the NNP at market prices minus indirect taxes plus subsidies. Now please tell me, is everybody okay why they call NNP as purest form of income? Do let me know. Anybody who has read NCERT can tell me the answer now. Why they call NNP as the purest form of the income? Why not GDP? Why not, right, let's say NDP? Why not GNP? Because my dear, all these indicators represent factor incomes, no doubt. But they do not represent the factor incomes generated by you and me. There are many more things that are included or excluded there. That is the reason NNP at factor cost is referred to as the purest form of national income in India. Is everybody okay? Everybody is okay. And if you look at it, NNP at factor cost, we have adjusted the number for indirect taxes. We have removed the impact of it. We have removed the impact of subsidies. We have removed the impact of residency. And we have removed the impact of depreciation also. Everything, whatever you can adjust, you have already adjusted. So whatever is left out now, that is NNP at factor cost, is nothing but the factor incomes generated by residents of India, whether in India or outside India. Is it okay? Can I go forward now? Everybody is okay with the discussion? Okay, now let me complete this particular chapter, then I'll address your doubts. Please have a look at the table. All of you, please have a look at the table. This particular table has been done. It has been created. It has been prepared so that you will find it easier to revise it at the last moment. At the last moment, you find it very easier to revise. Whatever are the important points in the context of all these indicators, GDP, GNP, NDP, NNP, full form of it, what does it represents, what is the formula for calculation, and what is the inference? What is the inference? What is the inference of these indicators? It is mentioned here. Actual income of, it's not actually citizens, it is residents. Actual income of residents, right? NDP represents the productive capacity of the economy. GNP represents economic output by residents, whether within India or outside India, economic output within the territory of India. Please download the PPT later. Don't worry, PPT will be uploaded. Download the PPT, use it for revision purposes. The whole idea of creating mind maps is you should be able to revise it much easier. Done? Okay, let's go forward. Now, apart from this, right, there are other indicators. One is called personal income. One is personal income. Second one is personal disposable income. Right? Personal income, personal disposable income. And there is one more indicator. Have a look at this. National disposable income. National, right, disposable income. Let's start. What is this personal income? Personal income represents part of the national income which is received by households. Please read the statement. Part of the national income which is received by the households. This is called as a personal income. Right, sir, what do you mean by that? Let me give you a very simple example. Imagine there is one house in India, okay, or only one person, not house, one person is there in India. Now, what is the personal income of this particular person? You will simply say a salary earned by the person. Whatever is the salary paid by the company, that is the the personal income. No, that is only the part of the calculation. It doesn't cover all the aspects of the personal income. The company will pay you, let's say hypothetically, 1 lakh rupees a month. The company will pay, I repeat, 1 lakh rupees a month. Does it mean you receive all the 1 lakh rupees a month in your hand? No. Right? And don't you think if you are receiving 1 lakh rupees a month, on the side, you might be receiving certain assistance from the government of India as well? Correct? You might be receiving certain assistance from the government of India as well. That is in the form of transfer payments, subsidies, etc. That is also not accounted. So when you say personal incomes, it is the part of the national income which is received by the households. How do I calculate it? Please look at the table here. All of you, please look at the table. Don't worry, I'll magnify this. Right? Please look at the table. You calculate NNP at factor cost. And all of you understand why I take NNP at factor cost? Why not GDP at market prices, etc.? Because when you calculate GDP, etc., these are at market prices and they do not represent the incomes generated only. They represent, apart from income, something else is also there. So take NNP at factor cost. The sum total of all these, that wages and salaries, rents, interest, profits, net factor income from abroad, all this represents the total factor income generated by the residents. Now, out of this, have a look at this component. Subtract something. You need to subtract something. What is the subtraction? Let's start. Out of this, there are certain social security contributions that you do. That is, you are an employee. You are earning salary. Don't you think part of your salary will be taken away for your social security contributions? Yes or no? Sir, what do you mean by social security contributions? EPF. Best example, EPF. Don't you think that will be deducted from your salary? Yes. Second, have a look at the second one here. Corporate taxes. Companies are part of residents in India. Companies are part of residents. The profits generated by the company should be given to the shareholders. That is given in the form of a dividend. But don't you think the company's profits are derived after paying the corporate taxes to the government? You get the profits which you want to distribute. First you pay taxes to the government. Then you are left out with the profit. Now, out of this particular profit, do we give everything to shareholders? No. Some of the profits the company will keep with itself. I repeat, some of the profits the company will keep with itself. It will not give to the shareholders. That is undistributed corporate profits. Is everybody able to understand here? Please do let me know. Everybody is able to understand. So corporates will earn profit. Profits should go to the households, that is the shareholders. There also certain adjustments are done. You earn salary. You are supposed to receive salary. Part of the salary is again made in the contribution of social security contribution. That also doesn't go to basically the hands of the income earner. You will adjust all of this. Now you will add one more component. You will add one more component. What is the component added here? It is transfer payments. All of you heard of transfer payments? What do you mean by transfer payments? Transfer payments are one-sided transfer. There is no good or a service that is given in return. It is simply a one-sided transfer. That is a transfer payment. For example, the government will provide certain subsidies to you. That is basically part of your money. The money that is there in your hand, it will come and sit in that particular hand. So transfer payments. You are going to count transfer payments. So all the factor incomes, subtract something, add a transfer payment. What you get after this is called as personal income. Is it okay? What you get after this is called as personal income. Now, out of the personal income, the government will take away income taxes. Simple. Out of the personal income, the government will take away income taxes. What is left out after that? What is left out after that is essentially the disposable income. Personal disposable income. Is everybody okay with this particular formula? Do let me know. Be very careful. Can be asked in the prelims examination. Can be asked in the prelims examination. Done. So I've written the formula here. Please go through that. Personal incomes, it is the amount or it is the part of the total national income which is received by the households. Received by the households. National income is generated. But how much of it is received by the households? It is personal incomes. And out of the personal incomes, after you adjust for the income taxes, what is left out? That is the money that you can spend to purchase goods and services. That is called as personal disposable income. PDI, personal disposable income. Okay, everybody is okay. Somebody will say, sir, only income taxes are adjusted? No, not just income taxes. You simply use the term fees and fines. There is a term fees and fines. It's not just income taxes. If you're supposed to pay certain fines to the government, certain fees to the government, even that will be taken out of your personal income. And what is left out after that is called as disposable income. And next concept, national disposable income. I know a lot of you will be feeling difficult right now. Why? You have never heard of these terminologies. If you have not heard of it, be careful. These terms are from NCERT books. These are from NCERT books, by the way, and UPSC has the habit of asking questions directly from NCERTs. So, national disposable income. What is this national disposable income? It is representing what is the maximum amount of goods and services the domestic economy has at its disposal. Meaning, within India, I repeat, within India, what is the maximum demand for goods and services? How much can we purchase within the domestic market? I know somebody will basically say, sir, it is the total incomes generated in India. My dear, that is not the correct option. That is not the correct answer. Why? Listen to me carefully. If I simply say the factor incomes generated in India, are we not forgetting some of the amount, that is, let's say the salary is paid by the company is 1 lakh, but I'm not going to receive 1 lakh rupees in my hand. Correct? Everybody is able to understand? I'm not going to receive, right, let's say 1 lakh rupees in my hand. Some of it will be, right, taken away. But we are also forgetting one more adjustment. That is, I might receive certain remittances from abroad. Yes or no? I might receive certain remittances abroad. Right? So we are forgetting that component as well. So we need to adjust for all of it. And whatever money I spend to purchase goods and services is after adjusting all of this. And that is the reason the formula is given. National disposable income is equal to net national product at market prices plus other current transfers from rest of the world. NNP at market prices, that is basically the market prices of all the final goods and services produced by the residents. That is the income that is generated in India. Factor incomes generated for the residents of India, by the residents of India, whether within India or outside India. But let's say my cousin is, right, let's say a citizen of USA. They will send certain remittances to me this year. I will use that. I will purchase goods and services. That component earlier was missing. Now I will add that as well. Is everybody okay? Please do let me know. Is everybody okay? So the other current transfers, for example, remittances, basically idea of remittance. Earlier, we did not consider the remittances when calculating disposable income. Now we are counting even the remittances. Can we go forward now? And this is for the whole of India, by the way. Somebody will ask me, sir, what is the difference between national disposable income and personal disposable income? Personal means focused on the individual household, that is households. Whereas national disposable income refers to the whole of India. Whole of India, whatever residents are there, it could be companies, it could be households, etc. Can we go forward now? So these are certain important concepts in this particular chapter. One more concept now. Savings, investment and capital formation. Savings, investment and capital formation. Now, what is this idea of a savings, investment and capital formation? Listen to this carefully. Let's say there is a particular individual who will earn a salary of 100. Company will pay a salary of 100, but the government will collect 10 rupee income taxes. What is left out now? 90 rupees. Simple. The earning of the individual is 90 rupees. From the 90 rupees, let's say the person will spend 60 rupees and will save 30 rupees. Expenditure is 60 rupees. Savings is 30 rupees. Is everybody okay so far? Savings is 30 rupees. Okay, let's go forward. Now this particular savings, imagine there are two types here again. One could be a physical saving and the other one could be a financial saving. One could be physical and the other one could be a financial saving. What is basically the difference? Physical means I am going to use 30 rupees to purchase certain physical asset. Physical asset, for example, could be land. Whereas financial savings, I will use the 30 rupees to invest in certain financial instrument, financial asset. For example, I'll take this 30 rupees, invest in bank. That is keep bank deposit. So far so good. Please do let me know. I'll keep this particular 30 rupees in a bank. Now the bank will take 30 rupees, issue this 30 rupees in the form of a loan. In the form of a loan. To whom? Let's assume a manufacturer. Now the manufacturer will take 30 rupees, purchase, let's say, raw material. Purchase raw material, that is input, or purchase, right, let's say a machinery, or set up a manufacturing facility. Now don't you think either one is done or the second is done? That is either purchasing raw material or investing in machinery. That will lead to higher production in the market. Yes or no? That will increase the production of goods and services. And when the production increases, the supply also increases. Higher supply will contribute to higher GDP. Is everybody okay with the flow chart now? Krish is saying no sound is coming. Is it the same for all of you? Krish, my dear, please check from your side because the sound is correct for all the others. Sound is correct for all the others. Only you are facing a problem. Krish, please hit the refresh button. Okay, let's go forward. So production will increase, supply increases, that will contribute to higher GDP. Done, everybody is okay? This is essentially an example of a virtuous cycle in the economy. Done, everybody is okay? That's a reason the savings are important. But how do you define all of these terms? There are key terms here. One is savings. Second one is investment. One is savings and the second one is investment. And the third one is capital formation. How do you define all the three? Savings is that part of the income that you use for future consumption. I'll repeat the statement. How do you define savings? It is that part of the income that you will use for future consumption, that is called as savings. Correct? That is savings. Now come to the second one, investment. How do you define investment? It is the part of your total income. It is part of your total income that you will use for acquiring assets. Simple. How much of your total income you will use for acquiring assets? Acquiring asset means what? Capital. You will basically use this money out of your income either to purchase a machinery, either you will use it to set up a manufacturing facility, you will use it to invest in research and development, develop a patent, etc. So part of the income that is used for acquiring assets or acquiring capital, it is called as investment. Is everybody okay with the second terminology? Now what is this capital formation then? What is the meaning of capital formation? Capital formation simply means as a percentage of GDP. As a percentage of GDP, how much capital you have acquired for a specific time period. It is always given as a percentage of GDP. What does it actually mean? In that particular time period, let's say one financial year. In one financial year, how much capital the whole economy has acquired in addition to the existing capital. Sir, what is the meaning of it? Let me give you one example. Just a simple example. Imagine until now, all the value of the machineries put together in India, the value of all the machineries put together in India was 100 crore rupees. And in this particular financial year, the companies in India have purchased machinery worth 2 crore rupees. Can I simply say total capital is 102 crore? Yes or no? Total capital is 102 crore. But how much is the capital which was acquired in this financial year? The capital that was acquired in this financial year is only 2 crore. Is everybody okay with the idea of a capital formation? Done? What is the meaning of capital? What is the meaning of a capital formation? Meaning of investment and meaning of savings. The formula is very simple here. The gross capital formation rate, GCF. Gross capital formation rate is equal to the total investment done divided by GDP into 100. The total investment done divided by GDP into 100. This is basically the idea of a gross capital formation rate. Now, let's go forward. Within the gross capital formation rate, this is the important point. The gross capital formation will have two components. It will have two components. One is called as GFCF, gross fixed capital formation, and the second one is called as stocks. What is essentially the difference? Lot of you make a mistake here. Please have a look at it. GFCF stands for gross fixed capital formation. And a lot of you will basically say gross fixed capital formation means what? Right? University language. Investment in the fixed assets, you will say. Correct? Investments in the fixed assets. So when you invest in the fixed asset, you will calculate that. It is called as a GFCF, will say. No, that is not accurate. That is not entirely correct, by the way. Idea is very simple. When you want to manufacture, you will invest one in creating assets which are durable in nature. I repeat, understand. You will invest in assets which are durable in nature. And second, you will also keep on investing in procuring some more assets using which you will continue to manufacture goods and services. That is raw materials, inventories, unfinished goods, right? Inputs, intermediary goods, etc. So on one, you invest, this is durable. This can be used for 30 years, 40 years, 50 years, etc. And on the other side, you will also invest there. You will also invest there, but that is done on monthly basis. That is done on weekly basis. That is done maybe on day-to-day basis. That is called as a stock, and the first one is called as the gross fixed capital formation. Is everybody okay with the idea here? Please do let me know. Is everybody okay with the idea? All these are important points, by the way. Please remember all of these. Remember all of this. And when you say capital formation, when you say investment, do not assume that you will always invest in assets which are visible to you. Do not assume that you always invest in assets which are visible to you. No, there are other assets which are invisible, intangible to you. For example, let's say you invest in R&D and you get a patent. You get a patent, right? Don't you think it is an asset for you? You will use it for a very long duration. Yes, that is also counted in the GFCF. Right? That is also counted in the GFCF, but that is not visible. It is intangible asset. Done? Everybody is okay? So these are certain important points regarding the first chapter. Do let me know what are your doubts now. 1 hour is over. Next 5 minutes, I'll address the doubts. What are the doubts? Let me know now. GFCF, explain again, my dear. When you open a company, you will invest money to set up a manufacturing facility. Don't you think this manufacturing facility, you will use it for next 40 years? Simple? Sakshi Pandey. Right? This is question for you. And again, don't say, sir, you are targeting me, etc. I want the answer from you, by the way. Right? So you will invest in manufacturing facility. Will you not use the manufacturing facility for 50 years, 80 years? You will purchase a machine. Will you not use the machine for next 30 years? But on the other side, you will keep on investing money to purchase raw material, intermediary goods, etc. So when it is right recurring in nature, when your investment is recurring in nature, it is stock. When it is not recurring, it is durable in nature, that is called as gross fixed capital formation. Huh. Why do they count subsidy and minus it while calculating? My dear, please understand the logic. The question is from Lalita. My dear, please understand the logic. Logic is what? Formula is you start with the factor cost. You start with the factor cost. Now you add indirect taxes and you subtract subsidies. Why? If you want to derive a market price of a product, what if government of India has given subsidy? You'll have to reduce the market price. That cost price will become lower. The government will impose a GST. The price will increase. So that is the reason plus indirect taxes minus subsidies. And we write market prices. Now we want only the market prices. So what you do? You take these two now you want only the factor cost. What you do? You take these two components, transfer it on the other side. Transfer it on the other side. So what is left out? Factor cost, market price minus indirect taxes plus subsidies. Is the formula clear at least now? It is basically CSAT idea. Transfer these on the other side. The symbol will change. Okay. What is the difference between residents of India and citizens of India? Residence is generally focused on economic concept. That is, your economic interest lies in India. That's the reason you're called as a resident. Generally, if you reside in a particular country for a period of 1 year and above, you're called as a resident of a country. Whereas the citizen of a country is a constitutional concept. It is a constitutional construct. If a foreigner wants to become a resident, let them work in India for more than 1 year. They will be counted as a resident. But they are not counted as a citizen. For that, the process is completely different. Okay. Flow and stock concept. My dear, I'll cover that later. Don't worry. I'll cover that later also. Right? Basically, idea is simple. Okay, I'll cover that later. Don't worry. With certain examples, when I'm discussing working capital, I'll discuss that. Why corporate taxes accounted in personal income? My dear, please listen carefully. Please listen carefully. Personal income, what does it represent? First understand what does the personal income represent. It is the total part of national income which is received by the households. Now, who are the shareholders? Right? Shareholders are the owners. Don't you think the shareholders come from households only? Simple idea. Shareholders come from the households. So the shareholders will receive dividend. But even before they receive the dividend, corporate taxes will have to be deducted from the profits of the company. Right? You are missing a very important point here. What is the point you're missing? How do you calculate the NNP at factor cost for India? How do you calculate? You need to take the sum total of 4 factor incomes. Don't you think one of the factor incomes is profits generated by resident companies? You have counted the resident companies' profits. But will all the profits be taken by the residents of India? No. Some of it will go to the government, corporate taxes. Some of it will be kept with the company itself, undivided profit. And then what is given to the residents, that is counted as a part of personal income. Please understand the logic. Sir, in expenditure method, you wrote minus x plus m. Okay, what is the formula? What have I written? Let's check. Let's check it. What is the problem? I have written x minus m. Exports minus imports. What is the problem? Okay, here you are saying, okay, this should be minus imports plus exports. Correct. If you are saying here, it should be minus m plus x. I have written ulta symbol, right? Just correct it. Okay. Done? Everybody is okay? What we deduct? Please look at the formula again. Please download the PPT and look at the formula. It should be very simple by now, right? What is the difficulty in this? You tell me. First and foremost, you are not understanding how NNP is calculated. Simple. First, understand how NNP is calculated. Only then you can go to personal income. In the calculation of NNP, won't you calculate profits generated by resident companies? Won't you calculate it? Interest earned by the residents of India? Won't you calculate rent generated by Indian investors? So all of this should go to the personal income. But out of this, certain adjustments have to be done. All I can gather by looking at some of your questions, again, don't take it as a criticism, by the way. All I can gather is for some of you, the basics are not clear. If you still have doubts, please wait. Right? Let's not keep on repeating the same thing. At the end of the session, I'll explain again. Okay, let's start next chapter. Next chapter. Let's start with the next chapter now. Okay, inflation. Next chapter is inflation. Again, I'm saying, if you still have doubts, hold on. I'll address it at the end of the session. Okay. Next, inflation. Now, first and foremost, what is inflation? Inflation simply stands for the change in the price level for basket of commodities. The change in the price level for basket of commodities. That is, you take a basket. For WPI it is different as of now. CPI it is different as of now. So there is a basket of commodities or the items. You calculate what is the price of this in the last year, and compared to that, in this year the price level has increased by how much. That is given as inflation. That is given as inflation. So rise in the price level for basket of commodities is called as inflation. Now, there is one more definition. Inflation is also said to be a decrease in the purchasing power. A decrease in the purchasing power. Purchasing power of what? Purchasing power of your currency. Purchasing power of your currency. So when you basically take certain currency, let's say 100 rupees. Today, let's imagine the price of onion is 20 rupees per kg. So at 100 rupees, you'll be able to purchase 5 kgs. But because of inflation, let's assume the price goes up to 25 rupees. Now at the same price or at the same value of the currency, you will be able to purchase only 4 kgs. So the price has changed, as a result of which the purchasing power of your currency has decreased. Is this definition also clear to you? So it is also a situation where the purchasing power of the currency decreases. That is the definition of inflation. Now, in terms of classification, there are two types. And my recommendation, I'll keep on telling you this. My recommendation, focus more on the causes of inflation. A lot of you will spend simply unnecessary time in memorizing the first classification. That is basically on the rate of inflation. What is the meaning of rate of inflation? If the inflation rate is in a single digit, if the inflation rate is in a single digit, we use the term moderate rate of inflation. At moderate, and within that also there is a creeping rate of inflation. There is a jumping rate of inflation, etc. So whenever it is in a single digit number, we call it as a moderate. For example, in India, everybody is okay, right? It is a moderate rate of inflation, galloping rate of inflation. Whenever the inflation rate enters into a double digit number, triple digit number, that is called as a galloping rate of inflation. And whenever the inflation rate is very, very high, uncontrolled. Sir, any number, any example? For example, Venezuela, it experienced 80,000% inflation rate. Zimbabwe experienced 2.7 lakh percentage rate of inflation. So whenever the inflation rate is uncontrolled, very, very high rate of inflation, that is called as hyperinflation. Now just understand this and go forward. Nothing more important here. Just numbers are there. What is more important is on the causes. How inflation will happen based on the causes, that is more important. Now there are two types under based on the causes. One is called as a demand pull inflation, and the other one is called as a cost push inflation. One is called as a demand pull. Don't worry, I'll magnify this before you simply say, sir, it is not visible. One is a cost push inflation and the other one is a demand pull inflation. What is the essential meaning? There are two sides in the market. One side is the demand side in the market and the other one is supply side in the market. Correct? One is the demand side and the other one is the supply side. Two sides, buyer and seller. whenever the market prices of the basket of items increases because of the supply side factor. I repeat, because of the supply side factor, that is called as a cost push inflation. Is the definition clear to all of you? Listen carefully right now. Whenever the prices of the commodities of the basket goes up because of the supply side factors, that is called as a cost push. And whenever the prices in the market for the basket goes up because of the demand side factors, it is called as a demand pull inflation. Right? So cost push, demand pull. But at the end of the day, basic idea is simple. For a particular basket of items, the prices goes up, and that is called as inflation. Is it okay? Is it clear for all of you? Cost push and demand pull. Now, what are the examples? What are the examples? How can there be a demand pull? How can there be a cost push? I'll just give you a couple of examples. Listen to me carefully. For example, let's say the government increases the GST rate. Will this increase the market price of the items in the basket? If the market price of the items in the basket increases, the basket should also become costlier. Simple, that will cause inflation. What if the cost of raw material goes up? Cost of raw material goes up. When the cost of raw material goes up, the basket becomes costlier. And when the basket becomes costlier, causes inflation. What if, right, the manufacturer is taking a loan? Manufacturer is taking a loan. On the loan, the rate of interest paid by the manufacturer goes up. Automatically, the cost of production goes up and the basket prices will also go up. And have a look at this. Supply shock. Supply shock. What is the idea of a supply shock? Sudden disruption. Simple. Sudden disruption. Sir, example. In India, especially in agriculture sector, have you seen suddenly there is a disruption in the production and supply of these agriculture commodities? Correct? Suddenly there is a disruption in the production and supply of agriculture commodities. It could be, for example, onion that we have experienced multiple times. It could be because of, right, let's say excess rainfall in certain states. Suddenly, right, there is a disruption. Onion prices increase and the market price will also start to increase. And what about other commodities? It can be the same for other commodities as well. So sudden disruption will cause a supply shock and that will increase the market price of commodities and that will increase the basket price, causing inflation. Is everybody okay? Please do let me know. Is everybody okay? All of you okay? These are some of the examples. So only these can be examples? No, these are some of the examples. But in the examination, you simply need to find out, is it a supply side factor that is causing inflation? Or is it a demand side factor which is causing inflation? Simply understand that and accordingly you decide. Correct? Everybody is okay? Accordingly you people decide. For example, let's say there can be hoarding activity. Hoarding activity. What is hoarding? Where basically the suppliers or the middlemen, right? Basically the suppliers or middlemen will form a group like this. The middleman will store unnecessarily more than what is allowed. I repeat, will store more than what is allowed by the government. Government will allow you to store 100 kg of onion. You will not store 100. You will store 200 kgs. And when you store more than what is allowed under the law, there is artificial scarcity that is created. And because there's the artificial shortage created, market prices increase. Now you will sell this in the market at higher price. This is essentially hoarding activity. Simple. This is essentially hoarding activity. And is there any law in India to address hoarding? Yes. Please remember Essential Commodities Act. Right? Essential Commodities Act. ECA 1955. Done. In fact, there is also one more. Prevention of black marketing of essential commodities. Right? There are laws which want to prohibit this particular practice of the hoarding. Then there is also possibility of cartelization. There's also a possibility of cartelization. What is cartelization? The producers coming together to form a group and controlling the supply. Simple. producers coming together to form a group to control the supply. And what they do is they will control the supply, reduce the supply. The moment they reduce the supply, automatically the market price will start to increase. In India, you do not find a cartel. If there is a cartel, the Competition Commission of India will take action against it. You don't find a cartel in India. But outside India, best example for that is OPEC example. OPEC, the major countries which are producing oil and exporting this particular oil in the global market. The OPEC group of countries is a prime example of a cartel in the global market. Is everybody okay on the supply side here? Please do let me know. Is everybody okay on the supply side? How supply side factors can contribute to inflation in the domestic market? Can I shift to the demand side now? Can we shift to the demand side? Okay, let's shift to the demand side. How demand side factors can contribute to inflation? Let's understand that also. What if all of us are earning higher incomes? Simple. What if all of us are earning higher incomes? The growth in the economy is very high. All of us start to earn very high amount of income. Now, don't you think that will contribute to aggregate demand increasing very fast? The total demand for the goods and services, effective demand for the goods and services will increase very fast. And when the demand increases and the supply cannot match the demand, it will contribute to a demand pull inflation. It will contribute to a demand pull inflation. And that is the reason, let me add one more point here. You will come across the term called as a recession. You will come across term called as a boom, pro-cyclical, counter-cyclical, etc. What is the basic idea? If I represent the economy movement in this way, if I represent the movement of economy in this way, that is GDP movement, lot of you assume that GDP will always, if you plot along the x-axis and y-axis, a lot of you assume the GDP will always move in a vertical 45 degree like this. No, GDP doesn't move. GDP doesn't move like that. Why? Every now and then, there is either an external factor or an internal factor which will basically have an impact on GDP, drag it down, again it will increase, again drag it down, again it will increase, again drag it down. That is the reason generally you will see this kind of a movement, that is in the sine wave form. Is it okay? In the sine wave form. Essentially the idea here is, at this particular point, if you look at this particular graph, this is called as a boom phase. Is everybody okay? This is called as a boom phase, boom or growth. Right? That is called as a boom phase. Then there is a slowdown. Then there is a slowdown in the economy. Then there is a recession in the economy. And then there is a recovery in the economy. These are the 4 stages. These are the 4 stages. Is everybody okay? Please do let me know. These are the 4 stages. Boom, right? Then there's a slowdown. Then there's a recession. Then there is a recovery. These are the 4 stages in the economic cycle. And that is the basic idea. You need to connect it to, let's say, inflation. When there is boom happening, when there is boom or growth happening in the economy, government should not reduce the income tax rates. Government should not increase overall expenditure. Reason being, there is already a sufficient demand in the market. There is already a sufficient investment in the market. Rather, the government should follow a policy which is essentially control its expenditure, collect more and more taxes from the people, so that this will not cause a demand pull inflation. This is not going to cause a demand pull inflation. Is everybody able to understand the logic here? Please do let me know. Is everybody able to understand? So idea is very simple. If there is very high growth in the economy, people have lot of disposable income. People will purchase lot of goods and services that will contribute to inflation. Government should simply follow a system here, collect more taxes, control its expenditure. If they don't do it, it will cause inflation. It will cause inflation. And some of you will say, sir, only government of India is responsible. Not necessarily. What if RBI, if there is already a boom in the economy, you and me have lot of money, we are purchasing lot of goods and services. What if RBI reduces the interest rate at that point of time? RBI increases money supply in the market at that point of time, don't you think this will also add to already existing higher demand in the market? Correct? Everybody is able to understand. It will contribute to higher demand for the goods and services in the market, and that can essentially lead to a demand pull inflation. Is everybody okay with the discussion? Please do let me know. And finally, one more factor here, inflation expectation. Meaning what? You are expecting prices of the commodities to increase in the next week or in the next month. You're expecting that. Why? You have read newspaper. There is a excess rainfall in Maharashtra. You know what is going to the impact now. Unseasonal excess rainfall in Maharashtra means a major onion producing state, that the production of onion would be disrupted, supply would be disrupted. Now you have already made up your mind. Next week the price of the onion is going to increase. You are speculating. You're expecting the market to behave in a certain way. Now, you will not wait for the market to behave. Right now, you will go to the market, purchase more and more commodities. Either you will purchase more and more, or you will purchase lesser and lesser. It all depends on what is your speculation. What is your sixth sense, basically making sense of all the information that you have right now. Everybody is okay, but if you purchase more and more, demand increases. If the demand increases, it will contribute to inflation. So demand pull inflation. The demand moves upwards and that will pull the inflation rate upwards. Is everybody okay? Please do let me know. Somebody else was saying, sir, can you explain the third one? In fact, I started with the third point itself. If the government of India will increase the GST rate, market price of the product increases. Simple. Market price of the basket of commodities will increase. When the market prices will increase, essentially it will contribute to inflationary trend. Is everybody okay with the demand pull inflation and cost push inflation now? Do let me know. Focus more on this. Trust me when I say this, focus more on this. UPSC has a habit of asking questions from this idea. Idea is important. Do not assume exactly the same statements will be given. Idea of what can be a demand pull, what can be a cost push. That is where UPSC will test you. Okay, so let's go back to the earlier mind map here. I've taken care of the definition of inflation. I've taken care of classification of inflation. The classification of inflation. Now, the measurement of inflation. Right? Measurement of inflation. How do we measure inflation? There are two indicators right now. One is a WPI, second one is CPI. WPI stands for Wholesale Price Index and the CPI stands for Consumer Price Index. Wholesale Price Index, Consumer Price Index. What is the basic idea? In the Wholesale Price Index, we take a basket of 697 items. 697 items. And what is the price change of the 697 items in the market, that is in the wholesale market? All of you understand the meaning of a wholesale market, where buying and selling of commodities or the items will happen in large quantities. In large quantities. One is the wholesale market and the other one is the retail market. Me and you, we purchase in the retail market. We purchase individual units, very small quantities. Whereas the companies, the traders, etc., they purchase in the wholesale market. So you take a basket of 697 items and you measure the change in the price of these 697 items in the wholesale market, and that is called as Wholesale Price Index. Now, another very important point to note right now is that in the WPI basket, there are no services. I repeat, in the WPI basket, there are no services right now. Earlier, the services, right, in the other side, that is in the CPI, services are there, right? The goods are there, services are there. But in the WPI basket, right now, only goods are there. But let's, right, I hope you understand, let's assume that nothing will change by the time you write the exam, because already there's a committee which has been set up. Recommendations are yet to be provided. let's assume it is not going to change by the time you write the exams. Everybody is okay? That is called as WPI. Who will publish it? It is published by Economic Advisor. For every month we calculate, right, the WPI that is published by Economic Advisor. Some of you are asking, are the taxes excluded or included? These are excluded. The taxes are generally excluded. Whereas in CPI, the taxes are included. Is it okay? Can we go forward now? WPI is clear to all of you. Next, CPI, Consumer Price Index. It measures the change in the price of the basket of items, goods plus services. Measures the change in the basket price of the goods plus services and in the retail market. In the retail market, not in the wholesale, but in the retail market. Until now, the base year for the CPI was 2011 and 12. Now the base year for the CPI has been changed very recently, 2024. Base year right now is 2024. Please remember that. In addition to this, there are other points also. Please have a look at all these particular points. The base year is 2024. The basket now has 358 items. Your books will say 299. Nothing wrong, but it is old base, right? The base year has been changed last week. So please make all of these updates. So the basket will have 358 items. 308 are goods, 50 are services. Food and beverages will have a weightage of around 37%. The core inflation will have a weightage of 58%. Until now, rural housing, that is a rent in the rural market, until now, the compilation was not done. That is, the data was not collected. Now, the data is being collected. These are certain very important updates. Please make a note of it. Download the PPT. Use it for revision. Apart from this, what are the other important points? The Household Consumption Expenditure Survey, HCES. The Household Consumption Expenditure Survey, HCES for 23 and 24. This data has been used by the NSO to prepare this new basket. What is the meaning of it? In the Household Consumption Expenditure Survey, we basically measure per capita, per person. Per person, monthly, how much is the expenditure? I'll repeat the statement. Monthly, how much is the expenditure on food items as well as non-food items? That is measured in the Household Consumption Expenditure Survey. So that data has been used by the NSO to make the new basket. And that is exactly the reason why you will see the weightage for the food items has been reduced. Is everybody okay? The weightage for food items has been reduced now because the logic is simple. Over a period of time, the amounts of incomes generated by the households will increase. The incomes of the households will increase. But as a percentage of the total income, you will spend lesser and lesser as your income increases. Is everybody okay with this idea? Please do let me know. There should be a logic to all of this. Sir, why has the food expenditure or the weightage for the food has been reduced under the CPI? This is the logic behind it. Right? You are spending more money. Absolute expenditure, it has increased. Nobody is doubting that. But as a percentage of your total expenditure or the total income, that expenditure on a food item will keep on reducing percentage. And that is basically the application of Angel's Law. Remember, this can be asked in the UPSC Prelims this year. Angel's Law. It says the same thing. Right? That is, as the incomes of the households keep on increasing, the expenditure on essentials, they will use the term essentials. We are talking about food. Food is an essential, by the way. Okay? Food is an essential. So what does it essentially say? As the incomes of the house increases, the absolute expenditure on essentials increase. But percentage expenditure decreases. Is it okay? Right? Everybody is able to understand. Absolute expenditure increases, but as a percentage, it will keep on reducing. That is Angel's application. Angel's Law's application. Done? Everybody is okay? So apart from this, couple of more important changes. The movement of prices in e-commerce platform. This is also very important. Please make a note of it. On weekly basis, we are going to collect the movement of prices on the e-commerce websites as well now. Because earlier we did not take this into account. But right now, compared to a decade ago, the practice of the households to purchase from the e-commerce websites has increased. So you will take the data into consideration. You will take this also into consideration. Right, apart from this, rural rent, the house rent in rural area, online media consumption, expenditure on streaming services, international airfare, modern energy sources, etc. All are the new items which have been added to the basket. And these are certain important changes in the context of consumer price index. Is everybody okay? Please do let me know. Somebody was asking who will publish the household consumption expenditure survey. NSSO? Yes, it is NSSO. NSSO will publish HCES. But NSO uses the data to frame or to create a basket. That's it. Okay, everybody is okay? So far everything is clear? Definition, classification, as well as the types or measures of inflation. Right? Types or measures of inflation. Now let's go forward. What are the other important concepts or the points associated with inflation? What is the impact of inflation? What is impact? If there is inflation, what is the impact? One, it will reduce the purchasing power. Simple. Already we have seen that. With more and more inflation, the purchasing power of the money that you're holding will keep on decreasing. Very simple. With the same amount of money, now you will be able to purchase lesser and lesser basket of goods. Second, it will also have an impact on investment. Lot of foreign investors don't like high inflation rate, because if the inflation rate is higher, their absolute earnings, that is after adjusting for inflation, will become lower. You as a household, you are not happy with it, because with the higher inflation rate, you will also be tempted to invest more and more in gold. So not just the foreign investor, even you as an investor, your returns will be affected. You want to adjust for this particular change in the inflation rate by basically shifting your investments. Rather than investing in bank deposit, you might invest in, let's say, share market now. Rather than investing in share market, you can shift your investments into physical assets such as gold now. That is what is happening. The demand for gold is actually increasing because of higher rate of inflation. Everybody is okay? Right? So it will also have an impact on imports as well as exports, because the logic says any country which has a higher inflation rate. I repeat, any country which has a higher inflation rate, their exports in the international market will become less competitive. Simple idea. Their exports in the international market will become less and less competitive. Imports will become cheaper because the domestic currency now will end up purchasing more of the imports compared to the domestically produced good. So that's a reason the international trade, exports and imports will also be affected whenever there is very high rate of inflation. But please understand, is inflation necessarily a bad thing? No. Inflation necessarily is not a bad thing. What is required is a healthy rate of inflation. Underline the term. What is required is a healthy rate of inflation. Healthy rate means what? In case of India, the inflation rate that RBI is supposed to maintain is how much? 4%. Inflation rate that RBI is supposed to maintain is how much? 4%. Right? Now, if inflation is around 4%, RBI is not worried. Even the government is not worried. Reason being, please remember this, inflation, whenever it is there, it is also representing that there is sufficient demand for goods and services. Is the point clear? It also represents the fact that there is some demand for the goods and services. Because imagine, inflation is not there, rather deflation is there in the market. That is, the price levels are falling. The price levels are contracting. In that particular case, what will happen? The demand will be postponed by a lot of people. You and me will simply say, let's wait for 3 more months. Let's wait for 6 more months. Let's wait for 1 more week. Why? The prices might further fall down. I will purchase it when the prices will fall down. That could be, right, one of the outcomes. So argument is very simple. Inflation represents a sufficient demand, a certain amount of demand in the market. And inflation is always generally associated with GDP. It is associated with GDP. That is, with the rise in the GDP, we also expect a certain rate of inflation to be there in the market. So that's a reason inflation is not necessarily an evil. It's not necessarily an evil. It represents certain positive factors or positive events that are taking place in the economy. But when the inflation goes beyond control, for example, in India, if inflation will hit 8%, 9%, 10%, 12%, that is not good for the Indian economy. Never good for Indian economy. That's the reason our target is basically 4% inflation rate. Everybody is okay, right? Now, in this particular context, let me add one more idea. Monetary Policy Framework Agreement, MPFA. Monetary Policy Framework Agreement, or else you will come across this term as inflation targeting. Inflation targeting. Is it okay? Inflation targeting. What is the basic idea of inflation targeting or monetary policy framework agreement? This was an agreement that was signed between the government and Reserve Bank of India. Is the point one clear to all of you? This was an agreement between the government as well as the Reserve Bank of India. Which year? It was signed back in the year 2015. And this agreement has come into force from 2016. According to the agreement, according to this particular agreement, the government of India, after consulting RBI, after holding consultations with RBI, will announce an inflation target that RBI is supposed to meet. I repeat the statement. The government will hold consultation with RBI and then announce what is the inflation target for RBI. And this is decided once every 5 years. It is decided once every 5 years. First round was decided and implemented from 2016 to 2021. Second round was implemented from 2021 to 2026. And I hope all of you remember what is the year this time, or you are in which year. I know all of you are busy with UPSC preparation, and I hope all of you have not forgotten what is the year you are in. It is 2026, which means obviously now you can expect RBI to announce the third round of 5 year of inflation targeting. Correct? Very soon it will be announced. Right? Be ready for that. Third round, that is the 5 year third round of inflation targeting will be announced anytime soon. Let's assume they will continue the same. Let's assume they will continue the same. 99.9999, right, infinite, with the bar on the last 9. They will continue with the same inflation target, that is 4%, which is used right now and which was used for the first round as well. 4% headline CPI. 4% headline CPI. Everybody is okay? Headline CPI of 4%. Right? So this was used earlier for 16 to 21. Same for 21 to 26. But please understand, there is certain flexibility that is provided for RBI. Flexibility. What kind of flexibility? It is not exactly 4%. That is flexibility wise. Along with 4%, RBI is given a freedom of 200 basis points. 200 basis points on either side. That is, RBI can allow the inflation to reach maximum 6% and minimum 2%. That is basically a ceiling and the floor level. Ceiling and floor level of 6 and 2%. Is everybody okay with the discussion so far? So RBI has to meet the inflation target. And what if RBI doesn't meet the inflation target? If RBI doesn't meet the inflation target for 3 consecutive quarters, I repeat, 3 consecutive quarters, then RBI has to give a written explanation to Government of India. Has it ever happened after the implementation of inflation targeting? Once it has happened. Once it has happened during pandemic. During pandemic, the inflation rate, right, for 3 consecutive months, from January to September, October, for that particular point, essentially the inflation rate was more than 6%. So then the Reserve Bank of India gave a written explanation to Government of India. And once the explanation is given, is it mandatory for the government to basically put it in the public domain, right? Give it to you or show it to you? Absolutely no. Right? It is entirely the prerogative of the Government of India to decide whether that explanation should be made public or should be kept as a secret. Entirely the prerogative of the government. And one more very important point under MPFA is the Monetary Policy Committee, MPC. The Monetary Policy Committee. The Monetary Policy Committee that we are following right now is basically having a composition of 6 members, which is having 3 members from Reserve Bank of India, 3 are from Reserve Bank of India, and the remaining 3 are the experts who are appointed by the Government of India. Is the point clear? 3 are members, that is the RBI members, right? Obviously, the Reserve Bank of India governor is a part of it, and the remaining 3 are the experts who are appointed by Government of India. Please remember all of these particular points. Remember all of the points. Done? And the decision essentially is taken with majority. The decision of the MPC is taken with the majority, and they follow a policy called as bi-monthly monetary policy review. Bi-monthly monetary policy review. Bi-monthly means the Monetary Policy Committee will meet once every 2 months. The Monetary Policy Committee will meet once every 2 months. Is everybody okay? Please do let me know. Everybody is okay with the discussion, right? So these are certain important points in the context of inflation targeting. Now, next, right, I'm going through the, right, let's say sequence like this. I'm going through sequence, okay? Next is Phillips curve. What does the Phillips curve represent? What is the meaning of the Phillips curve? Phillips curve will give you an inverse relation, I repeat, an inverse relationship between unemployment rate and inflation rate. Phillips curve, it will provide you an inverse relationship between unemployment rate and inflation rate. What is the meaning of it? If the inflation rate is higher, unemployment rate would be lower. If the inflation rate is lower, unemployment rate will be higher. Why? What is the connection? Let's start. If the inflation rate is higher, don't you think the demand for goods and services will be higher? If the demand for goods and services is higher, production will be higher. If production is higher, the companies will be hiring more and more employees. Unemployment rate will be lower. Correct? Unemployment rate will be lower. Is everybody able to understand? So inflation is higher, unemployment rate is lower. And on the other side, if inflation rate is lower, it represents absence of demand or very less demand. Why will you keep the same number of employees if demand is not there or very less in the market? Automatically what you do is you will reduce production. And when you reduce the production, supply also goes down. You will be able to meet the demand, but now you do not require same number of employees. You do not require same number of employees. You will remove some of the employees, unemployment increases. So when the inflation is going down, unemployment rate is going up. When the inflation rate is going up, unemployment rate is going down. Inverse relation. Inverse relation. Is everybody okay? That is Phillips curve representation. Next, concept of GDP deflator. Concept of GDP deflator. Now listen to me very carefully. GDP deflator is one more type of inflation measurement. I'll repeat the statement. GDP deflator important because I know a lot of you will focus only on CPI and WPI. I know that. You'll always focus only on CPI and WPI. But please understand, either CPI or WPI, it doesn't give you the inflation for whole of the economy. That is because they follow a basket approach. Both of them follow a basket approach. The WPI has 697 goods, not even services. In India, more than 55% of the contribution to GDP comes from services. In CPI, we have 350 plus goods and services, but it is only 350. The number of goods and services produced in India is much, much larger. So when you compare both of them, yes, right, the CPI is mainly used as a the anchor. For monetary policy, CPI used as an anchor. But please understand, better than the WPI and CPI, there is one more indicator, GDP deflator. It is a GDP deflator which represents the inflation for the whole of the economy. What do you mean by whole of the economy? The formula for GDP deflator is simple. It is the nominal GDP divided by real GDP. Nominal GDP as well as divided by real GDP, right? This is basically going to give you the GDP deflator. And what is the nominal GDP? Nominal GDP represents what is the GDP calculated at prevailing prices. What is the GDP at prevailing prices? Meaning, if you calculate GDP for 2026, will you not take what is the current market price? Simple. What is the current market price? And if you calculate GDP for 2025, you will take what was the right market price of that product in 2025. So whatever is the prevailing price, that is the current market price in that year, you simply take and calculate GDP, that is called as nominal GDP. Whereas the real GDP, it basically focuses on calculating GDP but by using base year prices. Base year prices. For example, in the context of the GDP calculation right now, in the context of the GDP calculation, all of you remember the base year for the GDP calculation is what? 2011 and 12. Now, what was the price of the products in the year 2011 and 12? That price is taken, the production of this year is taken. Simple. The production done in this year into the current market price will give you nominal GDP. The production in this year into the base year prices will give you the real GDP. Is everybody able to understand the difference between a nominal and a real? Please do let me know. Everybody is able to understand the difference between a nominal and a real. And these are also referred to in a different way. They will say GDP at current market prices. That is nominal GDP. GDP at base year prices, that is the real GDP. So now you tell me, if you take I'll just write the formula again. If you simply take the current market price and you are comparing that with the base year price, don't you think the change in the price represents inflation? Yes or no? The change in the price, that is, let's imagine a product in the base year, the price was 10 rupee. Today, that is in the year 2026, the price, current market price is 18 rupees. Can I simply say, assuming one product, but in reality it is complicated. You'll also understand it. In reality, there are too many products, that is goods and services. Let's simplify it. So imagine the product in 2011 and 12, the cost was 10 rupee. Today it is 18 rupee. Can I simply say the rise in the price is nothing but inflation? So when you calculate nominal GDP and compare that with the real GDP, the change in the prices here represent change in the, the change in the price levels here basically represent inflation. Is everybody able to understand at least now? That's the reason, I'll repeat this again. CPI and WPI, yes, they are inflation. They represent inflation. But is there any other indicator which is a much better indicator of inflation? It is GDP deflator. It is a GDP deflator. Why I'm saying much better? Because in the GDP deflator, you're not having a basket. You're essentially covering all the final goods and services. You're essentially covering all the final goods and services. That's the reason that is a much better indicator of inflation. Right? So GDP deflator is also referred to as implicit price deflator. Implicit price deflator. Done? Everybody is okay with the GDP deflator? Can we go forward now? Can we go forward? Couple of more pointers in the context of inflation. One is disinflation. Right? One is disinflation. What do you mean by disinflation? Whenever inflation rate goes on reducing. Whenever the inflation rate keeps on reducing, that is called as disinflation. Is everybody okay? Inflation rate reduces. Meaning what? Let me give you one example. I'll write it here only. Imagine price levels change like this. 100 to 110. From 110 to let's say 130 rupees. From 130 rupees, let's say, right, 118 rupees. From 118 rupees, let's say, to 90 rupees. Simple question to all of you. Can I simply say from here to here, there is a rise in the price level, inflation. Correct? From here to here, there is a rise in the price level, inflation. From here to here, that is if you drop down vertically like this, the price levels are not increasing, rather decreasing. This is deflation. This is a deflation. But now there is disinflation. Sir, what do you mean by disinflation? Let me give you one more example on the right side now. Let me give you one more example. Imagine the price level was 100. It increased to 120. From 120, it increased to 130. From 130, it increased to 135. Now, very simple question to all of you. Does this sequence represent inflation? Correct? Is this sequence, I'm talking about the right side now, not on the left side. Go to the right side, exactly above my head. If you're wondering, sir, which one are you talking? You have written two sequences here. Look at the one that I've written on the top of my head. Okay. So here, the price levels are increasing, which means inflation. But if you calculate inflation rate, can I simply say inflation rate is decreasing? Is everybody okay? Inflation rate is decreasing. That is from 100 to 120, you will get 20%. From 120 to 130, you will get 9%. From 130 to 135, you will hardly get 4%. So inflation is there, but the inflation rate is slowing down. That is called as disinflation. Is it okay? That is called as disinflation. So deflation, price levels will reduce. Price levels will fall down. Disinflation, price levels will increase, but inflation rate is slowing down. Is everybody okay? Very often in the context of India, you will come across the disinflation as well as the deflation. For example, let me see how many of you have read the newspapers correctly. In the last 1 year, have you seen deflation in the context of agriculture commodities? Do let me know. Have you seen a deflation in the context of agriculture commodities? Yes, it has happened. Agriculture commodities prices have gone into negative territory. They've gone into negative territory. It has happened, by the way. Whereas the core inflation was experiencing more of a disinflation trend. Is everybody okay? So, you have seen both of them happening in India in recent times. But of course, the focus is different. Core inflation is different, right? The food inflation is different, etc., etc. Done? So, disinflation, deflation. What is stagflation? Stagflation is a situation wherein you see that inflation rate is high, unemployment rate is also higher, growth has stagnated. Is it okay? Everybody is okay? I'll repeat it again. What is right? The basic idea of a stagflation, you're seeing growth has stagnated. GDP is not changing by much. Inflation rate is high and the unemployment rate is also high. This particular situation where inflation, unemployment rate is higher, GDP has stagnated is called as stagflation. Everybody is okay? And this is an exception, by the way. Exception in the sense, what does the Phillips curve say? The Phillips curve basically says there is an inverse relationship. If inflation is high, unemployment rate should be lower. But in stagflation, what you're saying? Both have increased. Inflation is also high, unemployment rate is also high. Right? That is basically an exception to Phillips curve. Stagflation. Next, open and suppressed inflation. Open and suppressed inflation. What do you mean by open and suppressed inflation? Whenever, understand this, whenever the basket which has items, the prices of the basket is determined by the market forces. I'll repeat the statement here. whenever the price of the basket is determined the market forces, no intervention of the government whatsoever. No intervention of the government whatsoever. That is called as open inflation. Is everybody okay? That is referred to as open inflation. But whenever the government will intervene, obviously, to reduce the price levels. All of you will agree, right? Have you ever seen government intervening in the market to increase the prices? Government wants you people to pay more for this particular basket? No. Government essentially will intervene to bring down the prices. So whenever the government will intervene to drag down the prices like this, it is called as suppressed inflation. It is called as suppressed inflation. Is everybody okay with the idea for open and suppressed inflation? So any example in India, my dear, the government of India will sell lot of these commodities at subsidized prices? Yes or no? The government of India will supply lot of these commodities at subsidized prices. Government will sell Bharat pulses. Government has sold, right, the onion at the subsidized prices. Government has sold tomatoes at subsidized prices. Government will conduct open market sales scheme, etc. Right? All of these is influencing the basket prices. Simple. All of these influence the basket prices. That is essentially the idea of a suppressed inflation. Is everybody okay? Please do let me know. Right? These are the different, right, let's say concepts associated with inflation. Now there is one more idea. Headline and core. Headline and core. Headline inflation versus core inflation. What is basically the idea? Headline inflation means you're taking the complete basket. I repeat, you're taking the complete basket, and for the complete basket, you're measuring inflation. Is the point clear to all of you? Do let me know. Simple. You're taking the complete basket, the goods, services, whatever the basket has. You take the complete basket and then you measure the change in the prices of the commodity. That is called as headline inflation. But the problem with headline inflation is there are certain commodities whose prices are unstable. There are certain commodities whose prices are unstable, whose prices are volatile in nature, whose prices are short-lived, whose prices are short-lived. They can use any one of the three terms. Any one of the three terms. So example, food and fuel. Food and fuel. The prices of food and fuel are short-lived, very volatile in nature. In such cases, we exclude these commodities and we calculate the price change for the remaining basket. Is it okay? Right? In such cases, because the prices are very volatile in nature, unstable in nature, we remove these particular the commodities from the basket, and we measure what is the price level for the remaining commodities the items in the basket. And that is called as core inflation. That is called as core inflation. Right now, for policy making, that is for Reserve Bank of India, which is the indicator? Is it headline or core CPI? It is the headline CPI. Right? They will call this as anchor. Anchor for policy making. What is used as an anchor for policy making by the Monetary Policy Committee? It is the headline CPI. Headline CPI, not core CPI. Although there is a debate, but headline CPI is the right anchor used right now. Then everybody is okay? And everybody is okay. So this is the discussion in the context of inflation. Now, before I take a short break, if any of you have certain doubts, do let me know. I'll address your doubts and then we can take a break. Any doubts? GDP data, GDP deflator data is published. Yes, GDP deflator data is published, but that is done once in a quarter. That is done once in a quarter by whom? Again, same, MOSPI. Okay. Sir, for the GDP, the inflation is calculated based on the WPI here or GDP deflator? For GDP, inflation is calculated. My dear, what is the question? For GDP, the inflation is calculated based on WPI here or GDP? I am not able to understand the question, by the way. Please clarify what is the question. Skewflation means uneven inflation rate. Uneven inflation rate. Uneven inflation rate. That is called as skewflation. That is, you take a basket. For some commodities, there is very high rate of inflation. Prices have increased by a lot. For some, prices have decreased. For some, prices have not changed at all. So uneven price changes in the basket, that is called as skewed inflation. Imported inflation, right? Essentially, because of the imports, whenever inflation is caused, because of inflation, whenever it is caused, sorry, because of imports, when inflation is caused, that is called as imported inflation. For example, crude oil prices becoming costlier. Crude oil prices becoming costlier. You import it, it will cause inflation in India. Rupee depreciating, that will also cause inflation in India. Okay. Base effect. Whenever the base means, let's say you are comparing this year's GDP or inflation with the previous year. In the previous year, if the GDP number was right very high or very low, right, that will have an impact on GDP growth of this year. Inflation of last year, if it was very high or very low, it will basically have an impact on inflation of this year. That is called as, right, the base effect. When government sold tomato at subsidized price, my dear, I hope you have gone through all of this. That is, I think last year only, when the tomato prices hit 240 rupees, 250 rupees. Have you not seen government of India through various agencies selling the tomato at subsidized prices? It was done last year only. Right? 24 and 25, the financial year, by the way. Any cause for stagflation? Supply and demand side factors. Supply and demand side factors. Essentially, that is the idea. On the supply side, the crude oil prices suddenly shoot up. Crude oil prices suddenly shoot up. Right? So prices have increased, but let's say there is a recession in the market. Demand is not there sufficient. So unemployment is already higher. So when the prices are very high, unemployment rate is also very high. Right? In fact, in 1970s, because of the crude oil prices only, stagflation has taken place in multiple countries. Uh, Bottleneck inflation, I've already explained it. Because of infrastructure, because of certain structural problems of the economy, there will be inflation. Okay, done. For real GDP, do we use a WPI in order to adjust for inflation or GDP deflator? Generally, we use a WPI as a GDP deflator in India, because the GDP deflator is generally calculated once every quarter, published once every quarter. There is a lag. So for right day-to-day usage, generally they use WPI as a GDP deflator. So trade deal can cause supply side inflation. How, you tell me, right? What is the thought process? I don't know. How, you tell me? Can it lead to, right? Let's say inflation can be, but again, what is the exact thought? You tell me. Is there any chances if any country's inflation is high, then other countries increase or decrease tariffs to that country? Again, tariff is not associated with the inflation rate. Tariff policy is their foreign trade policy. Okay, done. Let's do one thing. Let's take a break now. 15 minutes break. 15, 1 5. 15 minutes break. Time is 6 8. Right? So we will restart the session at 6:23. Okay, 6:24. We'll restart the session at 6:24 p.m. Please rejoin at 6:24. Okay, welcome back. Am I audible and visible for all of you? Those present, please do let me know in the session. Am I audible and visible? Please do let me know. Now you should be fine. You have taken a break. You've had a cup of tea, coffee, biscuit, samosa, whatever you wanted to have, you have already eaten. You should be awake now. You should be active. Still a long way to go today. Okay. Okay. Now, before I start, a lot of you have raised a concern regarding the PPT. Please understand, you will be able to download the PPT with annotation. Right, there are one or two corrections that I need to make. I will provide that with the correction itself. With the correction, don't worry. Before I go forward, I believe a lot of you have joined late after I started. So whatever topics we are discussing today on that, MCQs, PYQs, etc., I'm taking two special classes. One tomorrow, 18th of February 2026 at 7 p.m. And the second one will be on 19th February 2026, that is same at 7 p.m. So tomorrow as well as day after tomorrow. This is the QR code of both of the special classes, two special classes. Scan the QR code, join the session, hit the button, enroll me. Please hit the button, enroll me. Okay, done. So tomorrow we will have a discussion on MCQs, PYQs on these particular topics. Today let's revise. And I know a lot of you are worried about notes. Have patience. Like I said, have patience. Focus on the discussion. It's my promise you will get the notes of topics that I'm discussing. Have patience, just wait for some time. Let me complete the topics in the Telegram channel, the PPT with annotation, without annotation, and the handouts. The notes will be made available to you. Download it, but please come prepared tomorrow for the MCQ discussion. Okay, let's go forward. So the next topic I want to discuss, we are done with national income aggregates. We are done with the inflation. Let's go forward now. Next topic that I want to discuss is the idea for budgeting, fiscal policy now. Fiscal policy. Let's start. There are two aspects in the fiscal policy. One is the expenditure part of it, and the second one is the taxation part of it. Let me start with the expenditure, then we will take up the taxation part. So in the fiscal policy, the first aspect, important aspect is budgeting. The government of India annually, I repeat, the government of India annually presents the union budget. Be focused on the union budget, by the way. So union budget is presented. In the union budget, there are multiple documents which are presented on the floor of the parliament, and these are passed by the parliament, approved by the president, given the assent by the president. For example, there is appropriation bill. All of you heard of this? There is appropriation bill. What does the appropriation bill have? The appropriation bill contains the details of the money that the government of India will withdraw from the consolidated fund of India. From the consolidated fund of India, the government has to withdraw money for expenditure purposes. It could be for infrastructure, it could be for welfare, etc. Now, essentially, you need to take the permission of the parliament before you withdraw the money. That is what the Constitution of India provision says. So, appropriation bill is there. Then there is a finance bill, which will provide you the details, of all the incomes that the government will be generating in the next financial year. So in the next financial year, how much will be the income tax collection estimate? How much will be the customs duty estimate? How much will be, right, the disinvestment receipts, etc. All of that information is provided in the financial bill. So these are the two most important documents. But if you ask me, only two documents? No. There is a summary document. There is FRBM document. There is a tax expenditure document. Macroeconomic framework, right, a statement is provided. There are multiple documents which are submitted, but most important ones are appropriation bill as well as the finance bill. So now when the government talks about expenditure, let's focus on all of this now. Government talks about expenditure as well as the receipt. I will use the term receipt. All of us will use the term normal term or general term is income. But in the context of budgeting, let's use the term receipt. Expenditure, straightforward. Receipt means income here. Done? So far so good. Now let's focus the accounts of the budget. There are two types of accounts of the budget. One is called as a revenue account. Second one is called as a capital account. Revenue and capital account. What is essentially the difference between a revenue and capital account? In the capital account, the government will either spend money or earn money. Simple, I repeat the statement. In the capital account, the government will either spend money or earn money. But this will either change the assets or liabilities of the government of India. I'll give you examples. Have patience, by the way. This will either change the assets or the liabilities of government of India. That is essentially covered under the capital account of the budget. What about the revenue account? The revenue account will list out all the transaction wherein there will be expenditure incurred, there will be income generated, but this will be done in the day-to-day activities of the government. In providing the day-to-day governmental activity, you will either spend money or you will earn money. And the speciality about the revenue account is, under this, the government of India, this is important, the government of India's assets or liabilities do not change. Is everybody okay with the difference between the revenue and the capital account of the budget? Do let me know. The revenue and the capital account of the budget. In the capital, expenditure or income, assets or liabilities will change. Whereas in the revenue, in the day-to-day activities, the government will collect or spend. The government's the assets, that is the government of India's assets or liabilities, do not change. Now, what do you mean by this? What are the examples? Let me explain to you in detail now. Revenue is further broken down into two components: revenue expenditure, revenue receipts. The capital is again further broken down into two components: capital receipts, capital expenditure. Now let's focus on receipts as well as expenditure separately. Receipts as well as expenditure. Okay. Now let's start receipts. Let's start with the receipts. Here you have revenue receipt as well as capital receipt. Somebody will say, sir, zoom in. It's not clearly visible, right? I don't have to go near to the mobile phone like this. I can't attach my eyes to the mobile phone. So zoom in. I've zoomed in. Okay. Zoomed in now. So on one side you have revenue receipts. Please look at the revenue receipt component. You will break down the revenue receipt into tax receipt as well as non-tax receipts. Tax receipts as well as non-tax receipts. 1, 2. I'll call this as A. Right, so tax receipts. Government will collect income taxes. Government will collect GST. Government of India will collect customs duties. Government will collect corporate taxes, securities transaction tax, etc. All of these are classified as part of tax receipts, either direct taxes or indirect taxes. Is everybody okay? Now, look at the other side. Non-tax receipts. Non-tax receipts. The government owns multiple companies. Central public sector enterprise. Example. Now, these central public sector enterprises will earn profits. Part of the profits will be given to the government because the government is the majority shareholder. Simple. Government is a majority shareholder. They will give part of the profits to the government. This is dividend. Dividend earned by the government. Interest receipt. Government has given loan, let's say, to a state government. 50-year loan is given. 40-year loan is given. On this, government is earning interest. On this, government is earning interest. That is interest receipt. Fees and fines. You will apply for a license. You will apply for, let's say, passport. You will have to pay certain fees to the government. So, multiple types, multiple varieties of fees and fines are collected by the government. And one more example, external grant. Let's say World Bank or United Nations will provide 50 crore rupees to Government of India. Will provide a grant of 50 crore. This is not a loan. Grant means a one-sided transfer. Is everybody okay? This is not a loan. Grant means a one-sided transfer. So when the grants are provided, government doesn't have to repay it. They will receive it. So, right, it is also part of the receipts, that is the revenue receipt. Now, all of you, this is my advice, all of you look at the revenue receipts and tell me, can you find any example of a revenue receipt where the government of India's assets or liabilities have changed? Let me know. I want an answer from all of you. Please look at all the receipts, tax receipts as well as the non-tax receipts. Please tell me any example under all of these where the government of India's assets or liabilities have changed. Is anything considered as an asset in this? No. It is simply an income that is earned. Is it changing asset immediately? No. Is anything a liability for the government? No. So is everybody on the same page with me now? Do let me know. Is everybody on the same page with me? The revenue side has incomes which are collected. Revenue receipt I'm talking. Revenue side has certain income sources for the government. Revenue receipts. But none of these are changing the assets or liabilities of Government of India. Can I move on to the right side of the slide? Do let me know. Can I move on to the right side? What is there on the right side? You have capital receipts. You have capital receipts. Now before you simply say, sir, there is an overlap, right? This, right? A bar is there. Please remove it. I've removed it. So look at the capital receipts. Please look at the capital receipts. I'll call the capital receipts as component B. I'll call it as component B. Now have a look at this. The component B has a couple of examples. I'll number them 3, 4 and 5. 3, 4 and 5. Now let's start. Recovery of loans. The government of India hypothetically in 2005 had given a loan to the state government. This year government will recollect the loan back. It will recollect the loan amount back. So can I simply say, by recovering the loan, the assets held by Government of India have gone down? Yes or no? Please do let me know in the chat section right now. Loan is an asset for you. Simple. If you have given a loan, it is an asset for you. If you recover the loan, don't you think one of your asset has gone down now? You cannot count this anymore as an asset for you. So asset has gone down. Clear for all of you? Disinvestment. What is the basic idea for disinvestment? Government will sell ownership in the companies that they have ownership in. That they own, they will sell ownership in the company. That is called as disinvestment. So now you tell me, if Government of India will sell, let's say LIC. If the Government of India, which has earlier sold Air India, don't you think government will sell and earn money? But at the same time, asset of Government of India has gone down. Clear? Even this is clear. Now shift to the last one. Shift to the last one. Borrowings. Shift to the fifth number, borrowings. And focus on all of this because I'll ask you questions now. Borrowings. Now Government of India this year will issue a bond. Government of India this year will issue a bond. Why will the government issue bond? Simple. Because government is falling short of money to spend. In the budget this year, Government of India has announced borrowings of 17 lakh crore rupees. Why? Government wants to spend so much amount of money, but the earning is lesser. Because the earning is lesser, government doesn't have any option but to borrow from the market. So can I simply say, when the government will borrow, either from the domestic market or from the external market, no doubt this year government will get money. But at the same point of time, can I write, liability of the Government of India will increase. Correct? Everybody is okay with this idea? Please do let me know. Liabilities of Government of India will increase. Now please observe 3, 4 and 5 which are part of capital account. Simple. Observe 3, 4 and 5 which are part of the capital account. Can I simply say, these are, right, essentially, that is the capital receipts are essentially representing the income or the earnings done by the government in this financial year. But at the same point of time, these are either changing the assets or the liabilities of the Government of India. Is it okay? Right? These are either changing the assets or the liabilities of Government of India. Right? Everybody is able to understand the difference between a capital receipt and a revenue receipt. Can I move on now? Can I move on to the next concept? Everybody is okay with the capital receipt and the revenue receipt? Now, certain important points. The total receipts, I will start writing here. Please have a look at this. First one, or right, let's say A. Total receipts, the total receipts is equal to A plus B. Everybody is okay? Total receipts is equal to A plus B. Second, the non-debt creating receipts. Non-debt creating receipts. What do you mean by non-debt creating receipts? These are the money that is collected by the government, receipts which are collected by the government, but these are not creating any debt. These are not creating any liability. Can I write non-debt creating receipts is equal to 1 plus 2 plus 3 plus 4? Anybody has a problem? 1 plus 2 plus 3 plus 4, or else A plus 3 plus 4. Somebody will say, no, sir, you are wrong. It's not 1 plus 2 plus 3 plus 4. It is A plus 2 plus 3 plus 4. Either ways, you are also looking at the same component. I am also looking at the same component. 1 plus 2 plus 3 plus 4. Component C, or point number C. Debt creating receipt. Debt creating receipt. Can I simply say number 5? Debt creating receipt, number 5. Everybody is okay? Anybody says, sir, no, it is incorrect, etc. Debt creating receipt. It's only number 5. Point number 4. Non-debt creating revenue receipt. Non-debt creating, again, I will have to simply write the idea of, right, non-debt creating, or simply say the revenue receipts. Because I hope you understand, somebody will say, sir, why not non-debt creating revenue receipts? I can't call it as a non-debt creating revenue receipt because by default revenue receipts are non-debt creating only. All of you are able to understand. Revenue receipts by default are basically non-debt creating, right? So the revenue receipts are basically 1 plus 2. And non-debt creating, last component, non-debt creating capital receipts. Non-debt creating capital receipts. Non-debt creating capital receipts are nothing but 3 plus 4. Everybody is okay? And the reason why I have written all of it, UPSC will confuse you with these kind of questions. UPSC will confuse you with these kind of question. They will throw the question like this. How many of the following are debt creating capital receipts? How many of the following are non-debt creating capital receipts? How many of the following are revenue receipts, etc. So you please be aware what is the difference between debt creating, non-debt creating, revenue, capital, etc. Everybody is okay? If at all a question is asked in the UPSC Prelims examination, will you be able to identify what is what, right? What is the correct option, etc. Now let's shift to the other side. We have taken care of the receipts now. Now let's look at the expenditure side also. Grant to the states and non-debt creating capital receipts. My dear, are you talking about the central government budget or the state government budget? You're talking about the central government budget. If the center will give away the grant, will the central government's assets change? Think of it. Will the central government's assets change? No, it will not change. That you will understand now. Let's focus. So government expenditure, there are two sides again. One is the revenue expenditure. On the other side is the capital expenditure. Let's start. Examples. Revenue expenditure, the central government's expenditure to maintain law and order. For example, salaries which are paid. The salaries that are paid to the defense sector. Again, I'm talking about salaries, by the way. Okay, a lot of operational expenses are incurred. So salaries paid. Transfer payment. Let's say Government of India will launch a scheme, right? Old age widow pension scheme. Old age widow pension scheme. That is a transfer payment, right? That will also be counted here. The Pradhan Mantri Kisan Samman Nidhi subsidies. That will also be counted here, right? That is an expenditure for taking care of the day-to-day operations, right? Next one, welfare payments. Lot of welfare payments are done. Again, welfare payments can be subsidies also. So lot of welfare payments are incurred by the government. Pension payments, lot of old age pension schemes are run by the government, pension payments. And grant for creation of capital assets, GCCA, grant for creation of capital assets. Focus on this very carefully. Point number 1, the term grant is mentioned. So everybody will be okay if I say this is not a loan. Yes or no? The term grant is mentioned, which means, right, it is not a loan given by the government. Now, what is this grant for a creation of a capital asset? Let me explain this with a simple example here. Imagine the central government will spend 100 crore rupees and construct, right, let's say an infrastructure. Construct infrastructure. Central government is spending 100 crore constructing infrastructure. So now can I simply say, here the assets of the government of India have increased. Simple, assets of the government of India have increased. Obviously, it has to be accounted on the capital side of the expenditure under the union budget. But what if the center will provide the same 100 crore rupees to a state government? It will provide the same 100 crore rupees to the state government. State will use this particular 100 crore rupees for development and, right, let's say, creation of an asset. Now, very simple question to all of you. In the second example, can I simply say, central government has paid 100 crore rupees, but the central government's assets have not changed? Yes or no? Right, do let me know in the chat section. The central government has spent 100 crore rupees. It's an expenditure. But the central government's assets have not changed. And it is a one-sided transfer. That's it. One-sided transfer. Right, so can I call this essentially as a revenue expenditure? And this, my dear, it is called as a grant for creation of capital assets. GCCA, grant for creation of capital asset. Is everybody okay with the GCCA now? Do let me know. Everybody is okay with the GCCA? And one more very important point. None of you have asked now, but later you might have this kind of a doubt. Sir, why is that the interest payment and interest received, they are associated with the loan, correct? Associated with the loan. Why are they not written on the capital side? Why are they written on the revenue side? Why they are accounted in the revenue side? Reason is very simple. Do not assume that the central government will either recollect or repay the loan like you people do. You and me, when we take, let's say, housing loan, we will make equated monthly installments, correct? EMI. We will make EMIs. In the EMI component, there is a principal amount, there is interest amount. Very simple. If I'm making an EMI of, let's say, 20,000 rupees, part of 20,000 rupees is principal. Remaining is interest amount. But when the government of India borrows and they have to repay, they will not make principal payment in installments like this. They will wait for the maturity period of the loan. Let's say a 20-year loan. After 20 years, complete principal is repaid. Is everybody able to understand the logic here? Complete principal is repaid. Till then, government will simply keep on paying interest annually. So this is a part of the day-to-day expenditure of the government, that is interest. Principal doesn't change. Liability of the government doesn't change. That's the reason whether the interest is paid by the government or received by the government, it will be accounted under the revenue head, but not under capital head. Can I move on to the capital expenditure now? All of you, those who are present, do let me know. Present, awake and listening. All the three are equally important. Present, awake and listening to the discussion. Can I move on to the next one now? That is basically capital expenditure. Capital expenditure. In short, they will also write CapEx. In short, they will also write CapEx, capital expenditure. What is the idea of a capital expenditure here? The government will spend money. Expenditure means spending. Okay, government will spend money, but please understand, because of this particular expenditure, the assets or the liabilities of the government assets or the liabilities of the government changes. Assets or liabilities of the government changes. And before I start with capex, everybody is okay? Look at the revenue expenditure side. All of you, please look at the revenue expenditure side. Please tell me, is there any change in the asset or liability of Government of India? Do let me know. All of you, please look at the revenue expenditure side. Look at all the components. And my question, listen to that also carefully. Is there any change in asset or liability of Government of India? Because I'm specifying, stressing on the term Government of India, because I know a lot of you will focus on the last one and say, sir, asset change. Government of India? That is important. Government of India's assets are changing? No. Somebody else, let's say state government, their assets are changing, not the Government of India. Now let's shift to the capex now. Let's shift to capex. Under capex, the assets or liabilities will change. How so? Government will spend money on developing infrastructure. Let's say government will spend money to develop infrastructure such as roads, right? Airports, bridges, etc. Now very simple. When the government spends money to develop roads, can I say assets of Government of India have changed? That is increased? Yes or no? Please do let me know. Assets of Government of India have increased now. What about repayment of loans? Let's say Government of India has taken a 20-year loan. 20-year period is over. Government will repay the loan. The principal amount government will repay now. Now tell me, don't you think because of this, the liability of Government of India will decrease? Liability of Government of India will decrease. The central government will give a loan to, let's say, a state government for 30 years, 40 years, etc. Center will give a loan to a state government. Can I simply say the assets of Government of India will increase? Everybody is able to understand, and A is, right, let's say assets here. A is asset, right? Assets are increasing, liabilities are decreasing. So can I simply now consolidate this under capital expenditure? Assets increase, liabilities decrease. Everybody is okay? I'll write a short table on the top here, right side top. I'll write a short table. Please memorize this. It should not be difficult. Once you understand, it will be very easy. What is the table? I will write assets and liabilities. Assets, liabilities, and right in the bottom I will write capital expenditure, capital receipts. Capital expenditure, capital receipts. Simple. I will always remember through this. I always remember through this. This is my trick. If you want to use it, you can use the same trick. But somebody will say, sir, I've got a better trick. You remember using that. Route doesn't matter. Destination matters. I'll repeat this. This is my trick. You have a better trick. You remember using that. So understand the logic here. What I remember is capital expenditure. Always I remember capital expenditure. Capital expenditure means road construction. Simple, road construction. So capital expenditure, road construction means assets will increase. Assets will increase. Only remember this particular arrow mark. Automatically you can write for other arrow marks. Other arrow marks automatically you can write. So capital expenditure, roads, assets will increase. Liabilities will decrease. If the assets for capex will increase, for capital receipts, assets will decrease, liabilities will increase. Is it okay? Please do let me know. Is it okay? Right? Simple logic. Again, this is how I remember. If you have a better trick, use that. Otherwise, simply remember one corner. Assets, capital expenditure, increase. That's it. Catch hold on to this particular increasing arrow mark. If the assets are increasing, liabilities in the capex will decrease. If assets in capex are increasing, capital receipts, assets will decrease. If you know this is decreasing, the opposite side should increase. That's it. Use this because UPSC has been asking questions on this. UPSC has been asking questions on this. Don't overcomplicate. I know a lot of you just fall into pressure during the examination. So remember these kind of hacks, these kind of tricks, it will become easier. Now, right, Divyakri is asking repeatedly interest component, interest component. My dear, if the center will take 100 crore rupee loan, it will annually pay interest only. 100 crore is not repaid. This 100 crore rupee loan is repaid only upon maturity. So the liability of Government of India was how much? 100 crore. You are paying interest. Is the liability changing? Liability still remains 100 crore. Simple. Right? That is the reason whether the center pays interest or receives interest, liability amount or the asset amount doesn't change. That's the reason we write it under the revenue side, not on the capital side. Everybody is okay with this particular formula now? Everybody is okay? What is capital receipt? What is capital expenditure? What will happen to assets, liabilities? And before somebody will ask, sir, please make the same kind of a table. There are two types of students. One type of student will ask, sir, can you please make this kind of a same table for revenue account as well? That is one classification. Second classification is they will raise a complaint. That is, sir, you have not written the same table for revenue side. Write it. What is your problem? Write it. To both of the students, I'll simply say, my dear, revenue side, there is no change in the assets and liabilities. That is what we have been discussing. Simple. Revenue side, there is no change in the assets and liabilities. So you don't have to make a table for the revenue side. Only for the capital side, you need to remember the table. Can we go forward now? Now, what is the use of all of this? What is the use of all of this? Some of you will be thinking, sir, why should I remember all of it? Is it of any use? Of course, yes. There are deficits. There are deficits. Now, listen to me very carefully. I've listed 6 types of deficits. Okay, I've listed 6 types of deficits. Should you remember all the 6 for examination purpose? Yes. But does the government calculate all the 6? Answer is no. Right? Does the government calculate all the 6? No. Government simply calculates the first 4. The government calculates only the first 4. The 5th and the 6th have been discontinued. We do not calculate 5th and 6th. Is everybody okay? Let's start now. First one, the easiest, revenue deficit. Then there is effective revenue deficit. Then there is a fiscal deficit. Then there is a primary deficit. Then there is a budget deficit. And finally, monetized deficit. What is a revenue deficit? Please have a look at it. Revenue deficit is the difference between revenue expenditure and a revenue receipt. And all of you remember what is the meaning of a revenue expenditure, revenue receipt, etc. And please don't ask me, sir, why are you writing expenditure first? Why can't you write receipt first and then write expenditure? It is because, my dear, you are calculating deficit. You are calculating deficit. Because you are calculating deficit means your expenditure is greater, your income is smaller. That's the reason expenditure first. Right? The receipt is later. Done? Everybody is okay? Right? So revenue expenditure minus revenue receipt. This is called as revenue deficit. Now please understand, there is a law FRBM. There is a law FRBM, right? Fiscal Responsibility Budget Management Act. The FRBM Act 2003 has been implemented by the Government of India. Under the FRBM law, the Government of India is targeting to reduce the fiscal deficit as well as revenue deficit. The revenue deficit is supposed to be reduced to 0% of GDP. RD is supposed to be reduced to 0% of GDP. And the fiscal deficit is supposed to be reduced to 3% of GDP. 3% of GDP. We have been able to meet the target only once. Right? In the whole 20 plus years of implementation, although in recent times we have deviated a bit more, there is a reason for that. We have been able to achieve this particular target of fiscal deficit of 3% only once, that too in the year 2007 and 8. But what is the logic? Why should we have 0% of GDP as a revenue deficit? Is it okay if I say the creation of assets will happen on the capital side, not on the revenue side? I'll repeat the statement. The creation of assets will happen on the capital side, not on the revenue side. So if you have a revenue deficit, does it not mean you are spending more than how much you are earning for consumption purposes? You are spending more than what you are earning for consumption purposes. And the golden rule of the financing, golden rule in the market is, if you want to borrow, borrow from the market. But the borrowing should be for creation of asset, not for consumption purposes. So by having a revenue deficit, you are borrowing in the market, and that particular borrowing is for consumption, not for asset creation. That's the reason the argument was reduce the revenue deficit to 0% of GDP. And now have a fiscal deficit of 3% of GDP. If you have an FD of 3%, that is essentially borrowings. Please look at the formula number 3. All of you, please look at the formula number 3. Formula number 3 focuses on the fiscal deficit, that is total expenditure minus non-debt creating receipts. Now all of you, please do let me know. You understand what is the meaning of a non-debt creating receipts? I'm looking at the chat section, by the way. I want everybody to answer. And I know a lot of you are worried about what am I going to have in dinner. Right, already you are sitting, right, in the home, the dinner is getting prepared. Already you are concentrated there. Don't go there. Anyways, you are going to get dinner. Don't worry. Today your parents will be very happy with you. Why? You have studied economics for 4 hours. 4 hours, which they have not been able to do. You have done it. So you will get good dinner. Don't worry. Focus on the discussion now. Everybody is okay with the concept of non-debt creating receipt. That is in simple, the amount that we have calculated earlier, that is in this particular formula. This particular formula, can I simply say the non-debt creating receipts are 1 plus 2 plus 3 plus 4 or A plus 3 plus 4. So understand the problem here. The government wants to spend, let's say, 100 crore rupees. Simple. Why do we say fiscal deficit is borrowing? Very often you will come across this statement. Why do we say fiscal deficit is nothing but the borrowings done by the government? Why do we say that? It is because of this. That is, you want to spend total 100 crore rupee this year. But if you calculate the 1 plus 2 plus 3 plus 4, which is a non-debt creating receipt, you have earned only 70 crore rupees. You have earned only 70 crore rupees. Now tell me, how can you spend 100 with 70? Not possible. So what we do is, the difference between that is the 30 crore rupees, is nothing but borrowings of the government. And that, my dear, is the fiscal deficit. Is everybody okay with the formula of fiscal deficit? Everybody will be able to understand why fiscal deficit is nothing but borrowings are done by the government in that financial year. Simple, borrowings done by the government in that financial year. That financial year, that is important term. Because somebody will say borrowings means all the borrowings. No. Please understand, there is a difference. There's a term called as total liability. I'll come to that in some time. There's a term called as a public debt. Right? There is a fiscal deficit. These are different. I'll explain that also. Just wait for 5 minutes. So everybody is okay with the revenue deficit and the fiscal deficit. Now come to the second formula. That is the effective revenue deficit. There was a committee set up by the government of India, Rangarajan Committee. The Rangarajan Committee on the public finances looked at the formula of revenue deficit and they basically raised a concern. What was the concern? You are, right, listen to me carefully. You are spending money under the revenue head. One component is GCCA, Grant for Creation of Capital Asset. Now the argument is revenue account doesn't change any assets or liabilities of the government of India. Agreed. But at the end of the day, can I simply say GCCA will change assets of Indian economy? Correct? All of you are okay with this? The central government's assets may not change. Agreed. Center's assets are not changing. But the economy's assets are changing. The states are taking this money and creating an asset. So the recommendation of this committee was, this should not be counted when you calculate revenue deficit. Simple. You cannot count this when you calculate a revenue deficit. Because when you say revenue deficit, you are simply saying you're borrowing money for consumption purposes. You're borrowing money for consumption purposes. Here is asset creation. So how can you count this when you calculate revenue deficit? That is the precise reason. What we have done is we have created one more type of a revenue deficit called as effective revenue deficit. So from the revenue deficit, that is the difference between revenue expenditure and revenue receipt, now we simply take out the GCCA component. Is everybody okay with the second one? Please do let me know now. Everybody is okay with the first, second and the third? What is mostly followed in India? Which indicator is mostly tracked in India? It is the third one. It is the third one, that is the fiscal deficit. But is it the most qualitative one? Underline the term qualitative. Is it the most qualitative one? No, it is not most qualitative. There is one more indicator, primary deficit. Primary deficit is the most qualitative indicator. Sir, what do you mean by most qualitative? Let me explain. The fiscal deficit represents how much is your borrowing in this financial year. Now the question is whether you are borrowing because in the current financial year you don't have sufficient money. In the current financial year, you want to spend on road construction. You want to spend and provide subsidies for the farmer. You want to spend and let's say provide certain welfare to the poor people. You want to spend money in the current financial year. So whether you have sufficient amount of money generated this year to take care of current year expenditure, or you are basically borrowing from the market. That is essentially the logic here. Fiscal deficit simply shows how much borrowings you have done. But you tell me, will the fiscal deficit number tell you how much of that borrowing is used for current year expenditure and for the liabilities of the past borrowing? What is the meaning of it? I'll just continue with the same number that I've taken earlier. Right? Earlier I had taken one number. You want to spend this year 100 crore and you have generated total income of 70 crore, non-debt creating receipts of 70 crore. Now have a look at this. Out of the 170, the difference is how much? 30 crore rupees. Correct? The difference is 30 crore rupees. So the problem is, out of this 30 crore, how much of the money you have used to pay for interest on the loans that you have taken last year? Interest on the loans that you have taken in 2020. Interest on the loans that you have taken in the 2015. Will that information be provided in the fiscal deficit number? That information is not there. Because if you know that amount, for example, think of this. Let's say government will borrow 30, but out of 30, the government will use 20 crore rupees for interest payment. Which means, can I now say, out of 30 crore, the government is using 10 crore rupees for current year expenditure? Everybody is okay with this idea? I'll repeat it again. Imagine government borrows 30 crore. But out of 30 crore, government will use 20 crore rupees, 20 crore for interest payment. And why there is an interest payment? Because you have taken loan in 2015, 2020, 2022, 2024, 2025. You will have to pay interest on it. So out of 30, 20 is that. 10 crore is for this year expenditure. So that information is not provided in fiscal deficit. So can we find out even that? Yes. There is one more indicator called as a primary deficit. All of you, please look at the formula. Look at the formula. Primary deficit is equal to fiscal deficit minus interest payment. Fiscal deficit minus interest payment. So out of the borrowings that you have done, how much is for liabilities of the past and how much is essentially for the current year expenditure? That information will be given by calculating primary deficit. And don't you think, if you use, hypothetically imagine this, if you borrow 30 crore and if you're using most of this for current year expenditure, does it not mean In the current year, your finances are very weak. That's the reason you're borrowing more. You're using most of it to take care of your current year expenditure. On the other side, imagine you borrow 30 crore and you use all the 30 crore for interest payment. Right? Extreme example, I know, but imagine you borrow 30 crore and you use all the 30 crore for interest payment. Not even a single rupee for current year. Meaning what? This year, you have sufficient amount of income to take care of your expenditures of the current year. That represents a strength of the finances of this year. Is everybody able to understand how do you read primary deficit? Correct? All of you able to understand how do you read primary deficit? A lot of you will be focused only on the fiscal deficit. But please understand, yes, we need to control fiscal deficit. We need to bring it down, etc. But is it going to provide a quality information? Primary deficit will provide you more quality information. Everybody is okay with 1, 2, 3 and 4? Done? 1, 2, 3 and 4? These are the ones which are calculated. In fact, one more important point here. Until recently, that is even this year by the way, the government of India used to use the fiscal deficit as an anchor. Fiscal policy anchor. I repeat, even this current year, current financial year, the government of India is using fiscal deficit as a policy anchor. That is a fiscal policy anchor. That is for decision making, policy making, etc. Fiscal deficit will give direction to you. You will have to consider fiscal deficit. But from the next financial year, it will not be fiscal deficit as a fiscal policy anchor. Rather, it will be debt to GDP. Rather, it will be debt to the GDP. Debt to GDP will be the new fiscal policy anchor. Please make a note of this. Question on this can be asked in the prelims examination. Done? Everybody is okay? Now, these are the 4 which are used. What is the debt to GDP? I'll explain this in the next. But before that, let me complete the 5th and 6th. These are not calculated, by the way. Budget deficit, monetized deficit, not calculated. But what is the meaning? Budget deficit represents the difference between total expenditure and total receipts. Total expenditure and total receipts. That is earlier, not now, earlier. The government used to have this kind of a practice. Government wants to spend, let's say, 100 crore rupees. They have generated, let's say, 50 crore rupees. Total expenditure, receipt is 50 crore. Now they will borrow 30 crore rupees from the market. They will borrow 30 crore rupees from the market. Now can I simply say, even after borrowing, there is a deficit of 20 CR? Yes or no? Even after borrowing, there is a deficit of, right, 20 CR. This was called as budget deficit. This was called as budget deficit. I hope all of you can understand the problem with this. Even the market borrowings have been considered as incomes. Even the market borrowing that the government has done, it has been considered as income. And after that also there is a deficit of 20 crore. This is called as a budget deficit. So earlier what the government used to do, this particular 20 crore which is a budget deficit, the government would borrow this 20 crore from Reserve Bank of India. The government would borrow this particular 20 crore from Reserve Bank of India. And that particular practice of RBI lending to the government, RBI giving loan to the government to bridge the deficit was called as monetization of deficit. Monetized deficit. Do we practice this as of now? No. Under FRBM, we have discontinued this. Under FRBM, we have discontinued. And the logic was very simple. This is inflationary in nature. This is inflationary in nature. That is, Reserve Bank of India will give 20 crore to the government which will spend money. This 20 crore until now was not there in the market. It will infuse more money in the market which is leading to inflation. That's the reason we have discontinued this. Everybody is okay with the deficits here? Please do let me know. Everybody is okay with the deficit? Okay, let's go forward now. There are 3 key terms. One is the fiscal deficit. I will write FD. Fiscal deficit, by the way. Okay? Fiscal deficit. Right? That is FD. Then there is public debt. Then there is public debt. Then there is total liabilities. Total liabilities. That is the complete debt of Government of India. Total liabilities are nothing but overall debt of the Government of India. Okay. And before I go forward, the Government of India's debt is different. Total general government debt is different. Right? I hope you understand this. They will write the term general government debt. What do you mean by general government debt? General government debt essentially focuses on central plus state government's debt. Central plus state government's debt. So please keep these particular key terms in the mind when you're writing exam. These are very important key terms. Don't get confused. Let's start. What is FD? What is the amount that you borrow in a financial year? Is it okay? What is the amount that you borrow in a financial year? That is called as fiscal deficit. What is a public debt? What is the amount of money that the Government of India has to repay taking the money from Consolidated Fund of India? Charged on Consolidated Fund of India. Sir, what is the meaning of it? Let's say the Government of India last year has borrowed 100 crore rupees. Last year has borrowed, I'll write financial year 25, it has borrowed 100 crore. None of it has been given back as of now. In the current financial year, they have borrowed, let's say 200 crore rupees. Can I simply say, the liability of Government of India, which they have to repay using the money from the Consolidated Fund of India, is 300 crore rupees here. Everybody is okay? 300 crore rupees here. That is called as a public debt. Right? How much money you have to repay taking the money from the Consolidated Fund of India? It is called as, right, the public debt. Is it okay? Can we go forward? MAIT 6016. My dear, you have written 3000 crores. Right, sir, 0 doesn't have any value. I've added one more 0. Right, kuch nahi fark padta hai. My dear, 300. Okay, again, I don't understand. Don't worry. So 300, not 3000. Let's go forward. Public debt. Then there is one more. Total liabilities. What is total liabilities? Can I simply say the amount of the debt the Government of India has to repay, which is charged on Consolidated Fund of India? That is part of the total debt. In addition to this, there is a public account. All of you have come across public account. There is a public account under which, for example, there are a lot of small saving schemes which are announced by the government. Money is collected. Who is liable to repay all of this? Government of India. Example, right? Public Provident Fund, Sukanya Samruddhi Yojana, Kisan Vikas Patra. Correct? All of these are the types of small savings funds. The Government of India announces it. You'll open these in the post offices, in the banks, etc. Who is liable for the repayment of all of it? Government of India. All of that is counted as a part of public account. That is, all of that is put into fund which is called as a National Small Savings Funds. And Government of India is liable for the repayment. Is everybody okay? Third one, there is a gross budgetary support. Gross budgetary support. Any example of a gross budgetary support? I'll give you one example. There is a term called as off-budget liability. Off-budget liability. In fact, this was mentioned even in the 16th Finance Commission report. 16th Finance Commission report, you should be very careful about it. So, off-budget liability. What is this off-budget liability? Center wants to implement, let's say, a road project. Center will allocate, let's say, 300 crore rupees, and it will ask the National Highways Authority of India, NHAI, to borrow 700 crore rupees from the market. And now the total expenditure on the project will be 1000 crore rupees. Now listen to me carefully. This 700 crore rupees is the liability of, right, the Government of India. Liability of Government of India. Agreed. In this year's budget, it is not mentioned. I hope you understand. In this year's budget, it is not mentioned. Why? Government of India is not borrowing this amount. Please understand why it is not mentioned. Government of India is not borrowing this amount. NHAI is borrowing the amount. But who has told the NHAI to borrow? Government of India. Government has told the NHAI to borrow. So obviously, it is the liability of Government of India. This kind of a liability is called as off-budget liability. Right? Over a period of time, the government will pay back this loan amount as well. So now please do let me know, all of you. Please participate and do let me know. Can I simply say the total liability is the sum total of A plus B plus C? Do let me know. Total liabilities or the total debt of the government. Total debt of the government is nothing but A plus B plus C. Now do let me know everybody is okay. The difference between a fiscal deficit, the public debt as well as total debt of the government. This is the fiscal policy anchor now. This is the fiscal policy anchor. And the government of India right now, it is around 55 to 56% of GDP. 55 to 56% of 56% of GDP. The government of India by 2030-31 wants to drag it down to 50% of GDP. Simple. The government of India's target of dragging it down to 50% of GDP. Again, there is a flexibility. There's a flexibility. 50% plus or minus 100 basis points. 50% plus or minus 100 basis points. Everybody is okay? Everybody is okay? Right? Let's go forward. Finance Commission. Please repeat C once more, my dear. Government of India has asked some other authority to borrow. It is not borrowing. It has asked some other authority to borrow. Because the other authority, for example, Food Corporation of India, National Highways Authority of India, etc., because they are borrowing, the liability will fall on the Government of India. Government of India has asked them to borrow, so Government of India has to repay it. Hence becomes liability of the government. So that is the reason it is not counted in the budget. It is not counted. Why? Government of India is not borrowing, hence not counted. So essentially it is counted as a part of gross budgetary support, and that will be part of total liabilities of the government. Okay, let's go forward. Let's go forward, right? So we have taken care of the expenditure part. Taxation is left out. I'll cover that. Don't worry. The Finance Commission. Finance Commission, right? So under the concept of budgeting, whenever the government announces a union budget, in the budget, there will be two expenditures that is generally mentioned. Two very important expenditures. One, in this year, how much is, right? Essentially, the tax devolution that is done. Tax devolution. And the other one is, the Finance Commission would also have recommended multiple types of grants, which will also be allocated in the budget. That is in the budget documents. And that is where the Finance Commission becomes so relevant for you. Okay, so Finance Commission, it is a constitutional body set up under Article 280 by the President of India, and it is set up generally once every 5 years or whenever there is a need of it. It is set up once every 5 years or whenever there is a need of it. The 15th Finance Commission initially submitted report for 1 year, that is 2021, and then for 5 years, 21 to 2026. And now the 16th Finance Commission, this is for 15th FC. And now the 16th Finance Commission has submitted report which will come into force for 5 years, 26 to 31. 26 to 31. Okay. Now, what is the composition of the Finance Commission? The Finance Commission generally has 5 members. One is the chairperson and remaining 4 are members of the Finance Commission. The most important recommendation of the Finance Commission, underline the term most important recommendation. So the most important recommendation of the Finance Commission is to provide a formula for vertical devolution and horizontal devolution. Simple. There are other recommendations also provided. Other recommendations are there. But the most important recommendation of a Finance Commission is to provide a vertical devolution formula and a horizontal devolution formula. What is essentially the idea? The central government under the Constitution of India is given the power to impose and collect pan-India taxes. Pan-India taxes. What do you mean by pan-India? The taxes which can be imposed across India and collected. Example, corporate taxes, individual income taxes, customs duties. All of these are prime examples of pan-India taxation. So the government of India is going to impose and collect it. All of this money pooled is called as divisible pool. All this money is called as divisible pool. But please remember, the surcharges and cesses, I repeat, the surcharges and cesses are not counted. The surcharges and cesses which are imposed and collected by the union government are not counted, right, in the divisible pool. These are not counted in the divisible pool, these are excluded. Now the divisible pool of taxes is collected. Out of the divisible pool, how much should go to the states and how much should go to the center? This is called as vertical devolution. Is it okay? This is called as vertical devolution. Now, once the amount is allocated to the states, let's say once the amount is given to the states, out of this amount, how much should go to the state 1, how much should go to the state 2, how much for state 3? This formula is called as horizontal devolution. Is everybody okay with the vertical and horizontal devolution? Now, this is the most important recommendation given by the Finance Commission. Apart from this, the Finance Commission can be asked by the central government to give recommendation in other areas. The Finance Commission will also give recommendation regarding the consolidation fund of the states. The Finance Commission will also give recommendation regarding on what principles the grants should be issued by the center to the states. So these are generally referred to as terms of reference, TOR, terms of reference. Now my suggestion, please go through the terms of reference of 16th Finance Commission. Is it okay? My recommendation, please go through the terms of recommendations of 16th Finance Commission. Question can be asked in the prelims examination. For example, the distribution of proceeds between union and the states from the total taxes collected. That is essentially the devolution, vertical devolution and horizontal devolution. In addition to this, the grant in aid. What kind of grant in aid under Article 275 should be provided by the center to the states? What are the principles on which we should provide it? All of that has been asked. Third one, the measures needed to augment the consolidated fund of the states. That is, I hope you understand. These three are given by default, by the way. That is, these terms of reference are given by default to the, right, let's say Finance Commission. But in addition to this, the Finance Commission was also asked, can you look at the financing for disaster management? Can you look at the financing for disaster management initiatives? Right, so that is one more, right, terms of reference which has been provided to the 16th Finance Commission. Everybody is okay? Please go through, download the PPT, go through all of this. Now, vertical devolution and horizontal devolution. Vertical, horizontal. So, vertical devolution formula, it has been retained as it was in the 15th FC. In the 15th FC, what was the vertical devolution formula? 41%. Now, the same 41% has been retained in the 16th Finance Commission. They have not changed anything in the vertical devolution formula. But in the horizontal devolution formula, my suggestion, please go through the complete table here, especially the 15th and 16th. Is everybody okay? Please go through the complete table, especially the 15th and 16th column, 2 columns. Please go through that. Questions can be asked straightforward only on 16th. They can be asked a comparison between 15 and 16. Popular questions. They will be asked. Please take care of it. Now, what has been done in the horizontal devolution formula? The population weightage for 2011, earlier it was 15, now it has been increased to 17.5%. The area, earlier it was 15%, now it has been reduced to 10%. The forest cover, earlier it was 10, retained at 10% weightage. Income distance earlier was 45%, now reduced to 42.5%. There was a weightage that was given for tax effort earlier in the 15th FC. It has been completely been removed, excluded completely. No weightage whatsoever. The demographic performance earlier it was 12.5, now has been reduced to 10%. The 16th FC has introduced a new parameter. It has introduced a new parameter, that is the contribution of the states to GDP. Contribution of the states to the GDP. Earlier in the 15th FC, it was not a parameter at all. Now it has been a new introduction. The weightage has been introduced or given at a 10% weightage. Everybody is okay? My suggestion again my suggestion, please go through all of this. Go through all of this. Memorize all of it. Memorize all of it. Nothing wrong. If question is not asked in the prelims, pakka it will be asked in the mains examination. So please be very careful with the 16th Finance Commission. Done? So we have taken care of under the fiscal policy, we have taken care of, right, let's say the expenditure side. Now let's shift to other side, that is the taxation. If you're spending money, you're also earning money, that is taxation. Let's understand that as well. So under taxation, what are the important points? And again I'm saying, mind map is there, we'll go point wise, point by point, we'll keep on covering these particular points. Okay, next, let's go. LUX, Lux is saying last topic. For what, my dear? Today's session. Today's last topic. No, right? Today we have one more bigger topic, right? Bigger topic, banking. And we have still banking to cover, right? So the banking will start after dinner, don't worry. But let's talk about taxation now. And be ready for these kind of marathon sessions, be ready. And trust me, we are taking mind maps. And it becomes easier for me to teach with the mind maps, easier for you to revise also. Otherwise, imagine if I keep on writing every point. Every point I'll keep on writing and then discussing. Only one topic we will complete today, right? So please download, use the PPTs for revision purposes. Let's go forward. Taxation. What is this tax? What is a tax? Tax is a compulsory charge. Tax is a compulsory charge. Okay, compulsory charge that will be imposed by the government and collected from the taxpayers. The taxpayers could be individuals. The taxpayer could be a company. Taxpayer could be a foreign investor. Taxpayer even could be a household, etc. So essentially, we have imposed the taxes, collected the taxes. For what purpose? Government of India needs to spend money for developing projects, for maintaining infrastructure, for repaying the loans, for providing welfare, etc., etc. For that, we impose and collect taxes. Now, the taxation or the taxes are divided into different types. You have direct and indirect. You have ad valorem and specific. You have cessus and surcharge. You have progressive, regressive, and proportional. Let's start. Let's start one by one. What is a direct and indirect? In case of a direct tax, the government will impose and collect the tax from the same person or a taxpayer. The imposition is on the same person. Collection is from the same taxpayer. In simple terms, the burden of taxation is not transferred. They use a technical term in this context, incidence and impact. Whenever the incidence and impact is on the same person, it is called as a direct tax. For example, imagine you are an income earner, salaried individual. Government of India will identify you under the Income Tax Act, impose and collect income taxes from you directly. You cannot basically ask your parents to pay your income taxes. You cannot ask the shopkeeper to pay for your income taxes. You cannot transfer the burden. Everybody is okay? Prime example, right? So individual income taxes, corporate taxes, all these are examples of direct taxes. What about indirect tax? Best example. A lot of you, as I'm discussing taxation, a lot of you, because you know, Time is 7:30. Any time now. Any time break will come. Dinner break will come, etc. You are searching on Swiggy. What to order? And somebody will say, sir, not Swiggy, Zomato. I am a fan of Zomato. I've got account, right? Prime membership in Zomato, etc. But whether you order in this or that doesn't matter. When you order, will you pay GST? Will you pay service taxes, etc.? Correct? That particular GST, the government has imposed on the hotel. They have imposed it on restaurant. What has the restaurant done? They have transferred the burden of that tax on you. Yes, everybody is okay? They have transferred that particular burden on you. So whenever the burden of taxation can be transferred, and that happens in case of sales of goods and services, these are indirect taxes. Incidence and impact is on two different people. That is indirect tax. Best example right now is GST. Everybody is okay? Best example for this is right now the goods and services taxation. Everybody is okay with the direct and indirect? Now ad valorem and specific. Ad valorem and specific. Whenever the tax is imposed on value of the product, on the value of the product. For example, the product has a value of 10 rupee. Government will impose a tax on it and collect. That is ad valorem. Whereas, if the government imposes a tax on physical parameters, physical characteristics of a product, for example, length of the car. Correct? All of you know this? Very often the cars are divided into sub 4 and 4 plus meters. Sub 4 and 4 plus meters. What is the logic? Logic is the same. If it is less than 4 meters, tax rate is different. If it is more than 4 meters, tax rate is different. Everybody is okay with the idea? Please do let me know in the chat section. And please participate in my class. I want all of you to participate. I'm basically of the idea that participation is better. And one more, my interest here, when you participate and keep on typing yes, and I don't expect you to write a paragraph, either type Y or type yes, I will realize it. You will also be awake, right? I'm confirmed that you people are awake. That is my interest, because I'm teaching and you're snoring. What is the output? Output is 0. Okay, that is the reason. Done. Let's go forward. Any other example of, right, let's say specific, any other example? Petrol and diesel. The central government will impose a tax on it per liter. Is it okay? Central government on petrol and diesel will impose a tax on per liter. Whatever quantity you purchase per liter, you will have to pay a fixed amount to the government. That is specific taxes. Ad valorem and specific. Cesses and surcharges. Cesses are imposed with a particular objective to be achieved. You have an objective to achieve. For example, earlier we had Swachh Bharat Cess. Look at the name, automatically you will tell me what was the objective. Swachh Bharat Cess. Right? There is even today a cess associated with agriculture. Even today there is healthcare cess, education cess, etc. So whenever you want to achieve a specific objective, you impose and collect this. This is called as a cess. Then there's a surcharge. Surcharge is imposed and collected whenever, right, the taxpayer crosses a certain threshold. There is an objective, that is a threshold. You cross the threshold, government will impose additional tax and collect it from you. Sir, what is the meaning of it? If you are earning an income of more than 50 lakh rupees, government will impose higher taxes in the form of a surcharge in addition to the income taxes that you are paying. Is everybody okay with the idea here? Right? You will have to pay income taxes, but with the addition of the income taxes, there is one more tax that is called as surcharge. If your income is more than 50 lakh, it will come into application. More than 1 crore, higher surcharge. More than 2 crore, much higher surcharge. And the logic is very simple. Government simply says, there is a principle of taxation, principle or canon of taxation. Canon, right? Chartered accountants will be very happy now. Canon of taxation or principle of taxation. What does the canon of taxation simply say? It says that you are supposed to impose a tax based on the ability of the taxpayer to pay taxes. Ability to pay taxes. Is it okay? Ability to pay taxes. Now, if there is a person who is earning income of more than 50 lakh rupees, the ability to pay taxes is higher. So you don't have to just collect 30% income tax, impose more taxes. That is surcharge. Simple, right? That is basically a surcharge. Done? Everybody is okay? Cesses and surcharge. And one final point, cesses and surcharges are not part of divisible pool of taxes. These are not part of divisible pool of taxes. Okay, let's go forward. Progressive, regressive and proportional. Progressive, regressive and proportional. What do you mean by progressive? As the income increases, you will be imposed with higher taxes. You will be paying more taxes. The percentage of tax that you pay will keep on increasing. That is, right, let's say progressive taxation. Example of a progressive taxation, income taxes. Income taxes. Income taxes is an example of progressive taxation. What about regressive taxation? As the income goes up, the percentage of the income that you pay in the form of taxes will keep on reducing. Is everybody able to understand? I'll repeat it. As the income goes up, how much percentage of the income you pay in the form of taxes will keep on reducing. That is called as regressive taxation. Generally, please understand, generally, the indirect taxes are regressive in nature. Generally, the indirect taxes are regressive in nature. Okay? And finally, proportional taxes. Proportional taxes. Whatever is your income, same percentage of your income, I repeat, same percentage of your income you will pay in the form of taxes. Same percentage, that is a key term. For example, corporate taxes in India. Think of it, corporate taxes in India. If you have chosen to pay corporate taxes at 22%, hypothetically imagine that. If you have chosen to pay corporate taxes at 22%, whether your profit is 100 crore, 200 crore, 300 crore, doesn't matter. You will pay the same percentage out of your profits in the form of taxes. That is essentially proportional taxation. Is everybody okay with the classification here? Everybody is okay with the classification? Let me go forward now. Certain types of direct taxes. Certain types of direct taxes. Okay, one is income tax. Of course, right, what I've written, by the time you write exam, some of it will change. Some of it will change. What is the idea? Income tax. Income tax, right now, the provisions of Income Tax Act of 1961 are applicable. Correct? Provisions of Act of 1961 are applicable. And you are going to write exams in the month of May. I hope all of you remember that. And one more point, month of May will come after 1st of April. Correct? I hope all of you know that as well. So from the 1st of April, the new Income Tax Act of 2025 will come into force. Right? Then you will have to automatically change. But anyways, right now the Income Tax Act of 1961 provisions are applicable. These provisions will cover the companies which are earning profits. Right? Because the profits for the companies is nothing but income. Profits for the companies is nothing but income. Right? So it is applicable for companies. The provisions are applicable for individual, that is salaried individuals, right, such as you, such as me, etc. The provisions of the income tax are also applicable to Hindu undivided families, etc. So right now we have this kind of a provision which will have, right, application on any source of income, because please understand, some of you assume that income tax means only on salary. That is not correct. Is my point clear? Some of you make an assumption that income tax means only on salary. No. Income can be any source. You have agriculture, you can earn income through that. You have a home, you are earning rental income through that. You have invested in the stock market, you have earned, let's say, 1 crore rupee income through that. So government simply says income here doesn't mean salary. Salary is one type of income. Is it okay? Salary is one type of income. There are multiple other sources of income. You will have to include all of them. And all of them are covered under Income Tax Act of 1961. Is everybody okay? Right now, corporate taxes, essentially understand this. Until recently, couple of years ago, corporate taxes essentially applicable were 30%. Corporate taxes applicability was 30%. Government used to provide lot of deductions, exemptions, etc. But Government of India basically back in the year 2019 announced that if you are an entity who doesn't want to claim any kind of a deduction, etc., you may choose not 30% but 22%. Is it okay? Rather than 30%, you may choose 22. But please understand, no kind of a deduction, right? These kind of deductions are not allowed to you, right? So there is a lower rate, you can choose it. And for foreign companies which are operating in India, that is, let's say through one office, they're involved in the projects, etc. For them, the corporate tax rate will be 35%. For them, the corporate tax rate will be 35%. Earlier it was 40%, now it is 35%. Everybody is okay? So salaried individuals, the income tax rate will change. Don't memorize the two slabs. Don't waste your time. Don't memorize both of the slabs. If you are filing income taxes, that is needed. But for UPSC exam, that is not needed. Don't simply memorize slabs are so many here, so many here. I want to memorize everything. Waste of your time. Everybody is okay? So next, MAT, minimum alternate tax. What is the idea for minimum alternate tax? Listen to me very carefully. There are certain companies, I repeat, there are certain companies which will generate profits. But please understand, whatever profits that they generate, they will use a lot of deductions. Under Income Tax Act and Companies Act, there are two sets of provisions used, Companies Act as well as Income Tax Act. So there are certain companies which will generate profit, but they will use the provisions, claim lot of deductions. And as a result of which, they will end up paying very less amount of taxes, zero or negligible taxes to the government. Is everybody able to understand the logic here? I'll repeat it again. I will repeat it again. My dear, listen to the discussion first. Listen to the discussion. I'll address your doubts later. Listen to the discussion. Because anyways, if you type, I'm not going to stop and address your doubt. I will address your doubt at the end of this particular session. But listen. So companies are there. They're earning profits. Again, technical term for this is their book profit, etc. For that, you'll have to become a chartered accountant. Not required for UPSC. And I know some of you are chartered accountants, by the way. So the company will generate profit. Now they will claim lot of deduction. They will reduce the taxable profit to such an extent, they will end up paying 0 rupee taxes to the government or negligible taxes to the government. Such type of companies are called as zero tax companies. Zero tax companies. On such companies, which is applicable to all the companies right now, on such companies, the government has introduced a system back in 86 and 87, which is called as a minimum corporate tax. Minimum corporate tax. Now, this particular minimum corporate tax over a period of time has been renamed, and that is minimum alternate tax. MAT, minimum alternate tax. Right now, the minimum alternate tax applicable is 14%. In simple terms, you can claim deductions. Understand the logic here? Somebody will ask me, sir, what is that 40% then, etc. Calculation is this. You will basically show your income, that is the revenue, and expenditure. And the difference between this, assuming income or the revenue is greater, it is called as a book profit. Is it okay? This is called as a book profit. From the book profit, you will claim lot of deductions. You will reduce the taxable profit to very low number. Is it okay at least now? you will reduce the taxable profit to a very low number, let's say, right, 0 crores. And it has happened, 0 crores. Now the government simply says, pay 30% on the taxable profit. Pay 30% of taxable profit. What is your taxable profit? 0 rupees. So whether it is 30%, whether it is 40%, whether it is 50%, doesn't matter. You will end up paying 0 taxes to government. Such companies are referred to as zero tax companies. Is it okay? These are referred to as zero tax companies. The companies are earning profit, but they are not paying taxes to the government. So now under the MAT system, the government of India simply says, you calculate 14% of book profit. I'm saying 14. I know a lot of you will try to correct me later, either through mail or in the comment section. It's not 14, it is 15. Right now it is 15, but from the next financial year, it will be 14. Budget announcement. Right now it is 15, agreed. But from the next financial year, it is going to become 14%. So 14% of book profit, just a second, the 14% of book profit or 30% of taxable profit, whichever is greater, that is collected in the form of a tax by the government. Is everybody able to understand the MAT system here? Do let me know. Everybody is okay with the MAT system? Either 14% of book profit or 30% of the taxable profit, whichever is greater, the government says pay that in the form of a tax. Of course, yes, if the 14% number is greater, there's a concept of a MAT credit that you can set off in the next year, etc., etc. But that is more of a, right, a CA territory. Prerak will be very happy, who is attending the session, by the way. He'll be very happy today, right? So because it is in his area, he'll be like, yes, finally, right, you have entered into chartered accountant territory. Can you repeat MAT? My dear, you have generated profits. You will claim tax deductions, and now taxable profit will be 0. Taxable profit will be 0. And because the government is collecting 30% of the taxable profit, government will not be collecting any kind of a corporate taxes from you. And these are called as zero tax companies. Zero tax companies. So now government simply says, in that case, I will not calculate this way. 1986-87, they introduced a new system. It was Mr. Rajiv Gandhi who was the Prime Minister back then. Minimum corporate taxation. Under that, they will calculate 14% of book profit and 30% of taxable profit. Whichever is greater, they will collect it from you. Whichever number is greater, they will collect it from you. This is called as minimum alternate taxation. Is it okay at least now? Minimum alternate taxation. Okay, done. So this is MAT. Next one is capital gains taxation. Capital gains taxation. What is this capital gains taxation? Imagine you purchase an asset. You own the asset for a certain time period. It could be for less than 1 year, more than 1 year, less than 2 years, more than 1 year, more than 2 years, etc., etc. So when you are holding this asset and you are selling the asset, when you're holding this asset and selling this asset, if the price differential is there, that is, what is the meaning? Let's imagine you purchase an asset at 2 crore rupees today. You purchase an asset. It could be a mobile asset or an immobile asset, doesn't matter, mobile or immobile. You will purchase this asset. And after certain time period, after 6 months, after 1 year, after 2 years, whatever the time period is, you will sell it at 3 crore rupees. Now, can I simply say, there is a certain profit that has been generated by you. Profit. You call it profit, government calls it as capital gains. Is it okay? You call it profit, government calls it as capital gains. So government will impose a tax on the gains. Is it okay? On the gains. How much is the gains here? You purchased at 2, you sold at 3. Gains is 1 crore. Of course, there's an indexation. I'll come to that. So the gains is 1 crore. Government will impose a tax on the gains and collect the tax. And that is called as capital gains tax. Is everybody okay with the idea of a capital gains tax? Now point number 2. Sir, is it calculated for what kind of asset? I told you, the asset can be movable, immovable, shares, paintings, land, right? All of these, any kind of asset that is notified by the government, movable or immobile, you can impose a capital gains tax and collect. Point number 3. Point number 3, essentially in this particular case, is it always 1 crore like this? Is it 1 crore? No. Even if you purchase it at 2 crore, sell it at 3 crore, the capital gains will not be 1 crore. Reason being, all of you will agree, the purchasing power of rupee this year will be greater compared to the purchasing power of rupee when you sell the asset. Simple. Everybody is able to understand? Don't you think there is a change in the purchasing power because of inflation, etc.? Which means whatever price you have paid this year, that is 2 crore, the asset value in the year when you are selling, let's say you have purchased in 2026, you will sell it in 2028. So in the year 2028, because there is inflation, because there is a change in the price level, the value of the asset in 2028 is not 2 crore, it will be indexed. Is everybody able to understand? It will be indexed. There is a concept of indexation, and that is where the CBDT, Central Board of Direct Taxes, annually will come out with an index which is called as cost of inflation index. So you will be using that index number to change the value of the asset. For example, just for sake of understanding, imagine according to CII, according to cost of inflation index, between 2026 and 2028, there is a indexation increase of 20%. Of course, the calculation is done using index number. I don't want to get into that chartered accountant territory. So the price levels indexation has increased by 20%, which means what was 2 crore in 2026 now will become 2.4 crore in 2028. Is everybody okay? What was 2 crore in 2026 now will become 2.4 crore. Now you calculate the difference between the indexed cost and the sold price. 2.4, 3 crore, your profit or the capital gains will be 60 lakh rupees. Capital gains will be 60 lakh. Now based on the tenure, from one asset to another asset, we have long term, we have short term capital gains. For some of the assets, if you sell it before 1 year, it is short term. If you sell it after 1 year, it is long term. For some assets, if you sell it before 2 years, it is a short term. If you sell it after 2 years, it is long term. So from one asset class to another asset class, what is short term, long term varies. It varies. And who will decide it? Government of India. Government of India decides what is short term for this asset, what is long term for this asset. Then everybody is okay? So that is essentially concept of capital gains taxation. Next one, GAR. Those are looking at the clock, my dear, let me complete certain concept. Let's say I'll complete GAR, then we will take a break. Okay? I'll complete the GAR, then we can take a break. And after the break, GST will be left out. And after that, we can enter into the banking. Okay, GAR. What is GAR? Be happy at least now. Be happy. You can simply say, yes, finally, break. I will break from the shackles of Indian economy, run away, never come back to the class. You can do that, by the way. Right? So let's continue. GAR. What is GAR? General Anti-Avoidance Rules. General Anti-Avoidance Rules. That is GAR. Okay, that's a full form. Now, before GAR, there was a concept SAR, right? Even before GAR, there was a concept called as SAR. You don't have to read into it, but just remember that. UPSC can trick you, right? They will simply give a statement. SAR was a precursor of GAR like this, right? They will use this kind of statement. Be very happy. Be very careful. Now, let's go forward. What is GAR here? GAR represents a framework. It is a guideline. Okay, GAR is nothing but a guideline or a framework. The tax officials will be using the GAR framework to identify whether you are involved in a tax avoidance. Simple. And be very careful with the GAR, by the way. Be very careful with GAR. Why? Very recently in one of the Supreme Court judgment, GAR was mentioned. I hope all of you know this. In one of the Supreme Court's judgment, GAR was mentioned. So please be very careful. Right, sir? Which particular judgment? Tiger Global case. Tiger Global case. Tax issue. Right? So please be very careful. So what is this idea of a GAR here? Let's imagine. I'll give you an example. Please understand this. Let's imagine I own an entity. This is right a setup outside SEZ. Just to make you understand, by the way, there is special economic zone. I've set up a manufacturing unit, company A, outside SEZ. Now I will manufacture the product, export the product, generate profit, and I'll pay corporate taxes to government. Is the system okay? I'm manufacturing outside SEZ. I will export, generate profit, sell it, right? Generate profit and pay corporate taxes to the government. Now, I feel I'm paying too much taxes. And I know every one of us thinks that. Every one of us. And every one of us wants to pay as much less tax as possible. In fact, zero. And I know somebody will go a step forward also and simply say, sir, I don't want to pay. Can the government return the money? Without paying, can they return the money? That will be a doubt. So every one of us wants to pay as much as possible lower taxes, 0 rupees also. So let's assume I am also of the same thinking. I am also one of you. I also don't want to pay so much amount of taxes to government. So what will I do? This is the company A owned by me. I will open one more company in the special economic zone. Right? I'll open one more company in the special economic zone. Why? What is the objective? Special economic zones earlier, not now, but earlier used to provide 100% tax exemption for the first 5 years. Correct? All of you know this, right? The special economic zones, right? They have a provision where for the first 5 years, you can claim 100% tax exemption. 100% tax exemption. So look at this. I will produce earlier, I will produce a good at 100. I will export it at 500. I will make a profit of 400. Simple, correct? I will produce at 100, export it at 500, make a profit of 400. I will pay taxes on 400 rupees. Now, I will shift the system. I will produce it at 100. I will sell it to another company at 200. I will sell it to the another company B, owned by me only, at 200. Now, I will export from the company B to the external market at 500. Now, let's do the equation. Let's do the calculation, simple calculation. In the second case, can I simply say, right, do let me know whether this is clear or not. Second example, company A will earn a profit of 100 rupee and company B will earn a profit of 300 rupee. Is it okay? Right? Please do let me know, all of you. Wake up and please do let me know. In the second example, company A will earn a profit of 100 and company B will earn a profit of 300. Now, A will pay the corporate taxes as usual. As usual, they'll pay, let's say, 30% corporate taxes. What about company B? Company B is set up in the special economic zone. And in the special economic zone, you are saying for 5 years, you don't pay any kind of corporate taxes. So can I simply say the company B will pay 0 rupee taxes, company A will pay 30 rupee taxes. Now, what was the earlier taxation on company A? Earlier, company A, if it has directly exported, if they export directly, 100 rupee, 500 rupee, they would earn a profit of 400. They will pay at 30% 120 rupee taxes. Now see the difference. Right? I hope you understand. See the difference now. Have I avoided the taxation? Do let me know. Have I avoided the taxation by manipulating the taxation system? Yes, there is a manipulation of the taxation system. So when I submit these particular documents to you, you are the tax official. You have become IAS. You are the commissioner of, right, let's say the taxation in that particular region. I will come to you and I'll tell you, you remember, I used to teach economics to you and now you will basically say, sir, how can I forget? you used to make me sleep so nicely in the classroom. That will be your argument. You are the faculty who made me sleep so nicely. Even in the evenings or let's say night, whenever I used to feel restless, whenever I did not get sleep, I would switch on your video. Automatically within 5 minutes, I would start snoring. Right? You will basically say, so I'll say, yes, I'm the same person. So please take, these are the documents. I'm filing the taxes. These are the documents. Now, you will look at the documents. You will say company A is selling it to company B. Who is the owner of company A? I'll say me. You will ask me, who is the owner of company B? I'll say me. Don't you think the next question that you will ask is, sir, okay, you are the owner of A and B. But why is company A selling the product to company B? Please tell me what is the commercial argument there. What is your commercial argument? Right? Is there any commercial substance in this kind of an arrangement? Is it okay? All of you are able to understand the logic here? Is there any commercial substance in the arrangement? Or you have made this arrangement in order to avoid taxes? Right? So you will come to a conclusion. You are going to use the rules of GAR here. You are using the rules of GAR and you will come to a conclusion. This arrangement that is existing between A and B, it is not focused on commercial argument. It is to avoid taxes. Is it okay? Everybody is okay? This arrangement is for avoiding taxes. And you will call such arrangements. You will call such arrangements as impermissible. Remember this. You will call these arrangements as impermissible arrangements. IAA, impermissible arrangements. And once you determine that this arrangement is an impermissible avoidance arrangement, whatever tax benefit I enjoyed earlier, that particular tax benefit will be withdrawn. Is everybody okay? Right, don't worry. We are very close to your dinner now. Very close. Don't worry. Right, so argument is you have used a GAR framework. You have classified this arrangement that is A selling to B as an IAA. And once you have decided that it is an IAA, what you will do? You will basically tell this particular company, that is the company B also, you enjoyed a tax benefit. What was the tax benefit? 30% corporate taxes you are not paying. Now, because you have purchased from A, which is an IAA, impermissible avoidance arrangement, now pay taxes on your profit as well. So instead of 0 rupees, now on 300 rupees, 30% corporate taxes will be imposed and collected. So 30% of 300 will become how much? 90 rupees. So 90 plus 30. Now have a look at it. Can I simply say what was the original amount of tax? 120 rupees. Now the same amount of tax will be recovered from the tax official. Same amount of tax will be recovered from the tax official. The provision or the framework that they use to identify such arrangements is called as GAR. Right? It is essentially called as GAR, General Anti-Avoidance Rules. Done? Everybody is okay? Now, let's take the dinner break. Before that, anybody has a doubt? Do let me know. Anybody has a doubt or a confusion regarding whatever I've discussed? This is the time you ask questions. When I'm discussing, don't keep on typing. Now ask me. Sir, if central government is giving 100 crore to the state government and state government is building infrastructure, then we consider under, so Indian territory, so we can consider change in asset. My dear, the budgeting is done for the central government. Central government. Budgeting is done for the central government. So the central government's assets don't change. That's the reason we put it under the revenue expenditure, not under capital expenditure. Okay. Any other doubt? Any other doubt? Okay, done. Let's do one thing. Is IAA for all the SEC companies? My dear, listen to me. You're not understanding the concept correctly. IAA is not applicable for SCA. The example that I gave is a kind of arrangement. an arrangement where I'm manipulating the tax system. SEC is just an example that I'm taking here. Don't simply attach GAR with only SEC. No, that is not the objective. Objective is to make you understand what is an impermissible avoidance arrangement. That was the objective. Is it okay? Don't simply say, in that case, GAR is only applicable SEC. No, no, no. That is a different objective altogether. Okay. Okay, done. So let's take a pause now. Time is 8:10. Time is 8:10. We will restart the session. I'll write it here. Right? We will restart the session blank. Okay. The restarting of the session starts. Session or restarts. Session restarts at 8:40 p.m. Half an hour is sufficient. Half an hour is sufficient. So 8:40 p.m. Let's meet back at 8:40 p.m. again. And somebody was asking, the session will continue till what time? Till we complete banking. We'll complete banking, then we will stop the session today. Okay. Take a dinner break now. Come back at 8:40 p.m. Okay. Good evening to you, all of you. Welcome back. Am I audible and visible? Do let me know. Those who are present in the session, please do let me know. Am I audible and visible? Great. Let's start, or let's continue the discussion. So, what we are discussing is taxation, by the way. We are basically looking at the concepts in taxation. In taxation, we have covered the direct taxes. Now, we are supposed to start with indirect taxes. We are supposed to start with indirect taxes. Let's start. First and foremost, indirect tax, what is the meaning of it? I'm pretty sure all of you remember this. Indirect tax essentially means the incidence and impact of taxation is on two different taxpayers. Incidence is on one, impact is on somebody else. Best example, VAT, value added taxation. Earlier it was VAT, now the VAT has been brought subsumed under the concept of a GST, goods and services tax. Now, earlier we had a VAT. Please understand what was the taxation system earlier. Whenever there was a production activity, the center used to impose a tax. On production activity, center used to impose a tax, and that particular tax was called as excise. And whenever there was a sales of the product, the state government used to impose a tax, and that was called as a sales tax. Is it okay? Everybody is able to understand? Simple. Whenever you produce something, the center will impose a tax and collect it. That is basically the excise duty. And the second one is you sell the product in the market, the government will impose a tax and collect it, but that was called as a sales tax. But under the Constitution of India, that is essentially the 7th schedule. Under the 7th schedule, you have a division of taxation powers. Sales tax was imposed and collected by the state, and the excise duty was imposed and collected by the center. But the problem was there was a lot of cascading effect. Cascading effect simply means a tax is imposed on a tax. Is my point clear? A tax is imposed on a tax. That is called as a cascading effect. For example, somebody will ask me, sir, what do you mean by cascading effect? Explain it to me. Just now I've done my dinner. I'm finished with my dinner. I am back now, right? Both the hands are free now. I'll start typing. What is cascading effect? Cascading effect simply is the idea where, let's imagine a situation. A will purchase a product from B. I'm giving you an example. Understand the example, okay? A will purchase a product from B. And let's say the actual cost of the product is 100. Now A will collect a tax of 10 rupee. B will pay 10 rupee to A. A will transfer the tax to government. Is the step 1 clear to all of you? Please do let me know. Is the step 1 clear to all of you? And please heed to my advice. Listen to my advice. I know a lot of you have finished dinner, and that too very heavy dinner. I know that. Now the only way you can remain awake in the next 2 hours is by typing, is by listening carefully. So please keep on typing. And when I say type, for the classroom, don't simply say, sir, you told me type. I opened my smartphone and started typing in Telegram. I started typing in WhatsApp, etc. No, I don't want that typing. I want you to type the answers, alphabet S, alphabet Y, etc. Step 1, B will purchase, pay 100 rupee, but at the same point of time, tax of 10 rupees collected and 10 rupee goes to the government. Now B will add value, let's say labor, profitability, etc. So 100 rupee, the cost of input. B wants to earn a profit of, let's say, 20 rupees. Now the selling price ideally should be 120. Simple, the selling price ideally should be 120. But if the company B, if the seller B doesn't get this particular 10 rupee back from the government, I repeat, if the seller B or the company B doesn't get this particular 10 rupee taxes that they have paid on the inputs back from the government, what will the seller do? Seller essentially will transfer this particular 10 rupee to customer. Simple, everybody is okay? They will transfer this particular tax burden to customer because the idea is simple. Indirect taxes ultimately have to be borne by the customer. They will have to be paid by the customer. So this particular company B, which should have sold the product at 120 plus taxes, now they will include this particular tax of 10 rupee on the input. The selling price becomes 130. Now, when they want to sell it at 130 to the customer, the state government will come into picture. Is everybody okay? The state government will come into picture. The state government also says, you are selling in my state, so pay taxes. You are selling in my state, so pay taxes. Tax of how much? Let's assume 10%. Let's assume 10%. So don't worry about the market price now. But you tell me, when in the step number 2, I hope you understand, in the step number 2, when 10% tax will be imposed on 130 rupees, can I simply say this is a tax on tax? Everybody is okay? Do let me know in the chat section. This is nothing but the tax on tax. Let me use a different color. This calculation is nothing but tax on tax. Everybody is okay? This is called as a cascading effect. This is essentially cascading effect. So earlier under indirect taxes, there was a lot of cascading effect. That is the reason the states came together. Rather than having sales taxation, they replaced the sales tax with another tax. And that was called as value added taxation. Value added taxation, VAT system. States replaced their sales tax. They introduced VAT. And what was the logic of VAT? Whatever taxes, I repeat, whatever taxes you pay on the inputs, I repeat, whatever taxes you pay on the inputs will be credited back to you when you sell the output. Meaning of that is very simple. In this example, please look at step number 1. If I'm the company B, I will purchase a product from you. On my input, can I say I have paid a tax of 10 rupee? Correct? On the input, can I simply say I have paid a tax of 10 rupee? Now, when I manufacture and sell the product in the market, that 10 rupee will be given back to me. Who will give it? Government. The government will simply credit the 10 rupee back to me. And because I'm getting a credit of 10 rupee taxes from the government, don't you think in the step number 2, I will not be including the 10 rupee in the calculation of selling price? Everybody is okay? I will not include the tax of 10 rupee in the step number 2 while calculating the selling price. This is called as input tax credit. This is called as input tax credit, in short, ITC. In short, ITC. I know a lot of you, when I say ITC, you will remember something else. Don't remember that particular product. ITC here is an input tax credit. Everybody is okay with the idea of ITC? So we implemented the taxation of VAT. We implemented the system of VAT. And we felt that the cascading effect completely would be addressed. But even after that, the cascading effect was not eliminated. When the products were sold across the state border, that is interstate trade and commerce, when that happened, again there was a cascading effect. So finally, what did the government of India do? The government of India basically said, there are too many problems with indirect taxation structure in India. Too many problems. So we need to simply restructure the indirect taxation altogether. And that actually led to introducing the GST, Goods and Services Taxation. What is the important features associated with the GST? 1. GST essentially will be a dual tax. It is a dual tax. What do you mean by dual tax? Whatever is the rate of GST, it will be divided into 2 equal parts. I repeat, whatever is the rate of GST, it will be divided into 2 equal parts. Right now, what are the rates of GST? Right now, we have only 2 rates. Most important, by the way. We have only 2 rates. One is 5%. Please have a look at the table now. We have only 5%. We have 18%. Now, please listen to me carefully. Your books will say we have 5, 12, 18 and 28. This was true until recently, But now we have rationalized the GST structure. We have 5 and we have 18. There is one more also, 40%. Somebody will basically say later, but sir, there is also one more 40%. 40% is a specific tax rate applicable for some of the goods, not all of the goods, some of the goods, that is sin goods. There are certain sin goods or demerit goods, 40% is applicable only for them. Whereas the most important rate of taxes under the GST right now is 5 and 18%. Now I said we follow a dual GST structure. Meaning of that is, take any GST rate. Okay, take any GST rate, you divide that into two equal parts. 5% divided into two equal parts, 2.5 and 2.5. 2.5 will go to the central government, that is called as CGST. The second 2.5 will go to the state government where consumption takes place, where the consumption of the good or service takes place. That is SGST component. And that is a precise reason, because the SGST will go to the state where consumption happens. Because the SGST goes to the state where consumption happens, GST is also known as a destination based tax. Is everybody okay with this? GST is also known as a destination based tax. That is, the state where consumption happens will get the SGST component. If it is produced and consumed in the same state, that is intra, no problem, same state will get the SGST component. If the production happens, let's say in UP, and consumption happens in Bihar, then the Bihar will get the SGST component. CGST anyways, in any case, will go to central government. But please understand the idea here. Instead of using the term GST whenever it is an interstate trade and commerce, we use the term IGST. We use the term IGST, integrated GST. Integrated GST essentially refers to the fact that the product is manufactured in one state, consumed in another state. So far everything is clear. Next important point, it's a dual tax, taken care. IGST and GST addressed. No cascading effect, that is whatever taxes you have paid on the input. I repeat, whatever taxes you pay on the input. Now when you sell the output, you will get the credit of it. That is essentially ITC, which was a feature of a VAT, is continued under GST. Because VAT has been subsumed, I repeat, VAT has been subsumed under GST. Same, right, whatever was the ITC model under the VAT is continued under the GST model as well. Everybody is okay? Next important point. The government of India, in order to implement GST, had to amend the constitution. Why? What was the requirement of amendment to the constitution? You are simply taking the taxation which have been provided to the states under the Schedule 7 of the Indian Constitution. Right? The states have been allocated taxation powers according to the Constitution. You are taking away those particular powers. You are simply subsuming that under the GST. So obviously the government of India had to amend the Constitution. And that's the reason 115th amendment was introduced. 115th bill, Constitutional Amendment Bill was introduced. There was, right, let's say the Lok Sabha elections were conducted. Obviously the bills elapsed because of that. Again, the government introduced 122nd Constitutional Amendment Bill. It was passed as 101st Constitutional Amendment Act, and thereafter we have implemented the GST from the 1st July 2017. From the 1st July 2017. Everybody is okay? One more feature of the GST is creation of national market. What is the meaning of national market? Irrespective of the product being sold in any state, whether it is being sold in Karnataka, Punjab, right, or let's say West Bengal, Uttar Pradesh, Tamil Nadu, somebody will say, sir, I'm from Andhra, include me also, let's say Andhra. And somebody immediately will say, sir, why are you including only Andhra? Include Telangana also. Okay, Telangana also. So it doesn't matter whether the product is sold in state 1, state 2, state 3, etc. The tax rate shall remain same. Is everybody okay? tax rate shall remain same irrespective of the state where you're selling it. So argument is simple here. It is going to create a national market. Then everybody is okay. And again, understand the next point as well. Just because I'm saying it is creating a national market doesn't mean the market price remains the same. Is it okay? Right? Doesn't mean market price is going to remain same. No, market price for many of the products will change, because if the manufacturing is done in one state and you are moving it across the state border and selling it, let's say 1,000 kilometers away, cost of transportation, warehousing, etc. will add to market prices. Everybody is okay? Everybody is okay with the model here? So these are some of the very important features of the GST. Next, there is one constitutional body under the GST, that is essentially GST Council. Article 279A. Remember this. Article 279A. It's a constitutional body, GST Council. The GST Council, it is headed by the Finance Minister. The GST Council will have representation of the states, that is the Finance Minister, the Revenue Ministers of the state government, as well as even the representatives of the the legislatures of union territories. If the union territory has a legislature, even that is having a representation in the GST Council. It will be chaired by the Finance Minister. The decisions in the GST Council are generally supposed to be taken through consensus. If no consensus is arrived, you essentially go for voting. And when you go for voting, the voting power is divided between the center as well as the states. 1/3 of the voting power, 33.3333%. Again, I'm saying 33.3333%. Right? Put a bar above that also. So 33.3% of the votes are given to the center. Remaining 2/3 of the votes are equally divided amongst the states. So if you want a decision to be done, after voting, if you want the decision to be done, you require at least 75% of present and voting. You need a majority of at least 75% of present and voting. And to start the deliberations in the GST Council, you need essentially a quorum of minimum 50%. Done? Everybody is okay with the GST Council now? Everybody is okay with the concept of GST Council? Now, apart from this, in the context of GST, there is also one more important point, GST network. Or else, they will simply write GSTN. GST network. What is the idea of a GST network? This particular entity, which is a non-profit authority, right? It's not focused on the profit activity. So it is a non-profit organization which has been set up by the government under the Companies Act of 2013. Now this entity will provide all the infrastructure requirements for the effective implementation of GST. Whatever is the requirement under the GST implementation, for example, you need to set up a portal so that people will file GST returns, right? It will provide it. You need to ensure all the taxpayers under GST are registered. It will take care of it. So all the back-end work, infrastructure backbone, all the back-end work or the infrastructure backbone is provided by the GST network. And please remember this, right now 50% of the GSTN is owned by the center, 50% is owned by the states. Earlier it was different, ownership was different. Right now 50% of the ownership with the center, 50% with the states. Everybody is okay? And finally, one more current affairs pointer here, National Anti-Profiteering Authority. National Anti-Profiteering Authority. What is this idea of a National Anti-Profiteering Authority? Whenever a seller makes unreasonably very high profits, unreasonable, excessive profits, that is called as profiteering. Is it okay? That is called as profiteering. Somebody will ask me, sir, what do you mean by unreasonable, excessive, etc.? Right? What is the meaning of it? Meaning is very simple. Imagine right now, the actual selling price, I want to sell it to you at 100 rupees. Okay? I want to sell the product to you at 100 rupees. The GST rate is 18%. Automatically, what will be the market price? The market price will be 100 plus 18, 118 rupees. Correct? The market price will become 118 rupees. Now, government will reduce the GST rate from 18% to 5%. Government will reduce the GST rate from 18% to 5%. What I will do is, I will reduce my selling price, that is the MRP, from 118 rupees to 110 rupees. Now all of you do the CSAT calculation and tell me, have I made unfair, excessive profits by reducing the price from 118 to 110 rupees? Yes or no? I know some of you will be thinking, sir, what is this? In addition to economics, now I am supposed to do CSAT also. Right? Until now, CSAT was my weaker area. Now even economics has become my weaker area. Right? So argument is very simple. If you reduce the tax rate from 18% to 5%, the selling price or the MRP should have changed from 100 rupees to 105. Is it okay? It should have been reduced to 105. If I reduce it to 105, I'm not going to lose my profit because within 100, profit is already included. Within 100, the profit component is already there. But what have I done? Have I reduced it to 105? No, I've reduced it from 118 to 110 rupees. And I'm telling you, when you come to the shop, I will tell you, thank the government. They have reduced the GST rate. That's the reason last month you paid 118. Now you are paying 110 rupees. You also become very happy. You will also look at the MRP and you will say, yes, the prices have come down. Thank the God, thank the government, etc. But in this particular process, I have not transferred the complete benefit of tax reduction to you. Correct? Everybody is okay? Right? I'll repeat the statement. In this particular process, I've reduced the price, no doubt. But I've not transferred the complete benefit of tax reduction to you. And I'm earning more profit. This is profiteering. Simple. This is profiteering. So Government of India says profits are allowed. Profiteering is not allowed. Is it okay? Profits are allowed. Profiteering is not allowed. That is the reason earlier the Government of India had set up one authority, National Anti-Profiteering Authority. Right? National Anti-Profiteering Authority. But that particular authority now has been closed. The cases were transferred to Competition Commission of India. Competition Commission of India. From the Competition Commission of India, the cases were transferred to GST Appellate Tribunal. From the 1st April 2025, I repeat, from the 1st April 2025, Government of India simply said, no new anti-profiteering cases will be taken up. I'll repeat the statement. From 1st April 2025, no more new anti-profiteering cases will be taken up. And those are wondering why, what is the logic behind it? Government simply argues that the private sector which is present, they are competing with each other. Correct? They are competing with each other. And when they are competing with each other, automatically, if one company doesn't transfer the complete benefit to you, others will completely transfer the benefit to you. Their market prices will fall down much sharper compared to this seller. So you will be shifting from this product to somebody else's product. They will end up losing the market share. Right? So everybody is able to understand the logic here. That's the reason, right? The Government of India now says there is no point of continuing with the idea of anti-profiteering. Market will take care of itself. Let's remove, right, this particular process altogether. Done? So these are certain important points in the context of goods and services tax. Finally, under taxation, you can have a sigh of relief now. You can have a big sigh of relief. Finally, under taxation, you're like, done. Taxation is done. So finally, under taxation, one concept, graphical representation, Laffer curve. Right? In the first session, when I started, there was one student who put a comment, sir, cover all the graphs right now. Cover all the graphs which are relevant for UPSC GS paper 3. My dear, please understand, we will cover those graphs, but under respective chapters. under respective chapters. Okay, so let's start. What is Laffer curve? Laffer curve basically provides a connection, that is a representation between the tax rate as well as the tax proceeds. It provides a representation between the tax rate as well as tax receipts. That is, if you increase the tax rate, the amount of tax revenue collected will increase, but only up to one level. Only up to one level. But when you increase the tax rate beyond that particular optimal tax rate, optimal means at the tax rate where the collection is the highest. Where the collection is the highest. That is, for example, imagine this is the optimal tax rate. Along x-axis, you are representing tax rate. Imagine this is optimal tax rate. That is, at this particular point, the tax revenue that you have collected are peaking, highest. Peaking means highest. After this, if you increase the tax rate, people will start replacing work with leisure. People will reduce the work. They'll start taking more and more rest. Why? They will simply say, what is the point? I'm giving most of the earning in the form of taxes to government. So no point in working more and more. Reduce the work. Take more rest. So as a result of that, the amount of taxes that you collect will keep on decreasing. And finally, if you have 100% tax, imagine 100% tax. If I were to ask you, what if government will impose and collect whatever is your earning in the form of tax? Will anybody go to work? Will any one of you go to work? You will only simply say, sir, what is this? This is not democracy. You will simply say, this is not democracy. And some of you will be writing the petition already. Sir, wait, I'm typing petition to Supreme Court of India. Tomorrow morning, this will be the first filing I do, and I'll ask the Supreme Court to hear it on urgent basis, you will say. Argument is simple. Don't do that, by the way. Right? No, not government is not doing it, by the way. So what if government will impose 100% taxes from you? Whatever you're earning, you'll pay to the government. So you'll simply say no point in working. No point in working means zero income. Zero income means you might have 100% tax, but you will not collect any kind of a income tax. So everybody is able to understand why it will start from the origin like this, why the graph will start from the origin, and why it will hit the x-axis again. This representation is called as, right, the Laffer curve. This is called as Laffer curve. Is everybody okay? Please do let me know. Is everybody okay with the discussion? Can we go forward? Congratulations. Pat yourself on the back. Not too hard, by the way. And don't ask your friend or your relative, somebody who's sitting in the room, to pat. They will not pat. They will hit you very hard. So pat yourself on the back. Congrats, you are done with one more chapter. And before I go forward, those who have joined late, here is a reminder. Tomorrow, on these particular chapters, tomorrow I'm taking a MCQ discussion on the platform. MCQ plus PYQ discussion on the platform. Tomorrow, that is 18th February at 7 p.m. and 19th February again at 7 p.m. Please scan the QR code, join the sessions. Please come prepared. And those who are asking, sir, PPT, will I get it with annotation? Yes, you will get it with annotation. Somebody will say, sir, can I get the notes of this? I'm saying, wait, you will get even the notes also. So have patience, right? So I'll give you the notes also. I'll give you the PPT also. Let me see how many of you prepare and come to the test tomorrow. Okay, with that caveat, let me get back to the discussion. Next important chapter, banking. Next important chapter, banking. And from prelims perspective, I'm pretty sure all of you know this. This is one of the most important chapters. One of the most important chapters. Because every year, four questions, at least 4 questions are asked from this. Let's start. So in the banking, let me start with the basic idea, money. What do you mean by money? All of you want money. Correct, all of you want money. How much money? Unlimited, you will say. Sir, as much is there. Right? More I get, more I become happy. You will basically say, my satisfaction with the life is directly related to the amount of money that I'm earning. My life essentially looks like only the first half of the Laffer curve. Only the first half of the Laffer curve. Along the x-axis, you write money. Along the x-axis, along the y-axis, you write happiness. Only the first half is my life, you will say. Don't worry about the second half. I will never enter into the declining zone, you will say. But the argument is simple. What do you mean by money? Money is a medium of payment. Simple. Money is nothing but a medium of payment. That is, you purchase goods in the market, you purchase services in the market. You will have to pay something in return. Nobody is going to give it free of cost to you. So you'll have to pay something in return. For example, even this particular class, it is not free of cost, by the way. I'm expecting return from you. What is the return? Likes, comments in the section after the video is uploaded, and more importantly, you people clearing the prelims, mains, and interview. That is my returns, by the way. Done? Okay, so come back on a lighter note, but on a lighter note, don't take it too seriously. Again, when I say don't take it too seriously, right, the jokes part, okay? Let's start. Money, medium of payment. What is the idea of a medium of payment? Earlier, what used to happen was we followed a system called as a barter system. We followed a system of payment which is called as, or which was called as a barter system. Barter system essentially is a right exchange. I will give you certain goods and services or services, and in return, I will get certain goods and services from you. But the problem with the barter system is there is one problem, multiple issues are there. The most important issue with the barter system is double coincidence of wants. Double coincidence of wants. Sir, what do you mean by double coincidence of wants? Let's imagine I have produced this particular stick it post. Right? Everybody can see? Right? Let's use certain props so that it becomes easier for you. I have produced this. I want to sell it in the market, and in return, I want to purchase, right, let's say a book. In return, I want to purchase, right, a book from the market. Now, I will have to find somebody in the market who has produced the book. They want to sell the book and they want to purchase this particular stick-it note. Don't you think this is very difficult to find? Simple. It is very difficult to find because you might have a book, you want to sell it, but you want to purchase coconut. You might have a book, you want to sell it, but you want to purchase, let's say, apple. So there is always a problem in the barter system, double coincidence. Sir, only one problem? No. Right? Let's say storage value. Storage value. Whenever you follow a barter system, imagine there's a perishable commodity, perishable product. The perishable product essentially in the market, by the time you find somebody, if this is a perishable product, it would have lost the quality and quantity. Everybody is okay with this, right? So there were a lot of issues with the barter system. So we shifted from this kind of a barter system to, right, commodity money. I'll go to the earlier parts also, don't worry. We shifted to the commodity money. Sir, what is a commodity money? In commodity money, a commodity means anything that is produced which is precious in nature. Simple. Anything that is produced and which is very precious in nature. For example, gold, commodity. Right? Crude oil, commodity. Agriculture products, commodities. Correct? Now, in case of commodity money, we started using the commodity itself for making a payment. Simple. We started using commodity itself for making a payment. For example, gold coins. For example, the bronze coins, silver coins, shells, beads, etc. They were basically used as, right, money for making payment. Is everybody okay? Please do let me know. And these particular commodities, because they were very precious, had value in the market, they were used as money, which means the commodity itself has a lot of value. The commodity which is used to make money, it is having lot of value. The money had intrinsic value. Is everybody okay? The commodity, right? The commodity money has very high intrinsic value. For example, right? Somebody will ask me, sir, very difficult to understand. Explain it. For sake of example, by the way, have a look at this. Can everybody see this? Do let me know. Can everybody see this? And again, fake. Don't take a screenshot and share it with the income tax department. Even if they come, they will not get anything. Okay. Right. So, right. Listen to me carefully. Imagine this is used as a commodity money. Because the money is made up of gold. Can I simply say this money has very high intrinsic value? Right? Yes or no? This money has very high intrinsic value. Done? Everybody is okay? So that was the idea. The money itself is made up of a commodity which will have very high intrinsic value. But please understand, commodities are very precious, very limited in supply. Obviously, what we did was we moved away from the commodity money to the idea of a fiat money. Today, what we use is essentially fiat money. Right? We use fiat money. For example, the currency coins that are lying on your table. I know some of you might be playing with the currency coins right now. What is that? You'll be creating a stack, one above the other, one above the other. You'll be creating a stack, making it fall, again creating a stack. You'll be playing with that, I know that. Or somebody will be sitting with the bundle of currency notes and they'll be waving like this. Right, sir, बहुत गर्मी लग रही है. So I'll wave with bundle of currency notes. My dear, whether that or this, it is basically, right, the fiat money. Fiat means order. Simple. Fiat means order. Through the order of the government, this particular money will be issued in the market. The money has value in the market because of order of the government. If you simply take out the order, if you simply withdraw the order, this simply remains a piece of paper. Everybody is okay? Simply remains a piece of paper. For example, right? I know a lot of you will experience this. Sir, what is the meaning of piece of paper then? Let me give you an example. Imagine tomorrow you're sitting quietly, your father is passing by, and you know your father is looking at you only. Now you have to prove that you are doing some work, and that too related to UPSC. So what you will do? You will take out some very, very old book, very big book, because you want to show to him that you are reading a very big book. So you'll take a very old, very big book, and you suddenly open. And there you find one old 500 rupee currency note. You remember before 2016? Before 2016, there used to be a different kind of 100 rupee currency note. Now imagine that is there. Suddenly you will close the book. You will forget about, right, looking at the currency note, you will close the book. Why? If your father sees that particular currency note, your dinner will be cancelled tomorrow. Right? He will call everybody. First, he will call your sister, your mother, right, your brother, and basically start scolding you in front of everyone. And your father will say, I travel on cycle because I have to feed all of you people. For 20 rupees, while eating in the canteen, I'll think of it 100 times. Look at this fellow. He has wasted the 500 rupees. He has kept it in the book. We could have simply given it, got an exchange of 500. Now nobody will accept, etc., etc. So argument is, right, that particular 500 rupee currency note, it is worthless now. Why? Why is it worthless? Can I simply say it has become worthless because Government of India has taken the order back which used to provide a value of 500 to this piece of paper. Demonetization. Correct? Demonetization. That is withdrawing the value. Taking the value back. Through the order, they have withdrawn the value. Is everybody able to understand? Please do let me know. Everybody is okay? Through the order of the government, the value will be given. Currency notes that you have, currency coins that you have, all of these are examples of fiat money. Fiat money. Now somebody will ask, sir, I have 2000 rupee currency note. Right? All of you remember the 2000 rupee currency note? Pink, purple color 2000 currency note. If you ask me, is it a fiat money even today? It is a legal tender even today? Yes. RBI has given this particular clarification very recently. Very recently this clarification has been provided. The 2000 rupee currency note that you have is a legal tender even today. But you will say, sir, nobody is accepting this. Right? I heard your name. I heard you say that. I went to market. Nobody is accepting. Everybody is looking at me and they are laughing. That too in a not right way. They are laughing at me sarcastically. Even my parents are looking at me and simply saying, right, you are UPSC aspirant, you don't know this note is not acceptable, etc. Then don't worry. Simply return it to Reserve Bank of India. RBI will give you 2000 rupee in your bank account. Is everybody okay? Right, don't worry. Simply transfer that or send it to RBI office. They will transfer the 2000 rupee, right, into your bank account. Of course, when you send it, please send your account details also. I hope you understand. Simply don't put that particular 2000 rupee note in an envelope and send it. How will RBI come to know what is your bank account number? How will RBI come to know what is your bank account number? They will not come to know. Right? So send your account details. Right? Send it in the letter. There are offices which have been identified. Send it. They will transfer that 2000 rupee into your bank account. Everybody is okay. Everybody knows the idea of the fiat money now. Fiduciary money. Fiduciary money. What is this idea of a fiduciary money? Example, a check. Example is a check. Check is an example of a fiduciary money. Fiduciary money basically is a money which is basically accepted in the market based on the confidence of the seller. It is a type of money, but its acceptance depends on the confidence by the seller. Right? That is, if I sell you something, I want you to make a payment in fiat money. You transfer through UPI, you transfer through Google Pay, etc. But if you take out a checkbook and try to write a check, I will simply say, no, I don't know who you are, you don't know who I am. Right? Sorry, I will not accept it. You might simply say, sir, I'm your student. Right? Have you not seen in the chat box? I keep on typing lol, etc. in the live session. I am that person, sir. I am the person typing lol, you will say. I will say, sorry, but I don't know you. You might be typing lol. But no, I don't know you. Please make a payment in the form of fiat money, I'll say. Right? So argument is simple. When you want to issue a check, that is a mode of a payment. And that is a mode of a payment. When you want to write a check, acceptance of this form of a payment depends on me. My confidence on you. Right? Whether you have a bank account or not, I don't know. Whether you have a bank account but money is there or not, I don't know. All of you are basically reading and hearing about the Mr. Rajpal Yadav's case. Correct? I'm pretty sure all of you have come across this. That is, when you issue a check, what is a guarantee that there are funds in the bank account? I hope you understand. So, logic is simple. Those kind of money, that kind of a money is called as a fiduciary money. You issue a check, I will take the check, I will deposit in the bank. Now, this will be converted into fiat money. I will be given fiat money from the bank. That is called as a fiduciary. Finally, commercial bank money. What is this idea of a commercial bank money? Commercial bank money, please understand, let me explain this. There is a system called as fractional reserve system. Fractional reserve system, FRS. What is this idea of a fractional reserve system? Under fractional reserve system, the banks will collect deposits. Part of the deposit, they will have to keep it with themselves and deposit with RBI. That is reserve. Remaining part, they are allowed to lend. Is it okay? Very simple idea. Imagine I will take 100 rupees and deposit that with the bank. The bank cannot take all the 100 and lend in the market. Not allowed. Why? RBI simply says it's too risky. What if you take all the 100 rupees, give it as a loan to Sri Vijay Mallya ji? Think of it. What if a bank gives all this 100 rupees as a loan to Sri Vijay Mallya ji? Vijay Mallya ji will go and sit in England tomorrow. You don't know whether they are going to return the money or not. You want the return, but they will not repay. What will you do? Right? So I hope you understand. The RBI simply says don't take a risk. Part of the deposit you keep with yourself. Right? That is called as CRR. We'll understand later. And part of the deposit you keep with yourself. That is called as SLR. And part of the deposit you give it to me. That is called as CRR. Remaining amount you can lend. Let's assume CRR and SLR is 10 rupee. Remaining 90 rupees the bank can give in the form of a loan. This kind of a system is called as fractional reserve system. Is everybody okay with the idea of a fractional reserve system? But what is a connection? Somebody will be thinking, okay, understood. But what is a connection to commercial bank money? My dear, commercial bank money refers to the credit or the loan that has been created by the bank. I repeat, it refers to the credit or the loan that has been created by the bank. That is called as a commercial bank money. Is everybody okay? For example, here Can I simply say the bank has created a loan of 90 rupees? Clear? Everybody is okay? Here, the bank has created a loan of 90 rupees. That is a commercial bank money. Bank is not printing money. The bank here is not printing. Only RBI is allowed to print. Bank is not printing money. Bank is simply collecting deposit, creating a loan of 90 rupee. That is the commercial bank money. Is everybody okay with the discussion? Please do let me know. So let's move up in the order now. What is money? Money is a medium of exchange. Why do people demand money? Why will you demand money? Why do I demand money? One, we will want money because we want to purchase goods and services for which we want to pay money. We want to hold money because we are thinking that there could be emergency in the home. Precautionary. Emergency. Suddenly there is an emergency. You need money to spend. That is the second reason why will you demand money. And the third one is the speculative motive. Speculative investment purposes. Investment purposes. That is, you want to purchase when the bonds, let's say bonds, when the prices will go down, and you want to sell them when the prices are higher. So you will hold on to your money when the prices are high. You don't want to purchase. Why? You want to purchase when the prices are low. Buy low, sell high. Speculative. For these purposes, people will demand for money. And the functions of the money, I've given you some of the functions here. Primary and secondary. Have a look at this. Primary and secondary. What is a primary function of money? It is used as a medium of exchange. And some of you will be thinking, sir, what is the meaning of a primary and secondary function? Primary means, in the first place, why do you need money? What is the function? What defines money? The most important function, why do you need money? That is primary. And out of the primary function, there will be certain derived function. Because there are primary, there will be certain derivative functions. These are called secondary, tertiary, etc. So primary reason, for money, or primary function of money is, one, it is a medium of exchange. You buy something, you pay money. You sell something, you receive money. Medium of exchange. And the second one is, every good and service today can be defined in rupees. Of course, in India, by the way. Of course, in India. Every good and service, whatever is available in the market, everything can be defined in terms of rupees. It can be measured in rupees. These are the primary function of money. But there are other functions which are derived because of primary. For example, deferred payment as well as store of value. What do you mean by deferred payment? You take the loan today, you repay it tomorrow. You purchase something today, for that payment you do in the future. Deferred payment. And that can be defined again in terms of rupees only. That payment can be done again in terms of rupees only. And store of value means what? Imagine I've produced agriculture commodity, perishable agriculture commodity. I will sell it today, I'll get rupees. I can store rupees. I cannot store, vegetables. Correct? I can't store vegetables. I can't store green leafy vegetables. If I store green leafy vegetables in let's say 4 or 5 days, it will be neither green nor leafy, nor can you call it as vegetable. Correct? It is not a store of value. It is perishable. But can I sell this in the market, collect money, store money? Correct? Can I store this particular money for 4 days, for 5 days, for 10 days, for 20 days? Of course, yes. Store of value. Store of value. And I've given you many more functions of money, by the way. Please go through the handout. Please go through the notes. I've given you many more functions. Expect this kind of question in the UPSC examination, that too in the prelims. Expect a kind of question. They will ask you, sir, what kind of question? They will give you, let's say, these 4. And they will ask you, which of the following are the primary functions of rupee or money? Which of the following are secondary functions of money? These kind of questions can be asked in the prelims examination. Be ready for those kind of questions as well. Okay, let's go forward. Now, we have taken care of money. Scheduled versus non-scheduled banks. What is the basic idea of a scheduled versus non-scheduled banks? Under the Reserve Bank of India Act, under RBI Act, there is a schedule, that is Schedule 2. Schedule 2. So under the Schedule 2, if you are registered under the Schedule 2 of RBI Act of 1934, you are known as scheduled bank. If you are not registered, you are referred to as a non-scheduled bank. Lot of these local banks are essentially non-scheduled. Lot of these particular local banks are non-scheduled. But please understand, scheduled and non-scheduled essentially will come under the classification that is commercial bank. What's the basic idea of a commercial bank? The Banking Regulation Act of 1949. The Banking Regulation Act of 1949 simply says, a commercial bank is a financial institution which is involved in collection of deposits and lending activity. Simple. Mobilization of deposit and lending activity. You collect a deposit, you give loan. You are called as a commercial bank. And that is where you need to understand the difference between all these types of banks. For example, I'm pretty sure all of you heard of NABFID. Please do let me know in the chat section, by the way. All of you heard of NABFID? Have you heard NABFID in the context of a commercial bank? Do you think NABFID is a commercial bank? I'm pretty sure you've heard of SIDBI also. Is it a commercial bank? You've heard of Exim Bank. Is it a commercial bank? NABARD. Is it a commercial bank? These are not commercial banks. Why? These are not involved in the collection of deposits from a common man such as you and me, and they're not going to give loans to all of us. I hope you understand. All these are categorized. All of these are categorized under one heading called as Development Finance Institutes. DFI, Development Finance Institutes. They will either use the term DFI or else they will use one more term, AIFI, All India Financial Institute. All India Financial Institute. And basic idea of All India Financial Institute is they are covered. These are basically covered under the provisions of Reserve Bank of India Act of 1934. Right? RBI Act of 1934 only. Done? Everybody is okay? Please do let me know. Everybody is okay with the discussion of a scheduled as well as non-scheduled? Sir, what is the benefit? If you're a scheduled commercial bank, you will get lot of features or assistance from Reserve Bank of India. If you're a non-scheduled bank, so much of, right, let's say, the assistance is not given by RBI. And the role of the non-scheduled commercial banks is very minimal in India. Don't worry too much about it. Role is very minimal. Most of the banking activity in India, commercial banking activity, is done by scheduled commercial banks. Is everybody okay with the discussion so far? Please do let me know. And wake up, by the way. Please wake up. Okay. So now let's enter into the big boss of banking sector, Reserve Bank of India. Reserve Bank of India. Right. So Reserve Bank of India, it is set up under RBI Act of 1934. RBI Act of 1934. It was recommended by Hilton Young Commission. It was recommended by Hilton Young Commission. Okay. Second point. Initially, when it was set up, 1935, 1st April 1935, when it was established, RBI was initially located in Calcutta. Later, in 1937, it was actually moved to, right, let's say Mumbai, and since then, it is there in Mumbai or Bombay. Okay. Earlier, the name was different. That's a reason. Don't take an offense to the reference to Bombay. Okay, that is the basic idea. But please understand, initially the Reserve Bank of India was privately owned. It was privately owned. Later, after independence, in 1949, the RBI's ownership was transferred to Government of India. So, what does it actually mean? Today, if you ask me, sir, who owns RBI? Who is the owner of Reserve Bank of India? It is the Government of India. 100% of Reserve Bank of India is with Government of India. Is everybody okay? So 1949, nationalization of Reserve Bank of India was conducted by the government. Next, What are the important sections of the RBI Act of 1934? I've listed only the important sections, by the way. There are more than 60 sections. I repeat, there are more than 60 sections under RBI Act. Should you remember all of it? No, I've listed only the most important ones. For example, Section 3 talks about establishment of Reserve Bank of India. Section 7 talks about the central government issuing a directive to RBI after consulting it, issuing a directive to RBI in public interest. RBI has to follow it. RBI has to follow it. Section 4 talks about the capital of the bank. Section 8 talks about Central Board of Directors. That is basically the group which will take a decision. Central Board of Directors has 21 members. Remember this also. The CBD has 21 members. According to the Act, 21 members. If there are vacancies, the number could be different. Out of 21 members, we have 1 RBI governor, up to 4 deputy governors of RBI. In addition to this, there are 10 experts who are again appointed by Government of India. There are 4 members, 1 from local boards. There are 4 local boards, again, earlier metro cities. So from these particular metropolitan cities, there is 1 local board in each one of them. 1 representative from each one of them will be present in the Central Board of Directors. Then we have 1 finance secretary and 1 economic affairs secretary. This is basically the composition of Central Board of Directors. So Section 8 talks about composition. Section 17 talks about business to be carried out by RBI. What kind of business RBI has to do? Is it allowed to invest in the stock market? Is it allowed to invest in the bond market? Etc. etc. All of the decisions that the RBI takes, essentially it draws the powers from RBI Act of 1934. Section 21, I think this is at least the 4th or 5th time. Anybody who is attending my special classes or current affairs classes will know this. Section 21 very recently was there in the newspaper in the context of Delhi government. Please focus on that. RBI will conduct the banking affairs of the government. There is a function of RBI. RBI will act as a banker to the government. I'll cover that later, don't worry. RBI will act as, the function is banker to the government. That is done under Section 21 of RBI Act of 1934. Section 22. It is the Reserve Bank of India which has the sole authority to issue currency notes in India. And finally, Section 47, which talks about transfer of surplus. That is, out of the revenues that are generated by RBI, part of the money will be given to Government of India. That is surplus transfer. That is governed under Section 47 of RBI Act of 1934. Is everybody okay with the sections here? Please do let me know. Everybody is okay with the sections? Again, there are many more, but according to me, this is an exhaustive, more than required exhaustive list. More than required, right? So you can basically connect it to a lot of current affairs. That's the reason I'm saying, please go through the list once more. Now, what are the functions of Reserve Bank of India? What are the functions of Reserve Bank of India? The first one, targeting inflation. Inflation targeting. Inflation targeting, that is, I've discussed this earlier. RBI has given the inflation target of 4% plus or minus 200 basis points by Government of India. RBI has to meet this particular inflation target. We have covered it earlier under inflation. Monetary policy. What is this monetary policy? The most important part of RBI, if you ask me. Most important part of RBI. Please have a look at the picture. Right? The monetary policy, also referred to as credit control tool. Credit control tool. Okay. Before I start credit control tool, anybody has any kind of a doubt? 1 hour is over. Right? I hope all of you have understood. 1 hour is over. 8:40 to 9:40. Anybody has a doubt? Satyajit Das. Sir, why surplus transfer is done? My dear, who is the owner of RBI? Who is the owner of RBI? Government of India. So if RBI generates profits, who should get the profits? Government of India. That is the reason part of the surplus, we use surplus but basically profits. Part of the surplus is taken according to the recommendation of Bimal Jalan Committee. It is a transfer to the government of India. Okay. So surcharge is a tax on a tax, not a separate tax, right? No, generally surcharge is imposed in addition to the taxes that you're already paying. The calculation generally is done on an existing tax. For example, listen to me. For example, I'll write it separately so that there's no confusion. For example, let's assume you're paying a tax of 3 lakh rupees. Hypothetically, by the way, you're paying an income tax of 3 lakh rupees. If the government says surcharge will be 10%, how it is calculated? 10% of 3 lakh rupees. You're paying 3 lakh rupees already income tax. If the government says 10% of 10% of income tax, it will be 10% of the income tax that you're paying. This is how generally surcharge is calculated. Okay. Is scheduled bank allowed to invest in stocks? No, my dear. Banks generally don't invest in stocks. That is not their objective. But banks' subsidiaries are there. Lot of institutional funds are set up by the banks. Again, subsidiaries. They can invest. But please understand, banks do not have the objective of investing in the stocks. They can invest in the bonds. That too, more of it in the government bonds. But it's very risky to invest in the stocks. Okay. Any other doubt? Lokesh Karkala. Why coins are minting and not using like 100 rupee coin and selling it to more rupees? My dear, please understand, in terms of coins, right? In terms of coins, the minting of the coins, value of it is very limited. Value of it is very limited because understand the logic also. In order to mint coin, you need a lot of metal, right? Everybody is able to understand you need a lot of metal. Very difficult to carry. That's the reason the currency notes of higher denomination are printed. And have a look at this. How many of you have observed the size of the coin essentially has reduced over a period of time? The size of the coin has essentially lowered, right, over a period of time. Right, sir, what do you mean by that? Compare what was the size of, let's say, 10 rupee coin earlier or 5 rupee coin earlier with the 5 rupee coin today. You will see the current 5 rupee coin has become leaner, right, much thinner, etc. Right, don't you think there is something that has changed? Metal is costly. Metal is costly, right? Government doesn't want to use a lot of metal because you must have come across this earlier also. That is, people realize that the metal that is used in some of the coins is more valuable than the face value of the coin. Itself. So what they started doing? They started melting the coins. Simple. They started melting the coins. So government of India, that is right, let's say the RBI realized this and they have changed the, let's say, the size of the coin. They have reduced the radius now. They have reduced the thickness so that they will not be spending too much money on the metal itself. That is the logic. Okay. Prerak is saying, sir, you are not taking my question. My dear, when I'm asking now, please tell me what was the question you asked. Tell me, Prerak, my dear, what is the question you have asked just now? You have not asked any question because I'm looking at the chat section only now. Any other doubts? Okay. Okay, there is one more question. Sir, how decrease in the tax to GDP ratio of a country slows economic growth? My dear, it's basically the idea that if the tax to GDP ratio is increasing, there is a higher economic activity, government is able to collect more taxes. Simple. Correct? Government is able to collect more taxes and that is generally the outcome. But if the tax to GDP ratio is declining, generally it means the amount, that is basically the denominator, is decreasing. And when the denominator decreases, that is the GDP decreases, the tax revenue collection will also decrease. It will also take a hit. It will also fall down. That is the reason the overall tax to GDP ratio will also start falling down. Done? Everybody is okay? Can you please cover important canons? Not required. My dear, canons of taxation are not required. If they are required, I will cover it. Okay. Let's go forward. Right? Let's continue. 9:45 now. I've spent 5 minutes on questions. Let's continue. So what are the functions of Reserve Bank of India? Monetary policy. I was about to start monetary policy. Now please wake up, wash your face, right, move around for a minute like this, have a cup of tea or coffee, eat something, because I'm going to discuss. Expect one question from this slide. Expect one question from this particular slide alone, that is credit control tools or monetary policy tools. Very, very important. Very, very important. So these are also referred to as a credit control tool or monetary policy tool. But what is the basic idea? There are two sets of tools here. One is called as a quantitative and the other one is called as qualitative. Or else there is one more name for this. Quantitative, essentially, right? The other name for this is general credit control tools. General credit control tools, and the qualitative are referred to as specific credit control tools. General and specific. General credit control tools are used to regulate overall money supply. Regulate overall money supply in the economy. Either they will increase the money supply or decrease the money supply, again, overall economy. Whereas in the qualitative, you can regulate money supply in certain targeted sectors. You can target specific sector and only in that sector you can regulate money supply. Is everybody okay? Right, general and let's say specific. Let's start with general. Cash reserve ratio, bank rate, statutory liquidity ratio, repo and reverse repo, standing deposit facility, open market operations. Let's go one after the other. Let's start. The cash reserve ratio and statutory liquidity ratio. Let me club both of them and explain this. The banks will collect deposits. Point number one. The banks will collect deposits. The deposits for a bank are nothing but liabilities. Is it okay? Everybody is okay? Why I'm saying deposits of a bank are its liabilities? Because the bank has to return back. Bank has to return this along with the interest to the depositor. So they are liabilities. So the deposits are of two types. One is called as a demand deposit and the other one is a time deposit. A demand deposit and a time deposit. The demand deposits, example, savings bank account deposits. The bank will collect the money from you whenever the demand arises from the customer. Whenever you demand, I will allow you to withdraw money. I will allow you to take your money back. Demand deposit. Time deposit. Best example, fixed deposits. You keep this particular money with the bank for a specific time period. Right? It could be 333 days. It could be 444 days. It could be 5 years. It could be 10 years. So for a specific time period, you keep money with the bank. Done? Everybody is okay? Demand and time. So if you put together both of them and make adjustment. Adjustment means if you take the sum total of both of them and remove interbank deposit. Interbank means one bank keeping money with another bank. So get the sum total of both demand and time liability and remove interbank deposit. What you get is net demand and time liability. Is everybody okay? Net demand and time liability. NDTL. And what is the use of NDTL? Let's start. Cash reserve ratio. It is the percentage of NDTL that the bank has to keep with RBI. Is everybody okay? It is the percentage of NDTL that the bank has to keep with Reserve Bank of India. Right? And on this amount, RBI is not going to pay any rate of interest. RBI will not be paying any rate of interest on this particular amount. Clear? That is CRR. And who is deciding CRR? RBI. RBI will decide CRR. Next one, SLR. Statutory liquidity ratio. SLR stands for statutory liquidity ratio. What is a statutory liquidity ratio? Percentage of NDTL. Percentage of NDTL that the banks will have to keep with themselves. That the banks will have to keep with themselves. Not with RBI, with yourself. There are three options. You can keep this either in the form of a cash, or you can keep this in the form of the approved securities, that is generally government securities, central government, state government, etc. And you can keep this in the form of a gold. But what banks prefer is keeping this in the form of approved securities. Remember, they prefer to keep this in the form of government security. Reason is simple. This is very liquid. That is, you can sell them easily in the market, get the money from the market, and these are very, very safe. These are very, very safe. Government securities are the safest instruments that you can invest in the market. That is the reason RBI says these are the approved securities. Use them. So banks will purchase them. Safest investment. They will also earn interest on it. And if there is a requirement, they can sell them in the market, get the money, and allow the depositors to continue to withdraw money. Everybody is okay with the CRR and SLR? Do let me know. Everybody is okay with the CRR and SLR, cash reserve ratio, and statutory liquidity ratio. Now, let's discuss about repo, reverse repo, and open market operations. Let's club these two. Repo, reverse repo, and open market operations. Let me start with the last one. Open market operations. What is an open market operation? It is a type of an operation, that is activity conducted by RBI, where RBI sells and RBI buys government securities. Very simple. RBI sells government securities, RBI buys government securities. So why? According to the requirement, according to the need. For example, what if RBI wants to increase money supply right now? It will basically buy the government securities. Is it okay? It will buy the government securities. When they buy, they will give money to the bank. More money supply. More money supply means more loans, right? People will take loans to purchase goods and services. Companies will take the loans to invest and produce goods and services, etc. That is a basic idea. And when the RBI wants to control inflation, too much of money is there in the market. RBI wants to control inflation. RBI will basically sell government securities, right? They will sell, they will take out the money from the banking system. Everybody is okay? So either they will sell or they will buy. This is essentially called as open market operation. Is everybody okay with OMO? Now, under OMO, there are two types. I'll write here. Under OMO, there are two types. One is repo. One is essentially repo and the second one is outright. One is essentially repo and the second one is outright. What is the basic idea? In case of repo, please listen to me very carefully now. There are two terms that I've written here, repo and reverse repo. I know a lot of you have read the books. In the repo, they will simply say it is a rate of interest on the short-term loan given by RBI to the bank. Correct? That is generally they say. Right? What is repo? RBI will give a short-term loan to a bank, on that charge a rate of interest and they will call it as repo. And what is reverse repo? Banks will give loan to RBI short-term and charge a rate of interest and that is called as reverse repo. That is what they say. But in reality, listen to me very carefully now. In reality, repo stands for repurchasing order. And I know for a fact that a lot of you have already attended my session when I took a marathon on banking. I know, right? You will be starting to basically exude that confidence now. Sir, repo stands for repurchasing order. There are two transactions. In first transaction, this will happen. In second transaction, yes, I know. You also know. You have already learnt. But let me explain. There are certain new students. Okay. What is the repurchasing order? right? A repurchasing order essentially is an agreement between two parties. Let me explain. It is an agreement between two parties, right? What do you mean by two parties? It could be a bank, right, and RBI. But please understand, does the term repo always mean a bank and RBI? No. Repo is a very common instrument in the market, financial market. It's a very, very common instrument. But in the banking, it is mainly used between a bank and RBI. What is that? Let me start. In the book, you will say, or you will read, repo means RBI gives a short-term loan and charges a rate of interest. Correct? RBI gives a short-term loan and charges a rate of interest. But what is actually repurchasing order? What is actually repo? Listen to me very carefully now. Those who are newcomers, listen to me very carefully. Now, let's say you are a bank. Can everybody see this? Imagine this is a bond. Right? I hope you understand. Imagine it is a bond. It is not a bond. I also know that. You also know that. Somebody will say, sir, this is not bond. It is a cardboard. Okay, doesn't matter. Imagine this is a bond. You are a bank. You are the owner of this particular bond. Now, step number one. Listen carefully. Step number one. I will pay 100 rupees to you. You will sell the bond to me. Is it okay? I am RBI, by the way. I am RBI. You are a bank. I will give you 100 rupees. You will give the bond to me. This is step number one. Can I simply say, because of the step number one, banks will have money now? Correct? Because of the step number one, banks will have money. Now, this same transaction between you and me, that is a bank and RBI, same transaction will be reversed. It will be reversed after maybe 1 day, after 7 days. So when you say repo is a contract. Repo is an agreement between two parties. That is RBI and a bank here. Where RBI is saying, today you give me the bond. You sell the bond to me. I will give you money. After 7 days, you repurchase the bond. I repeat, after 7 days, you repurchase the bond, but at 110 rupees. Is everybody okay? Today, I will purchase the bond from you. I'll give you 100. After 7 days, you repurchase the bond and you give me 110 rupees. This is called as repurchasing order. Is everybody okay with the idea of a repurchasing order? Do let me know. Everybody is okay with the idea of a repurchasing order? I'm explaining this for a simple reason. A lot of you do not understand the difference between repo and a bank rate. You do not understand the difference. You think both are one and the same. Or you are basically assumed you will never understand because you do not know the basic idea. This is called as repurchasing order. That is, one party will sell the asset to another party with the promise of repurchasing on a specific date at a specific price. That is called as repurchasing order. Is everybody okay with the idea of repurchasing order? Please do let me know. But please understand and now tell me the answer to this question. Can I simply say, if the repo is done by RBI, the money that will enter into banking sector, it will be only there in the banking sector for short duration? Correct? Everybody is okay? The money that will enter into banks, it is there with the bank only for short duration. Sir, how short? It could be 1 day. It could be 7 days. It could be 28 days as well. But the money will be there only for short duration. Right? So that is called as repo. What is reverse repo? It is also a type of OM only. What is reverse repo? Exactly reverse now. What is a reverse repo? Reverse repurchasing order. Reverse repo simply means you follow the reverse order. What was there in the repo? What was there in the repo? Step number 1, RBI purchased the bond. That was there in the repo, correct? RBI purchased the bond in step 1. RBI sold the bond in the step 2. That is repo. In reverse repurchasing order, exactly opposite. Exactly opposite. That is, first step, RBI will sell the bond. Everybody is okay? RBI will sell the bond and you will give the money to RBI, 100 rupees. let's say after 7 days, RBI will repurchase the bond and give you 110 rupees, right? It will not be 110, right? Imagine in the repo, if it was 110, now it will be 107, 108 rupees, etc. Is everybody able to understand the idea of a repo and a reverse repo? But fundamentally, you tell me, fundamentally, don't you think repo and reverse repo, essentially, although there are two transactions under both of them, essentially RBI is buying or selling the government securities? Correct? RBI is buying or selling government securities. And when RBI buys or sells government securities, we call it as open market operation. Simple, we call it as open market operation. So if UPSC will ask you, is a repo a type of open market operation? Say yes. Absolutely yes. But here, the change in the money supply, whether RBI gives the money or takes money, the change in the money supply is only for short duration. Is only for short duration. That is a key term. Now, there is one more outright OMO. There is one more outright open market operation. Now, what is this outright open market operation? What is the basic idea of an outright open market operation? In the outright open market operation, RBI will either only sell the government bonds or purchase the government bonds. I hope you understand. Or, not and, or. Meaning what? If RBI wants to promote growth, RBI will basically purchase the government bond, give you money. That's it. Only one transaction. They will purchase the bond and give you money. No repurchase. No repurchasing order. No agreement. Basically, they will take the bond from you and they will give you money. So everybody is okay. This money that is supplied into the banking sector, it is for long duration now. It is durable in nature. Correct? Does it make sense to all of you? Do let me know. Does it make sense to all of you? Now, imagine inflation is there. Imagine inflation is there. Now, RBI simply says inflation is too much. I will basically sell the bond to you. That's it. You purchase the bond, right? Sorry, if the inflation is too high, RBI will basically sell the bond to you. That is, you take the bond and give the money to me. Only one transaction. No repurchasing, no reselling again. You, right, basically take the bond from me and you give the money. They will take out the liquidity from the bank. So please understand the outright OMO. The outright OMO will change the liquidity for durable in nature, for durability. It can increase or decrease according to the requirement in the market. But that change, whenever it is for a short duration, that is repo and reverse repo. Is everybody okay with the idea of a repo, reverse repo, outright OMO and overall OMO? Can we go forward now? Do not get confused in the examination. Right? These are important concepts, by the way. Don't get confused in the examination. For example, if you have seen the RBI operations in recent times, RBI reduced the CRR. Right? In the last 1 year, RBI has reduced the CRR. RBI has not changed repo rate. All of you are able to understand the logic behind it? Because in the book you will read, with the reduction in CRR, money supply increases. With the reduction in the repo, money supply increases. So now ultimately the question will be this. If money supply can increase by reducing CRR, by reducing repo also, then why will RBI reduce CRR? Why not repo? Because my dear, in repo, today the money supply will increase. But after, let's say, 21 days, if the agreement is for 21 days, after 21 days, RBI will take the money back. Simple. RBI will take the money back. That is not a change in the money supply for long duration. It is only for short duration. What if RBI says, no, I want to keep the money supply higher for maybe 2 years, maybe 3 years, maybe 1.5 years. Then they will not tweak repo. They will keep the repo same. They will reduce CRR. They will reduce SLR, right, etc. Everybody is able to understand the logic here, right? So that is the reason I'm saying last 1 year, look at CRR. They have reduced the CRR from 4% to 3%. They have reduced CRR from 4 to 3 and they have not touched repo. They have kept the repo same way. Okay, let's go forward. So cash reserve ratio, SLR done, repo and reverse repo done, open market operation done. Now, there is one problem in reverse repo. And there is one problem in the reverse repo. What is the problem? Basically, the idea is you keep deposits with RBI, RBI will give you money. That is, I hope you understand. RBI will sell the bond to you, take the money from you. That is the first step in the reverse repo. Correct? That is the first step in the reverse repo. Basically, you will read this in the book saying that bank will keep a deposit with RBI. RBI will give collateral. RBI will give security to the bank. Now, have a look at this. Have a look at this. What if the banks want to conduct reverse repo? RBI does not have sufficient government securities. Let me know. Right? RBI wants to, the banks want to keep deposits with RBI. They want to conduct reverse repo. But RBI does not have sufficient government securities. Don't you think that's a problem for RBI? That's a problem for the whole system. So, what we have done is, based on the recommendation of Urjit Patel Committee. Remember, based on the recommendation of Urjit Patel Committee, we have introduced a tool called as Standing Deposit Facility. We have introduced a tool called as a Standing Deposit Facility. Under the Standing Deposit Facility, listen to me very carefully. A bank will deposit money with RBI. Step number 1. Bank will deposit money with RBI. Sir, for what duration? Depends. It's short term. Short term generally means up to 1 year. Up to 1 year. Right? So, step 1, bank will deposit money with RBI. RBI doesn't require to provide any collateral. RBI doesn't provide any security. Step number 2, the bank will withdraw the money. Bank will take back the money along with the interest from Reserve Bank of India. Is everybody okay with this idea? This is called as a Standing Deposit Facility. Standing Deposit Facility. SDF. Standing Deposit Facility. Is everybody okay with the idea of STF? I have not listed STF. Okay, it is there. Standing Deposit Facility, it is there. This is the meaning of STF. This has been introduced very recently. The banks are mainly using STF now. The banks are mainly using STF. And understand one more very important terminology here. Understand very important terminology. Repo and reverse repo will be available to you when RBI will announce it. Is it okay? I'll repeat the statement. Repo and reverse repo are available to you, but RBI will announce it. For example, RBI will simply say, for the next 1 week, repo facility is available. For the next, let's say 21 days, reverse repo facility is available. These are not available throughout the year. These are not there throughout the year. RBI announces their availability. Whereas the term standing, whenever you come across this term, please remember, whenever you come across the term standing in the context of these particular monetary policy tools, it simply means this facility is available throughout the year. Is everybody okay? This is available throughout the year. There is one more tool. There is one more tool under the quantitative itself, marginal standing facility. I'll explain this. Marginal standing facility. But before I explain, please do let me know. Everybody can observe the term standing in the name of the tool. Please do let me know. Wake up, by the way. Wake up. I know a lot of you have already started dozing off, etc. Don't worry. We will cover monetary policy tools, at least one part of it. Then we will pause. I'll continue in the next session. Don't worry. So, but please wake up and do let me know. All of you are able to see the term standing? The term standing means what? Throughout the year. So, this particular tool, marginal standing facility, is available for the banks throughout the year. But what does it actually mean? The marginal standing facility simply means whenever the banks face emergency. I'll repeat. Whenever the banks face emergency, the banks are allowed to borrow from the Reserve Bank of India for short duration. For short duration. And before you ask me, sir, repo also short duration? My dear, repo is an agreement. MSF is for emergency purposes. Is it okay? Emergency for purposes. For example, generally for overnight purposes. If there is an urgent requirement for a bank, they don't have sufficient funds, they are allowed to borrow from Reserve Bank of India under MSF. Under MSF. And that's a reason, look at the availability of MSF. Correct? Look at the availability of MSF. It is available throughout the year. Is it okay? It is available throughout the year because emergency can happen at any point of time. Repo is available to you only when RBI provides the facility. But emergency can happen at any point of time. Correct? A bank can face emergency at any point of time. So they can borrow from Reserve Bank of India for very short duration, generally for overnight purposes under MSF. And because the banks are requiring money, emergency is there, there is a problem with the bank, they have not managed the funds correctly, RBI charges a higher rate of interest under MSF. Is it okay? RBI charges a higher rate of interest when they lend under MSF. Is everybody okay? So CRR, SLR, repo and reverse repo, standing deposit facility, open market operation and marginal standing facility. There is one more. Let me cover this, then we can stop for today. Bank rate. One more, bank rate. We'll cover at least one part of the monetary policy, bank rate. What is this bank rate? Bank rate is purely a lending rate. Simple. Bank rate is purely a lending rate. That is, you take a loan from RBI and you pay rate of interest. You take a loan from Reserve Bank of India and you pay rate of interest. That is called as a bank rate. Right? So, in the context of these particular instruments, please look at the table now. Please look at the table. Right? I've summarized. And my suggestion, please use these kind of tables. What you can, let's say read in 1 hour. Right? All these particular monetary policy tools, quantitative, what you can read in 1 hour, you can summarize in 5 minutes like this. Right? For revision, it will be very easy for you. Let's start. Repo. Banks borrow from Reserve Bank of India for short term. Do they provide collateral in this? Yes. Is there a requirement of collateral? Yes. Reverse repo. Banks will deposit money with RBI. RBI will pay rate of interest to the bank. Again for short term. Is there collateral requirement? Yes. Standing deposit facility. The banks deposit. This is reverse. I made a mistake. Don't worry. In the PPT that I upload, I'll correct it. Okay. Standing deposit facility. The percentage of NDTL that the banks will keep. Right? No, correct. But only one correction I need to do. I'll just make it while uploading the PPT. Don't panic. Don't worry. Standing deposit facility. The banks deposit money or keep money. Keep this particular money, which is percentage of NDTL with themselves. Is everybody okay? Please do let me know. It is a standing deposit facility. My mistake. I'm making a mistake here. Don't worry. I'll correct it. I thought I was discussing. Okay, my mistake. I thought I was discussing SLR. Okay, I thought I was discussing SLR. Don't worry. SLR, percentage of NDTL that the banks will keep with themselves. Correct? At least now it is okay. Right? Again, I'm saying my mistake. I thought I was discussing SLR, but it is standing deposit facility. In fact, there was one student who was saying, sir, what are you discussing? You're making a mistake. Right? What are you discussing? You're absolutely right. I was making a mistake there. Okay. So statutory liquid ratio, percentage of NDTL that the banks will keep with themselves. Is there a collateral requirement? No. Collateral requirements are not there here. Okay. Standing deposit facility. Now let's get back to SDF. SDF essentially, the banks will deposit money with RBI and earn a rate of interest. Earn a rate of interest. Is there any collateral involved here? No. Under repo and reverse repo, collateral is there. But under STF, no collateral requirement. Next one, cash reserve ratio. Percentage of NDTL that the banks will have to keep with RBI. You have collected NDTL, take a percentage of it, keep it with RBI on this no interest rate. That is basically the cash reserve ratio. Is there any collateral? The idea of a collateral is not even applicable here. It is basically part of the deposit, keep it with, right, let's say RBI. Marginal standing facility. For overnight purposes, for emergency purposes, the banks are allowed to borrow from Reserve Bank of India. The banks borrowing for very, very short duration. Do the banks provide collateral for this? Yes. And finally, bank rate. Bank rate. Under bank rate, the banks borrow from Reserve Bank of India. Usually they'll say this is the borrowing for long duration, because unlike repo, which is very, very short, bank rate is used for the banks to lend for a longer loans. The banks will borrow and give loan for longer duration. That is bank rate. So under the bank rate, banks borrow from Reserve Bank of India. Do they provide any kind of a collateral? Answer is no. Done? Everybody is okay? Please do let me know. Please do let me know. Everybody is okay with the, right, let's say, this side of the monetary policy tools, that is quantitative set of tools. Please do let me know. Somebody is saying, sir, you're feeling sleepy. My dear, when you stand, you don't feel sleepy. When you stand, you don't feel sleepy. Yes, that was a mistake. I was reading, again I'm saying, my reading was wrong. I thought I was explaining the SLR concept, but I was not explaining SLR. I was explaining the STF, by the way. Okay. Sir, there is a MSR already. MSF, okay, marginal standing facility. There is MSF already. So why repo is necessary for the banks? Again, I'm saying, one, MSF is available throughout the year, but RBI will not charge, right, let's say the same rate of interest under MSF and repo. RBI will charge a higher rate of interest under MSF compared to repo. So if you're a bank, you tell me, if you want to borrow for short duration, which one do you think is better? If repo facility is available, you will use repo first. You will not go for MSF. Why? Rate of interest is higher there. Okay. Next. Okay. Now it is the doubt resolution time. If you have any doubts, do let me know. I'll address them one by one. Let's go forward. Next one. Current affairs marathon. What collateral will the bank pledge? Government bonds. Government bonds. Government bonds are generally the collaterals which are used by the banks to pledge and borrow like this. Everybody is okay? They generally use government bonds. Next one. If the borrowing and lending for short term, then can the banks use it to dispense a large credit to customers? Generally, they don't use this kind of a credit. It's an indicator, agreed, but they don't use that kind of a, let's say, money to lend long term. Generally, they use the deposits that they've collected. Of course, they will borrow from RBI. They will use that also. But repo is for short duration. For example, imagine this. What do I mean by that? Imagine the bank has not collected any amount from a customer. Hypothetically, it is not likely, it is not going to happen, but just to make you understand. Imagine the bank has collected, let's say, only 100 rupees from a customer, not 100 rupee. Now they will take a repo of 7 days from RBI, let's say 1000 rupees. Now, assuming nothing else is going to change in terms of deposit, can the bank take a risk and give 1100 rupees worth of loan for 20 years in the market? Think of it. If they provide for 20 years, after 7 days, they will have to return the money to the Reserve Bank of India under the repo. So I hope you understand there are certain constraints, right? So is the repo an indicator? Of course, yes. Repo rate of interest is a very good indicator in the market. But the banks use other types of deposits along with the repo, bank rate, etc. to borrow and lend in the market, not just the repo. Next one, where is the question? Okay, Arushi. Banks don't earn interest on CRR, SLR, right? On CRR, they don't earn. SLR, they deposit, sorry, they invest in the government bonds, they earn. They earn on government bonds. Next one. Aman Singh, repo not available all the time. Yes, that is true. Lokesh, SEZ are provided by the center or the state. SEZ policy is promoted by the central government, not by the state government. Uh, Sapta, Saptashati. Again, I'm not able to pronounce the full name by the way, because you have joined two terms. Anyways, uh, bank rates are higher than repo. Yes, bank rate is higher than repo. MSF rate is higher than repo. Reverse repo rate is lower than repo. STF is lower than repo but higher than reverse repo rate. Saurabh, sir, who decides interest rates on deposit, bank themselves or RBI? On the deposits, right? Again, within the deposits also, there are multiple criteria. There are multiple criteria. Let's focus on only the normal deposits. If I'm collecting a normal deposit, let's say fixed deposit or savings bank account, it is the rate of interest is decided by me. It is decided by me. RBI doesn't decide it. Earlier, RBI used to do that. But now only the banks, respective banks, decide the rate of interest. Next, Tushar Kumar. Sir, if there is no collateral in STF and BR, how it works? My dear, it is purely a lending rate. Lending rate. You take a loan, you pay rate of interest. That's it. What is it? What is the difficulty in that? You take a loan and you pay higher rate of interest. For example, there are certain types of loans that you take in the market. For example, let's say you take a loan from NBFC. Is there a collateral always there? Not required. NBFCs will give you loan even if you don't have a collateral. But mind you, they will charge a rate of interest. Apply the same logic. Okay. IBLR, MCLR, my dear, I'm yet to cover that. I'm yet to cover MCLR, I'm yet to cover. Have a look at this. It is there in the, right, let's say this thing, I'm yet to cover. Don't worry, I'll cover it later. Okay, next. Sir, please finish qualitative. My dear, it will take another half an hour. It's already 10:30. It's already 10:30, right? So a lot of you have already fed up. I know that. That's the reason I stopped at right after quantitative. Uh, Lokesh, is there any reason behind why finance secretary sign on rupee note? My dear, the reason behind that is the rupee note is counted as a currency coin. The rupee note is counted as a currency coin. Currency coins are minted by the government. That's the reason in the rupee note, government authority will be right mentioned there. That is the finance secretary signature. Okay. Sir, fiscal policy includes revenue policies in general or only taxes? Expenditure policies as well as taxes. Traditional idea. But any kind of a revenue, the government will consider that. But traditionally, because I hope you understand, all these concepts, right, or these terminologies have been devised looking at how the old age, right, let's say governments used to work. That point of time, the focus was always on taxation. Government did not have the idea of selling the asset, selling the companies, right, disinvestment, etc. That point of time, the whole idea was collect money through taxation. That's the reason you will see there is always a connection to taxation when they talk about the policy, fiscal policy. Next one, not related to economy, but could modern history marathon, my dear, PPT be checked? I'll ask the backend team to check it. I'll ask the backend team to check it. Can the banks invest in municipal bonds under SLR? Yes, they are allowed now. Not under SLR, under repo itself, they can purchase now. Right? Municipal bonds are covered under approved securities, by the way, now. They can be used under repo. Next one. Shivamurthy, thank you. Okay. Aspirant, does the current flexible inflation targeting framework risk a growth inflation trade-off by using demand-side interest rates to tackle India's persistent supply side structural food inflation? Aspirant, my dear, this is a mains question. This is essentially a mains question. You have taken this from some question paper and you have asked that to me. Please understand, whenever you talk about inflation targeting, there is always a risk trade-off. There is always a trade-off. It's not that purely one-sided transaction. It's always a trade-off. That is, if you fix, let's say, 4% inflation target, and that to headline, and you have certain amount of weightage for, right, let's say volatile commodities, there is always a danger that just because certain commodities become very costly very quickly, you can change your monetary policy also very quickly. Increase the interest rate because you are bound by the target to control inflation. That danger is always there. But if you have observed what has happened now, the core weightage has been increased under the new CPI. The weightage for core has been increased. That to a very great extent should address the problem of, right, let's say, no abrupt change in the monetary policy. Okay, next, a bank generated savings credit of 1,600 first round of savings deposit. What is the cash? Are Baba, don't enter into all of it, right? Basically, you're picking up question from some papers and you're throwing it here. Can capex lead to crowding of private investment? Yes, possibility is always there. Higher capex, let's assume the government will spend more money on development of infrastructure. Even the private sector will be more interested. Even the private sector will feel, right, yes, this is the opportunity. Government is focused on the growth. Government is promoting investment. Private sector can crowd in because of that. What is the 16th FC recommendation regarding off-budget borrowing? Central government has discontinued, they don't follow the off-budget borrowing now. State budgets, a lot of the state governments actually follow off-budget borrowing. So the 16th FC has recommended that, one, make it transparent in nature. That is, start publishing the data in the budget documents, or else simply discontinue it. Discontinue, do away with the idea of, right, let's say, the off-budget borrowing. Next one. So then why repo rate is center stage monetary policy and even impacts the markets when there is no use in actual credit creation? My dear, it is used. Who said it doesn't have any utility? I'm saying there is a utility. But please understand, you cannot use bank rate as a monetary policy anchor right now. Reason being, the market is very dynamic. Market is very dynamic. Earlier we used to use bank rate. But today the situation is such that in a very short duration, the liquidity situation or supply side factors or demand side factors can change the situation in the market. That's the reason we are using a short-term instrument, short-term tool as a center of your policy making. That is a repo rate, by the way. Okay, next one. Sir, if foreign banks are having banks in India, then repo and reverse repo is applicable to banks? Yes, my dear. Yes. Right. Whatever is a bank operating in India, you have a, right, let's say, approval from Reserve Bank of India. You come under the regulation of Reserve Bank of India, then you will have to follow these guidelines. Okay. RBI has more surplus money. Can't the government take money from RBI instead of borrowing? No, you can't do that. You can't simply put your hands into RBI, let's say, chest and take it away, because RBI is the central bank. It has its own functions. No doubt RBI is owned by the government of India, but you can't simply take away the money from RBI like this. No, that will create a very bad precedent, right? It basically shows that RBI is not working independent, right? There is a government intervention. That is not a good precedent, by the way. Okay. Same question. A bank generated savings credit of 1,600 crore in the first round from savings deposit of 2,000 crore. What is cash reserve ratio fixed by the central bank? My dear, RBI will fix that. RBI will fix the CRR. I don't know what is the question you are asking, by the way. RBI will fix the CRR, right? Right now the CRR is 3%. right? It was earlier 4%, but what is the question? I'm not able to understand. Okay, anyways, done then. So let me pause the discussion here. Let me stop the discussion today here. Time is almost 10:30, right? So let me stop the discussion. Again, I'm saying do not worry about the PPT, right? You will get access to the PPTs. But most importantly, revise. Revise. Don't simply sit, download the PPT and simply sit with the PPT. Please revise. And tomorrow and day after tomorrow, right? I'll arrange a couple of more classes. Don't worry. Let's solve more and more questions, right? This is the link for the tomorrow special class as well as the day after tomorrow's special class. Please do join. Let's solve the question and let's basically consolidate your learning so that you will not be able to forget the concepts very easily, or you will basically have more confidence in solving the questions. So that's it from my side in today's session, by the way. If you have liked the discussion, do not forget to hit the like button. If you are yet to join our YouTube channel, kindly do join the YouTube channel right now. Remaining parts of the banking, do not worry, I will cover it because I've got 2 more marathon sessions. I hope all of you know this. I've got 2 more marathon sessions. I'll cover the remaining part, right? Along with the other parts that I've already listed out. So don't worry, I will cover the remaining topics in the next and the next marathon session. But I want you people to attend the test, attempt MCQ questions, practice more and more, right? Because that will consolidate your learning and most importantly, improve your confidence. So that's it from my side in today's session. Take care. Have a great day. See you in the next marathon session. Right. Good night.